So welcome to CA final revision series. So we have already completed time value for money and advanced capital budgeting. What is our next topic? Portfolio management. The weightage of this topic is on an average you will get 11 to 12 marks. 11 to 12 marks. Okay. So in this video I am going to cover CA final study material questions and all CA final past questions. So we have already discussed the basics, right? A business to become successful we need a clear and realistic strategy. Financial resources and right management team. Nothing but strategy, finance and management. We need SFM, but our subject name is AFM, Advanced Financial Management. Okay. Earlier it was called as SFM, but now it is called as AFM, Advanced Financial Management. The objective of AFM is to maximize the wealth. To maximize wealth, we take four types of a decision, that is financing decision, from where to procure money, investing decision, where to invest money, dividend decision, whether to declare a dividend or not, portfolio decision. In portfolio decision means investing in two or more assets or securities. Okay. At CA inter level, we have already discussed the financing decision, procurement of fund, cost of a capital structure. Okay. And we have discussed investing decision. So that is capital bursting and working capital management. And in last class, we have discussed an extension to the capital bursting topic, that is advanced capital budgeting. Okay. Now we are going to discuss portfolio decision. So four decisions falls within the scope of a financial strategy: financing decision, investing decision, dividend decision, and portfolio decision. So dividend decision also we have covered at CA inter level. Now portfolio decision. So portfolio means a combination of different financial assets such as bonds, stocks, and money market instruments. So there are three activities in portfolio management. Three activities. Simple. So portfolio means a combination of securities such as bond, stock, and money market instruments. Okay. So portfolio chapter, mainly we are going to learn how to find out the risk. And return. Why? Because before investing in any security or in any asset, we consider mainly two factors, that is return and risk. So that's the main objective. The learning objective in this chapter is finding out the risk of security and return of a security, and also return of a portfolio and risk of a portfolio. So the basic point, the theme of this portfolio chapter is, if you invest in portfolio, the risk can be diversified. We should not put all the eggs in one basket. If we put all the eggs in one basket, eggs will break, yes or no? Likewise, we should not put all the money in one particular stock. If we put all the money in one particular stock, we might lose the entire money. So that's why in finance also there is a rule. For suppose if you have a 1 crore rupee and if you have to give a loan, you should not give 1 crore loan to one single person. You should give that 1 crore loan to 100 people. Why 100 people? Because even if 5 or 10 people makes a default, still 90% will repay the principal with interest and you will be safe. Okay. So that's why in the portfolio, the basic point is, if you invest in two or more securities, the risk can be diversified. So that's why here three activities are involved in portfolio management. First activity, selection of a security based on risk and return. In market you will find thousands of securities. We cannot invest in 1,000 securities. So we will be having a funds limited. So that's why we should select the securities based on return and risk. And after selection of securities based on return and risk, construct feasible portfolios. And next, decide the weights of a different securities. Deciding the proportions, in which proportion the investment has to be made. That has to be decided. So these are the three major activities in portfolio management. So what is the objective of portfolio management? Before investing in a portfolio, first you must ensure that principal must be safe. Safety of a principal amount, stability of a income, marketability, capital growth, liquidity, diversification. So liquidity and marketability almost same. Marketability. So you should not invest in a private limited company, because if you are investing in a private limited company, closely held company means most of the shareholders are what? Relatives, friends. Okay. You cannot come out of that company. So that's why generally you have to make investment in listed company shares for better marketability. Okay. So safety of a principal, stability of income, marketability, the securities must be marketable. Liquidity means securities must be easily convertible into cash. Capital growth, and also what the main point, diversification. Main point is what? Diversification. Okay. So we should not invest in one particular company stock or one particular industry. We should diversify investment into different securities or different industries. Okay. Clear? Next, phases in portfolio management. Now you might be getting a doubt. As a chartered accountant, why you should learn mutual funds topic? You may be appointed as a fund manager. As a fund manager, on behalf of the investors, you have to decide where the investment has to be made. Where the investment has to be made. So next topic we want to discuss is derivatives and then mutual funds. Mutual funds. So why we are learning mutual funds topic? Simple. As a CA, you may be appointed as a fund manager. What is the concept of a mutual fund? To invest in stock market, first we require money. And next, time to analyze the security. Time to analyze the security. And third, knowledge. Third, knowledge. Okay. So generally people may have a money, but they may not have time to analyze the security. Even if they have a time to analyze the security, they may lack knowledge. They do not know security analysis. They do not know how to analyze the portfolio. So that's why we have a concept of a mutual fund. For example, we all are busy. Okay, most of the software employees are busy. They may have a money, but they may not have time to analyze the security, and they do not have a knowledge. So those investors, retail investors, they will invest money in mutual funds. Mutual fund is professionally managed by a CA or a CMA or a CFA, Chartered Financial Analyst. Okay. Now the fund manager will be analyzing the security and portfolio on behalf of the investors, and will invest money. Fund manager will take incentive. If the fund perform well, fund manager will take incentive and he will be taking a fixed percentage on the portfolio value. For suppose portfolio value is equal to 100 crores. Portfolio value is equal to 100 crores. So the fund manager will be charging what? Straight away 1% or 0.5% on the fund value. Okay. So that is a fixed charge. Apart from fixed charge, he may get incentive. He will receive an incentive if a fund perform well. Fund performing well means what? 100 crores invested and the fund value increases to 120 crores or 130 crores. That excess 20 or 30. On that excess 20 or 30, he will get incentive. Fund manager will get incentive. Okay. So why we are learning portfolio management chapter? Because the reason you may be appointed as a fund manager, and if you are appointed as a fund manager, you should know how to analyze the security and how to analyze the portfolio. Okay. That's why in this chapter, first we are going to learn how to find out the return and risk of a security, and also then we are going to learn how to find out the return and risk of a portfolio. So what are the stages in portfolio management? First stage, security analysis. First stage, security analysis. We should analyze the security. We should identify the securities for investment based on return and risk, security analysis. Second, portfolio analysis. Portfolio analysis. So three activities. First activity, selection of security based on return and risk. Second activity, construction of all feasible portfolios. So once the portfolios are constructed, we have to analyze the portfolio. We have to analyze the portfolio again based on what? Return and risk. Next what? There may be 5 or 6 portfolios. We cannot select all the 5 or 6 portfolios, right? We will be selecting best portfolio out of 5 or 6. So portfolio selection, and next portfolio revision. Portfolio revision. So time to time we revise the portfolio. So the reason for portfolio revision may be need of additional funds. If we need additional funds, we sell the securities. Then portfolio compositions may change. Or we have a surplus funds. If we have a surplus funds, we add investment to the portfolio. There may be a change in risk perception. For example, since the war between Iran and Israel has started, the Nifty decreased by 10%. The reason for decrease of a Nifty by 10% is the foreign institutional investors started selling equity investment in Indian stock markets. Okay. So why they are selling their investment in Indian stock market? Because of change in risk perception. Initially they felt like what? Indian stock markets are less risky. But now they started feeling like it is high risk to make investment in what? Indian stock market, because most of the companies in India are dependent on oil. So that's why what? They started taking back the investment in Indian stock market. So portfolio revision. And next what? Portfolio evaluation. For portfolio evaluation, so we have a concept of Sharpe ratio that we are going to discuss in next stage. Sharpe ratio, Trainer's ratio, Jensen's alpha. So portfolio evaluation means nothing but assessment of performance of the portfolio, how the portfolio has performed, whether we got a revenue, whether we got a profit or a loss. So we do that assessment. So there are 5 stages in portfolio management: security analysis, portfolio analysis, portfolio selection, portfolio revision, portfolio evaluation. So security analysis. Here we examine risk and return characteristics of individual securities and also correlation among them. Correlation among them. So correlation denotes closeness between the two securities. Correlation denotes what? Closeness between the two securities. Okay. So here security analysis means we examine the return and risk characteristics of individual securities. So here we follow the simple strategy. If the securities are underpriced, the securities are underpriced. So security is underpriced. When we say it is underpriced or overpriced, so generally we compare an actual return and CAPM return, and we decide whether the security is underpriced or overpriced. We calculate Jensen's alpha. If Jensen's alpha is positive, security is underpriced, buy. If Jensen's alpha is negative, security is overpriced, sell. Okay. And in security valuation topic, we have a security valuation in our syllabus. In security valuation also, we find out the value of a security. So that value is called as a theoretical value. We are learning theory in the classroom. We are applying the theory and finding out the price. Example, we got 32 rupees. Price of a security X is equal to 32. Price of a security X is equal to 32. In classroom, we are getting 32. What is the meaning of this 32? As per the theory we are learning in the classroom, the security value must be equal to 32. But in the market, the price is 40. In the market, the price is 40. That means in the market, security is overpriced. As per our theory, the price must be equal to 32, but in the market the price is 40. So that means it is overpriced. And if we are holding the security, we sell the security. Why? Because as per our perception, okay, the value must be 32 only. But whereas in the market the price is 40, sell. For suppose if in the market the price is 20 rupees only. 20 rupees. In our perception price should be 32, but in the market the price is 20. So buy the security. Buy the security. So simple strategy: if it is underpriced, buy. If it is overpriced, sell. For security analysis, 2 approaches: fundamental analysis, technical analysis. Okay. If you are interested in investing money in stock market, you have to do a fundamental analysis and you should invest money for a long period. You should not go for intraday trading. Intraday trading. Fundamental analysis means what? We concentrate on fundamental factors affecting the company, such as EPS of the company, dividend payout, competition faced by the company, market share, and quality of management. Fundamental analysts compare intrinsic value with market value, fundamental factors affecting the industry to which it belongs to. Okay. Mainly we focus on what? Fundamental factors. So financial information of a company. So if we focus on the fundamental, if we concentrate on the fundamental factors which affecting the company, so then that is called as a fundamental analysis. Okay. So technical analysis means we concentrate on price movement and ignore fundamental factors. We focus on what? Price movement and ignore what? Fundamental factors. So trend analysis. We concentrate on a trend analysis, that is called as a technical analysis. So we are going to thoroughly discuss technical analysis and fundamental analysis in security analysis chapter, theory chapter, security analysis. Okay. So portfolio analysis. Once the securities for investment has been identified, the next step is to continue the securities to form the suitable portfolio. Next, portfolio selection. So the goal of a rational investor is to identify the efficient portfolio out of the whole set of a feasible portfolio. Generally, a portfolio is said to be efficient. Efficient. We have to apply the rule of a dominance. So we select a portfolio which is giving a higher return for low risk. So we are going to discuss one question, rule of a dominance. So generally a portfolio is said to be efficient. A portfolio is said to be dominating if it is giving a higher return for low risk, or same return for low risk, or higher return for same risk, or higher return for higher risk. 4 cases. High return with low risk. Portfolio is giving a high return with low risk when compared to other portfolio. Then this is an efficient portfolio. Okay, high return for same risk. Then also it is said to be efficient. Clear? Next, same return, low risk. Same return, low risk. So portfolio is said to be efficient. And fourth case, high return for higher risk. Here I have taken two cases, higher return with identical risk. Higher return with identical risk. Example, portfolio 1, portfolio 2. So portfolio 1, risk 10%, portfolio 2, risk 10%, return 15 and 20. Which security are we going to select? Which portfolio are we going to select? Portfolio 1 or 2? We are going to select portfolio 2 because it is giving higher return with same risk. Higher return with same risk. Second case, identical return with low risk. Identical return with low risk. So we select a portfolio 2 because it is giving same return for low risk. So this is how we select an efficient portfolio. So this is how we select the portfolio. So that's why generally we select a security or a portfolio based on a return and risk. So that's why in first part of the portfolio management, we are going to learn how to find out the return and risk of a security and return and risk of a portfolio. Clear? Portfolio revision. In the light of developments in the market, the investor has to revise his portfolio. Okay? In the light of developments in the market, obviously what the investor has to revise the portfolio. So the reasons can be what? Availability of additional funds, change in risk perception, and need for cash. Portfolio evaluation means what? This process is concerned with assessing the performance of a portfolio over a selected period of a time. Over a selected period of a time. Clear? Now, so in first part we are going to discuss return and risk of a security, and then what? Return and risk of a portfolio. So why are we learning this return and risk of a security concept? Simple. While investing, before making any investment, generally we keep in mind two factors, that is return and risk. Okay. So after CA qualification, are you going to join civil services coaching? Are you going to join civil services coaching? Generally you keep in mind two factors. What is the return I am getting? Okay, if you become IAS officer, you may get return. You may get huge respect. But why you do not have a thought of going to civil services? What is the other factor you are considering? What is the other factor you are considering? Risk factor, the possibility of failure. Possibility of a failure. Here the syllabus is defined, confined. Here the syllabus is confined, but whereas in civil services, syllabus is not confined to one area, one single area. Yes or no? So generally in risk, in UPSC exams is what? High. In groups, it is even more high because they don't know when the notification will be released by the state government. Yes or no? Risk is too high. So that means before choosing a course itself, you consider two factors. One is return and the second one is risk. So that's why before investing in any security, we generally consider what? Two factors, that is return and risk. So we invest in securities. So while investing in security, you may get return in two forms. Return in what? Two forms. Okay, what are the two forms? One is capital appreciation, second dividend. Second is dividend. So not every company pays dividend because payment of dividend is not mandatory. Example, Tesla company has never paid dividend. Never paid dividend. That means what? Whatever the profits earned are retained and reinvested. Retained and reinvested. Okay. But the shareholders of Tesla company will get a return or not? Yes, they will get a return in the form of capital appreciation. The share price will increase. So generally we may invest in equity shares or debentures. Equity shareholder will get return in the form of CA Saileja. What? Why you are staring? CA Yogita, CA Harshita. So equity shareholders will get return in the form of two. Capital appreciation, CA CMA Navneet. Capital appreciation and what? Dividend. Debenture holders will get return in the form of capital appreciation and interest. Generally debenture shareholders will get less amount of a capital appreciation. Less amount of a capital appreciation. Why? Simple. For suppose company is growing, but still debenture holders will get fixed rate of interest. Fixed rate of interest. So that's why if a face value for debenture is 100 rupees, market price may be 110, 120, that's it. Okay, it will not increase to 1000 or 2000 rupees. Why? Why? Because simple. Investor will get a fixed rate of interest irrespective of a growth of a company. Okay, but what about equity share? Face value 1 rupee, but market price may increase to 1 lakh or 1 lakh 30. Clear? Okay. So capital appreciation. So first return. How do we calculate return percentage? Return percentage is equal to P1 minus P naught plus D1 divided by P naught. So this formula again we use in mutual funds topic. Mutual funds topic. So this is simple. P1 minus P naught. P1 price at the end, P naught price at the beginning, D1 dividend for the year 1. So let me take example. Price at the beginning 100, price at the end 110, dividend received during the year 10 rupees. Okay. So 110 minus 100 plus 10 divided by 100. Simple logic. So I invested 100 rupees. Price increased to 110. I got a capital appreciation of 10 plus dividend 10, overall 20 divided by 100. So 20% is the return. Okay. So this is how the return is calculated. So generally, so I will not expect this 20% for the next year. I will not expect 20% for the next year. What I will do is, I will gather the security information for the past 5 years or 10 years. For suppose if I want to invest in security X, I will gather information of related to security X for the past 5 years or 10 years. And for the past 5 years or 10 years, I will find out return. I will find out the return for the past 5 years or 10 years. Past 5 years or 10 years. Yes or no? Based on past what? We can expect. We can expect what? Future. Based on past, we can expect what? Future. Yes or no? Clear? Generally what? Based on past, we expect future. But the past, history may not repeat. History may not repeat. Yes or no? For example, Navneet. Okay, he is a decent fellow. Okay, he is a teetotaler. Okay, he does not have a habit of drinking, smoking, and he is like Ramam in Aparichit movie. Okay, so this is the past. This is the past. So based on the past, okay. So on the other side, okay. So the bride family, so they got attracted, and so that girl got married to Navneet. Okay, based on the past, what is our expectation? In future also, Navneet will remain same. Okay, definitely there is a high chance that Navneet will remain same. But there is a chance that what? There is a chance that what? He may, okay, start smoking, drinking, etc. Yes or no? So, am I clear? For suppose Pawan Kalyan, he is a drunkard, smoker. Okay. So, based on past, what is our expectation? He will remain the same in the future. Yes or no? Likewise, if a security if security was giving 20%, 25% in the return in the past 5 years, generally our expectation will be what? The security is going to give us same kind of a return in the future also. Yes or no? So that's why what we do is, we gather the security past information and we find out the returns for the past 5 years or 10 years. Past 5 years or 10 years by using the formula P1 minus P naught plus D1 divided by P naught. For suppose last 5 years data is collected, last 5 years, and the X return is calculated, return was calculated. Okay. Then thereafter, example, see this example. So past 5 years return was, past 5 years data was collected, and security has given a return of 10, 20, 50, 30, 60. What was the highest return in the past 5 years? 60%. Are we going to expect 60% return for the next year? Answer is no. What is the lowest return? 10%. Are we going to expect the lowest return 10%? No. Generally we expect an average. We expect an average. Yes or no? So what is the average return? 10 plus 20 plus 50 plus 30 plus 60 divided by 5. 34%. So we are doing a simple average. So for the next year we expect this 34%. For next year we expect this 34%. Okay. So but for some security, the past information may not be available. Past information may not be available. In that case, what? We take the possible events. We take the possible events or possible returns, expected possible returns. Example, in second example, so we are expecting that security may give 20%, 50, 80 or 100 or 10% return for the next year, and we are assigning the probability. We are assigning the probability. So in examination question, past data may be given or the future data may be given. Likewise, practically also, so past information relating to the security may be available If not available, then we expect the future, we identify the possible returns, and we assign the probability. If return and the probability are given, then how can we find out the expected return or average return? How do we get expected return or average return? By doing a weighted average. So 50% chance that 0.5 means 50% chance that we may get 20% return, 10% chance that we may get 50% return, 10% chance that we may get 80, 10% chance that we may get 100, 20% chance that we may get 10%. Simple, we do a weighted average. We are getting 35%. We are getting what? 35%. But selection of a security is based on return and risk. So we have to consider two factors, return and risk. So we cannot select the security just based on a return. Okay, if that is the case, we all might have joined civil services, yes or no? If the selection is solely based on a return, but generally what selection is based on return and risk. So what is risk? What is risk? What is risk? Risk means what? What is risk? So risk means a possibility of occurrence of loss. Possibility of occurrence of a loss. For example, Pranav is getting married. So obviously our feeling is why he is taking a risk. Okay, here the point is, or else what? Tejasvi, she is getting married. We say why you are taking a risk. What is the meaning of this risk? Possibility of occurrence of loss. Possibility of occurrence of a loss or a failure. That is a possibility only. That is a possibility. So who is getting married? Navneeta? Pranav is getting married, right? So after getting married, he may get wife like Rashmika. Okay, he is so happy. Okay, he is so happy. That means what? Here risk does not mean mandatorily we are going to get a failure. Risk means what? Possibility of occurrence of a failure. Possibility of occurrence of a failure. Are you getting my point? So likewise, I am also happy after marriage. So recording lo undi కాబట్టి చెప్పాలి. So are you getting my point? So possibility of occurrence of a loss, only possibility. So possibility of occurrence of loss or possibility of failure is called as a risk. It is also called as uncertainty. So in this chapter, we mention the risk as possibility of deviation from the mean, average, possibility of deviation from the expectation, possibility of deviation from the expectation. Okay, so what do we expect from the security? From security we expect expected return, X bar. We expect X bar, expected return. Yes or no? Clear? We expect expected return, but there is a possibility of deviation from the expected return. So risk. How do we measure the risk of a security? Risk of a security can be measured using standard deviation, variance, or a coefficient of a variance. Risk of a security can be measured using variance, standard deviation, or coefficient of a variance. Variance measures total risk, standard deviation measures total risk, coefficient of a variance measures risk per unit of a expected return. Risk per unit of expected return. So higher variance, higher standard deviation, or higher coefficient of variance indicates high risk. Okay, if you calculate the standard deviation of risk-free security, you will get 0. The name itself indicates risk-free security. Risk-free security. So there is no uncertainty. There is no possibility of occurrence of a loss. Example, if you are investing in Government of India bond, if you are investing money in Government of India bond, there is no possibility of occurrence of a loss. There is no possibility of deviation from the expected return. If you calculate the variance or a standard deviation for risk-free security, you will get 0. Okay, clear? So these are the formulas for variance, standard deviation, coefficient of variance, so that you can easily understand. See this table. First see the table, understand the table, and then formula. So what is the meaning of risk? Risk means a possibility of deviation from the expected return. So see the columns, X bar, expected return, X minus X bar, X minus X bar is deviation from the expected return. Deviation from the expected return. So if you take the total of X minus X bar column, always you will get 0. For any example, for any number, for any data, you will get 0. If you take the total of X minus X bar. Why? Because there, you will get negative sign and positive sign. If you take the total, you will get 0. Okay. So that's why to avoid, eliminate the negative sign, we take square, X minus X bar square. If there is a probability, then what are the columns we should take? P, X, P into X, X bar, X minus X bar, P into X minus X bar whole square. So we cannot take P into X minus X bar in the last column. If you take the total of P into X minus X bar, you will get 0. For any data, you will get 0. If you take the total of P into X minus X bar. We should take P into deviation square, X minus X bar square, to avoid the negative sign. Okay. So that's why if you see the formula, variance is equal to, when past data is given, last column total. Last column total. That means summation sigma X minus X bar square divided by n. We have to do average. Okay. If a probability is given, then already we multiplied with weights. So that's why we should not divide with n. We should take only summation sigma P into X minus X bar square. Standard deviation is equal to square root of variance. Square root of a variance. Coefficient of variance is equal to standard deviation divided by X bar. Standard deviation divided by X bar. Okay. So let us solve one question. See this question. So this question is with probability. This question is with probability. Okay. Required, calculate the expected return and calculate the standard deviation of a return. Standard deviation of return. CA Saileja, I am going to discuss one question only. Okay. A stock costing rupees 120 pays no dividend. A stock costing rupees 120 pays no dividend. So stock costing rupees 120. This is P naught, price at the beginning. The possible prices that the stock might sell for at the end of the year with the respective probabilities are, price 115, 120, 125, 130, 135, 140. Total how many possibilities are given? 6 possibilities are given. Right now the cost of a stock, the price of a stock is 120. But at the end of the year, price may decrease to 115. Price may remain at 120 or may increase to 125 or 130 or 135 or 140. Probabilities are given. And they are asking you to find out what expected return and standard deviation of a return. Standard deviation of a return. Simple, basic question with probability. This question is a smart question, not for practice. So what are the columns we should take? Navneet? Hexa, okay. So what are the columns? Smart one. A. So we have to find out what expected return and standard deviation. So what are the columns? Harshita? X, P into X, X bar, X minus X bar. X is not given in the question. We have to find out the return. X, how do we find out the X? X is equal to P1 minus P naught plus D1 divided by P naught. So the stock is not paying any dividend. Okay, what is P naught? 120. P naught is equal to 120. So there can be 6 possibilities. There can be 6 possible returns. 6 possible returns. Yes or no, Navneet? 6 possible returns. What is the first possibility, Navneet? 115 minus 120 divided by 120. Price at the end of the year. Price at the end of the year can be 115. Okay. So P1 115 minus P naught 120 divided by 120. Minus 4.17. 120 minus 120 divided by 120. 0. Next 125 minus 120 divided by 120. 4.17. Next 130 minus 120 divided by 120. 8.33. 135 minus 120 divided by 120. 12.5. 140 minus 120 divided by 120. 16.67. Next. 6 possibilities, yes or no? So 6 probability. What is the probability? 0.1, 0.1, 0.2, 0.3, 0.2, 0.1. So P into X. Minus 0.417, 0, 0.834, 2.5, 2.5, okay, next, 2.5, 1.667, total, 7.083. This is the expected return. This is the expected return, 7.083. Clear? 7.083. Next. X minus X bar. X minus X bar. First case. Minus 11.553. Minus 11.253. Next. Minus 7.083. Next. Minus 2.913. Next. 1.247. 5.417. Next. 9.587. So can we take the total of X minus X bar? No. We have to do weighted average. Can we take P into X minus X bar? No. If we take the total of P into X minus X bar, we get 0. So that's why we should take P into X minus X bar square. Risk means a possibility of deviation from the expectation. Okay, clear? So P into X minus X bar square. First case? 12.67. Okay, now next. 5.016. Okay, very good. Next. 1.6697. Next. 0.467. 5.869. Next. 9.191. 34.902. 34.902. What is this 34.902? Variance. Sigma x square is equal to summation sigma P into X minus X bar whole square divided by N L also. Summation sigma P into X minus X bar square. Answer 34.902%. Sigma x is equal to square root of 34.902. 5.91%. So this expected return is 7.083. Expected return 7.083. So for the next year we expect on an average 7.083. Is it certain or uncertain? Uncertain. We may or may not get 7.083. There is a possibility of deviation from the expectation. Yes or no? So what is the standard deviation? 5.91%. On an average, there is a possibility of a deviation of 5.91% from the expectation. Clear? So why are we learning return and risk of a security? Because securities are selected based on return and risk. So we want high risk, so high return, low risk. So generally we select a security which is giving a higher return for low risk. If not, at least high return for same risk. Otherwise same return for low risk. Else high return for high risk. Clear? Okay. So in next session, we're going to learn return and risk of a portfolio. Okay. Thank you. So in yesterday's class, we discussed up to what return and risk of a security. So 4 decisions falls within the scope of a financial strategy: investing decision, financing decision, dividend decision, portfolio decision. So portfolio investment means investment in 2 or more securities. So security can be equity share, bond, or a money market instrument. Yes or no? Okay, done. So before investing, generally we consider two factors, that is return and risk. So that's why we have learned how to find out the return and risk of a security, and now we are moving on to learn how to find out the return and risk of a portfolio. Return and risk of a portfolio. Okay, done. So now, before moving on to the return and risk of a portfolio, so risk of a portfolio, what is the purpose of making portfolio investment? What is the main objective? Risk diversification. Risk diversification. Yes or no? Risk diversification, right? So diversification of a risk is the main objective. So first step is learning how to find out the return and risk of a security, and next what risk of a portfolio. So return of a portfolio is equal to nothing but weighted average of a security return. Weighted average of a security return. Okay, we do weighted average. But risk of a portfolio is not a weighted average of a security risk. We have to consider the co-movement of the securities. We should consider the correlation coefficient, closeness of securities, closeness of a security, how close the securities are moving. So that has to be considered. So that's why we cannot directly proceed to calculation of a risk of a portfolio. First we should learn the covariance concept, next correlation concept. Covariance of x comma y, it ranges from infinity to plus infinity. So why are we learning covariance of x comma y? Because risk of a portfolio depends upon a co-movement of securities, how the securities move, whether they move in same direction or opposite direction. So that will decide the risk of a portfolio. So that's why we should learn covariance of x comma y. It ranges from minus infinity to plus infinity. Your answer ranges from minus infinity to plus infinity. So covariance of x comma y, negative means what? Securities are moving in opposite direction. Positive means what? Securities are moving in same direction. It denotes co-movement between two variables. How can we find out the covariance of x comma y? So deviation of x into deviation of a y. Summation sigma x minus x bar into y minus y bar divided by n. So nothing but the columns we should take is x minus x bar, y minus y bar, x minus x bar into y minus y bar. Deviation of x, deviation of y. We are multiplying both. That decides the co-movement of a securities. So divide by n. And next what, if there is a probability, then covariance of x comma y is equal to summation sigma p into x minus x bar into y minus y bar. Okay. Likewise, covariance of x comma y, the another formula is with correlation coefficient, that is sigma x, sigma y, sigma xy. Sigma x, sigma y, sigma xy. So when beta is given, high chances of forgetting this formula. When beta is given, covariance of x comma y is equal to beta x, beta y, sigma m square. So we have not yet discussed about beta, so that's why I will discuss this beta concept again later on. So see the computation table. What are the columns for covariance of x comma y? When past data is given, covariance of x comma y, columns are x minus x bar, y minus y bar, x minus x bar into y minus y bar. So when the probability is given, then p x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. First case, the last column total divided by n will be covariance of x comma y. In second case, the last column total itself is a covariance of a x comma y. Be careful. Okay. And next, correlation coefficient. Correlation coefficient denotes closeness of two variables, closeness of securities. It ranges from minus 1 to plus 1. Minus 1 to plus 1. In portfolio management, this session is very important. So correlation coefficient ranges from minus 1 to plus 1. So how do we find out the correlation coefficient sigma xy? Covariance of x comma y divided by sigma x, sigma y. So you always get answer between minus 1 and plus 1. First, suppose if you are getting answer 2.5, that means you are gone. That is the wrong answer. Okay. So answer should, lie between what? Minus 1 and plus 1. So correlation coefficient sigma xy is equal to covariance of x comma y divided by sigma x, sigma y. So in the numerator, x minus x bar into y minus y bar. In denominator also same, x minus x bar into y minus y bar. It denotes closeness of securities. Done. So return of a portfolio. Return of a portfolio. How can we find out the return of a portfolio? Wx x bar plus wy y bar. Weight of x into x bar plus weight of y into y bar. Let's understand with example. How can we find out the portfolio return? First, suppose 50,000 invested in Tata and 50,000 invested in Reliance. What is the return of a Tata? 10%. Return of a Reliance? 20%. Return of a portfolio? Wx x bar plus wy y bar. 0.5 into 10 plus 0.5 into 20. So the answer is 15%. This is simple. Okay. What about the risk of a portfolio? It may be noted that risk of a portfolio is not weighted average of a risk of a individual securities. While finding out the risk of a portfolio, we cannot directly do the weighted average of a risk of a individual securities. Okay. Why? Because the main purpose of investing in portfolio is diversification of a risk.
So before finding out the risk of a portfolio, you have to consider co-movement of securities or closeness of a securities. Either you should consider covariance of x comma y or sigma xy to find out the risk of a portfolio. So that's why return of a portfolio is nothing but weighted average of security return. But risk of a portfolio is not weighted average of risk of a individual securities. Clear? So that's why sigma p is not equal to wx sigma x plus wy sigma x sigma y. Okay. So why? Because while calculating risk of a portfolio, we should consider co-movement of a security, that is covariance of x comma y, or correlation coefficient sigma xy. So correlation coefficient ranges from -1 to +1. So when correlation, first scenario 1, there can be 5 scenarios in correlation coefficient, 5 scenarios. First one, correlation coefficient is equal to -1. -1. First you should know what does it indicate. Correlation coefficient -1 means securities are moving in opposite direction and in same proportion. Okay. So when securities are moving in opposite direction and in same proportion then what is the formula for sigma p? We cannot do a weighted average because securities are moving in opposite direction. If I get profit in one security, I will lose money in another security. Or I can say like this, even if I lose money in one security, I will get profit in another security. So the possibility of occurrence of loss will get reduced. So that's why, what is the formula for sigma p? Wx sigma x minus wy sigma y. Nothing but it is a minus b. Wx sigma x minus what? Wy sigma y. Clear? And in this case, the weight can be reduced to 0. I mean risk of a portfolio can be reduced to 0. When sigma xy is equal to -1, then only we can reduce the risk of a portfolio to 0, because securities are moving in opposite direction and in same proportion. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. So since it is a revision class, I am not deriving the formula weight of x. So weight of x is equal to sigma y divided by sigma x plus sigma y. Okay. So this formula we apply and we find out the weight, and if you are using that weight, the risk of a portfolio will be equal to 0. So risk of a portfolio, we can reduce it to 0 only when sigma xy is equal to -1. Why? Because securities are moving in opposite direction and in same proportion. When correlation coefficient sigma xy is perfect positive means +1. If sigma xy is equal to +1, what does it mean? Same direction, same proportion. So securities are moving in same direction, same proportion. In that case, what happens? In that case, if I lose money in A, then I will be losing money in B also. So that means I will get loss in A and loss in B also, because securities are moving in same direction, same proportion. If I get profit in A, I will get profit in B also. Clear? Okay. So my point is, here the risk cannot be diversified. Why the risk cannot be diversified? Because both the securities are moving in same direction, same proportion. So that means we cannot diversify the risk. Yes or no? The risk will get diversified or what? The risk will not get diversified. So what happens? Risk will not get diversified. Risk will not increase, but at least what risk will remain same, because both the projects risk move in same direction and same proportion. So that's why sigma p is equal to what? Here you can do a weighted average of a security risk. You can directly do a weighted average of a security risk. So that means sigma p is equal to wx sigma x plus wy sigma y. So this formula you can apply. Only when sigma xy is equal to +1. That indicates securities are moving in same direction and in same proportion. Scenario 3. When correlation coefficient sigma xy is 0. Sigma xy 0 means what? There is no relation between securities. There is no relation between the securities. So when there is no relation between the securities, risk can be diversified. But risk cannot be reduced to 0. Okay. So no relation. For example, sigma xy of nothing but correlation between risky security and risk-free security. Risky security and risk-free security is equal to 0. What is this risk-free security? Example, Government of India bond is a risk-free security. So the correlation between a Government of India bond and Tata Motors Limited share is equal to 0. Even if Tata Motors Limited share price increases or decreases, the Government of India price will remain same. The return we get on a Government of India bond will remain same. Very good. So that means the relation between Tata Motors and Government of India bond is 0. Okay, clear? So risk can be diversified. By changing weights, we can reduce the risk. Okay, we can find out the optimum weight, minimum risk portfolio, optimum weight for minimum risk portfolio. Clear? So how can we find out sigma p here? Sigma p is equal to square root of a square plus b square, wx square sigma x square plus wy square sigma y square. So actually we have not yet discussed the main formula of a sigma p, standard deviation of a portfolio. Then you will understand this one easily. Scenario 3. What is the scenario 4 and 5? Correlation coefficient may range from -1 to 0 or 0 to 1. If it is -1 to 0, that means opposite direction, not same proportion. Risk can be diversified. 0 to 1, same direction but not in same proportion. If it is same proportion, we cannot diversify, but if it is not in same proportion, we can diversify the risk. So -1 to 0 can be diversified, 0 to 1 risk can be diversified. -1 to 0 opposite direction, not same proportion. 0 to 1 same direction, not same proportion. So then what is the formula we use? Sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. Okay, if you see this formula, okay, this formula can be derived, but I am not deriving in this class. Okay, if you see this formula is similar to a square plus b square plus 2ab. What is a square? Wx square sigma x square plus what is b square? Wy square sigma y square plus 2wx wy sigma x sigma y. Okay, if it is a square plus b square plus 2ab, you can write it as a plus b whole square. Square and square root will get cancelled and you will be left with a plus b. Nothing but what? Wx sigma x plus wy sigma y. So nothing but weighted average of a security risk. But if you observe the formula carefully, this is not actually a square plus b square plus 2ab. We have an extra one variable. What is that extra variable? Sigma xy. Sigma xy. If sigma xy is equal to plus 1, if sigma xy is equal to plus 1, then no doubt that is what a square plus b square plus 2ab. Yes or no? So then I can write a plus b whole square and square root will get cancelled and the formula will be wx sigma x plus wy sigma y. Yes or no? Done. Okay. If suppose sigma xy is equal to -1, so a square plus b square minus 2ab, then I can write it as a minus b whole square, square and square root will get cancelled, wx sigma x minus wy sigma y. Simple. For suppose sigma xy is equal to 0. If it is 0, then the 2ab part will be 0 and what is left? Square root of a square plus b square. So that is what we have written above. Yes or no? Okay. So the formula has become lengthy because of the sigma xy. So that is what we discussed earlier. So for finding out the risk of a portfolio, we have to consider correlation coefficient and co-movement of a securities. Closeness of securities. We should consider what? Closeness of securities. Closeness. So that's why what? Okay, the formula has become lengthy. For suppose if sigma xy is equal to 1, again formula will become short. That means securities move in same direction, same proportion. So then you can do a weighted average of what? Security risk directly. Wx sigma x plus wy sigma y. Done. Clear? So what is the formula for sigma xy? Sigma xy is equal to covariance of x comma y divided by sigma x sigma y. That means nothing but covariance of x comma y is equal to sigma x sigma y sigma xy. So that means what is the other formula that we can use? Instead of sigma x sigma y sigma xy, we can use what? Covariance of x comma y. Clear? So sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy covariance of x comma y. When there are three securities, if there are three securities, then the formula will become even more lengthy. Why? If there are two securities, then formula will be similar to A plus B whole square. But if there are 3 securities, then formula will be similar to A plus B plus C whole square. Nothing but A square plus B square plus C square minus 2AB. Okay, sorry, plus 2AB plus 2BC plus 2AC. 2CA, yeah, very good. 2CA. Done? Clear? So are you able to understand how many scenarios? 5 scenarios. Okay, in these 5 scenarios, understand properly. If sigma xy is equal to plus 1, risk cannot be diversified. Risk cannot be diversified. Diversify nahi kar sakte. Okay, so diversify, risk diversify panna mudiyadu. Okay, so risk diversify cheyadam avvadu. Clear? In which case? When sigma xy is equal to plus 1. But when sigma xy is equal to minus 1, risk can be diversified. Risk can be reduced to 0. हम 0 तक reduce कर सकते risk को. Already हम बोल दिया. Okay. और risk हम क्या reduce कर सकते up to 0. Clear? Done. 0 वరకు reduce చేయొచ్చు మనం. So there are other 3 scenarios. What are the other 3 scenarios? Risk correlation coefficient 0, correlation coefficient minus 1 to 0, or 0 to 1. Clear? Scenario 3, 4, 5. In scenario 3, 4, 5. In that case, we cannot reduce the risk to 0, but we can minimize the risk. We can minimize the risk, but we cannot reduce the risk to 0. For that, for construction of minimum risk portfolio, weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. High chances of forgetting this formula. Okay, especially in examination, you might getting a doubt in numerator whether it is sigma x square or a sigma y square. Okay, maybe weight of x is equal to, weight of x means in numerator that should be sigma x square. Okay, that kind of doubt, confusion might get created. So it is what weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So what is why this formula we are using? What is the purpose? This is to find out the optimum weight of security x to minimize the risk for construction of a minimum risk. That is the lowest point, that is the lowest risk which we can achieve. Okay, so instead of investing money in 2 securities at a random proportions or a random weights, find out what optimum weight by using this formula. Clear? Are you able to understand 5 scenarios? Sigma xy plus 1, risk cannot be diversified. Panna mudiyadu. Okay, when it is plus 1, risk can be reduced to 0. Okay, next minus 1. Minus 1 means what? Yeah, 0, minus 1 to 0, 1 to 0. In that case, what? Risk can be diversified, okay, but cannot be reduced to 0. For that weight of x, we should use this formula. Done? Clear? Standard deviation of a portfolio consisting of risky security and risk-free security. For suppose in a portfolio we have a risky security and risk-free security. Risk-free. Okay. So risk-free security. So risk-free security. What is the standard deviation of risk-free security? Imagine X column. Every year you will get same return. In X column you will be taking 8, 8, 8, 8, 8. What about X bar? 8, 8, 8, 8, 8. X minus X bar. 8, 8, 8, 8, 8. No, 0. Very good, Amar. X minus X bar is equal to 0. Okay. So what about X minus X bar whole square? 0. So that means standard deviation of risk-free security is equal to 0. Simple. Visualize one example. X 8, 8, 8. X bar 8, 8. X minus X bar 0, 0, 0. Okay, fine. So standard deviation of risk-free security is equal to 0. Done. So that means sigma y 0. Sigma y 0 means what happens? Wy square sigma y square will be 0. 2ab part will also be equal to 0. Then what is left? Square root of wx square sigma x square. Square and square root will get cancelled. And what is left? Wx sigma x. Wx sigma x. Yes or no? Clear? Okay. So what are the steps to find out sigma p? That is important. Examination point of view. Okay. So how to find out sigma p? Standard deviation of a portfolio. So understand the concept. For finding out standard deviation of portfolio, you need weight of x, weight of y. Generally, weight of x and weight of y will be given in question itself. Very good, Amma. Okay. What about sigma x and sigma y? We have to find out sigma x, sigma y. For finding out sigma x, sigma y, you want x and x bar, and y, y bar. Yes or no? What about then a square plus b square? Okay, fine. What about 2ab part? In 2ab part, we require sigma xy. Correlation coefficient. How can we find out sigma xy? Sometimes in some questions they will give sigma xy. Then you would directly substitute the formula. But in majority cases they will not give. Then how can you find out? Sigma xy is equal to covariance of x comma y divided by sigma x sigma y. So sigma xy करना है तो पहले क्या करना होगा? पहले हम covariance of x comma y उसको calculate करना होगा. Yes or no? So covariance of x comma y. How can we calculate covariance of x comma y? What are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. If it is a past data. If it is a future data, possible data, then x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. तो यहाँ पे सिग्मा p कैलकुलेट करने के लिए हमको क्या चाहिए? सिग्मा x चाहिए, सिग्मा y चाहिए और क्या? सिग्मा xy चाहिए. लेकिन सिग्मा xy कैलकुलेट करने के लिए कोवेरियंस ऑफ x कमा y भी चाहिए. అర్థమవుతుందా? సిగ్మా p క్యాలిక్యులేట్ చేయాలంటే మనకి ఏం కావాలి? సిగ్మా x కావాలి, సిగ్మా y కావాలి, సిగ్మా xy కావాలి. సిగ్మా xy క్యాలిక్యులేట్ చేయాలంటే కోవేరియన్స్ ఆఫ్ x కామా y కావాలి. సో దట్స్ సీ ద స్టెప్స్. ఫస్ట్ స్టెప్ ఓకే, x క్యాలిక్యులేట్ పన్ను. ఓకే, అப்புறம் నాట్ అమర్. అపురం means next. Apuram means in Tamil next. So that's what I am saying. X Tamil தெரியாதா? ஒன்றுமே தெரியாதா? ஓகே, எனக்கு தெரியாது. थोड़ा I mean not थोड़ा, கொஞ்சம் தெரியும். ओके, हिंदी भी थोड़ा आता है बस. x बार, y बार, and next what? सिग्मा x सिग्मा y. उसके बाद ऑलरेडी बोल दिया हम covariance of x comma y, and next what? Sigma xy, and then sigma p. Clear? Done? So with this energy let us start questions. हम क्वेश्चन स्टार्ट करते हैं. ठीक है, देखो स्मार्ट टू मतलब this question is for practice or refer? This question is just for referral. You have to refer this question. Okay, the historical rates of return of a two securities over the past 10 years are given. Wow, two securities and past 10 years data. Very good. Calculate the covariance and correlation coefficient of the two securities. Covariance and correlation coefficient. This is a CA final past examination question. You might be thinking this question will not be asked in examination, but already this question was asked. Then why I have categorized it as a smart question? Tell me, Amar. Yeah, this is a basic question. So that's why what I have categorized it as a smart question. Even if you are not practicing this question, you will be able to do it in examination. Okay. So what is the there are two criteria for categorizing the question into a smart. What are the two criteria? First one, it might be a basic question. Second, this question is similar to super question with minor one additional point, some different point. Okay. Anyway, you have already practiced one similar kind of a question. So that's why what this question you need not practice. Okay. So this question is a smart 2 question because it is a basic question. Okay. What they are asking you to find out the covariance and correlation coefficient. So tell me, what is correlation coefficient formula? Correlation coefficient is equal to covariance of x comma y divided by sigma x sigma y. So क्या चाहिए हमको? Sigma x sigma y, covariance of x comma y. Yes or no? First part of the question is what they are asking you to find out covariance of x comma y. So nothing but sigma x not given in the question. We have to find out sigma x, and next what? Sigma y, and then covariance of x comma y. Find out covariance of x comma y, because for covariance of x comma y you require x minus x bar and y minus y bar. So while finding out sigma x, anyway you will find out what? X minus x bar, and sigma y you will find what? Y minus y bar. That you can use for covariance of x comma y. Okay. So whether it is past data or a future data? Past data. Now my point is simple. Imagine the steps. Practicing AFM means not taking the calculator and writing the numbers. Before even starting the answer, you have to imagine, visualize the steps. So what is the first step? Sigma x. Second step, sigma y. Third step, covariance of x comma y. So tell me what are the columns for sigma x? Tell me what are the columns for sigma x? Sigma x, past data. X, already given in the question. Next, x bar. We do simple average. Next, x minus x bar. Next, x minus x bar whole square. What, man? X bar, x minus x bar, x minus x bar whole square. Next to sigma y. What are the columns? Y, y bar, y minus y bar, y minus y bar whole square. Next to covariance of x comma y. Okay, what are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. Then sigma xy is equal to covariance of x comma y divided by sigma x, sigma y. That's it. Clear? Done. So you visualized the columns. Check with answer. If your visualization matches with reality, then go to next question. But for the first time, suppose if this is the first time you're watching this class, you learn the concept and you want to practice this question, pause the video and try to solve this question within 10 minutes. Within 10 minutes. Pause the video. Okay, I hope you calculated you got the answer right? Okay, done. Let us move on to the next question. Smart 3. Smart 3 means again it is what? Basic question. You need not practice. You have to refer. So second part, I'm just telling you the answers. Covariance of A comma B, you should get minus 0.8. Okay. And correlation coefficient 0.06071. Almost close to 0. Almost close to 0 means there is no relation between x and y. So that you can observe in the question also. If you see the question, security 1, 12 and then what? 8. What about security 2? 20, 22. That means moving in opposite direction. 8, 7, 22, 24, 7, 14, 24, 18, 14, 16, 18, 15, 16, 15, 15, 20. Okay. Up to 6th year, they are moving in opposite direction. That means we should get negative. Okay. And next, again, after 6th year, 15, 18, 20, 24. Moving in same direction. 7, 8, 18, 20, 24, 25. Next, 20, 16, 25, 22. Clear? Up to 9th year again, same direction. Okay. And again 9 to 10th year, opposite direction. So there is no a relation. Okay. So that's why the answer was close to 0, minus 0.06 something. Clear? Done. Okay. Let us move on to the third question. Mr. A is interested to invest rupees 1 lakh in the securities market. He selected two securities B and D for this purpose. The risk return profile of these securities are as follows. Security B, D, risk 10%, 18%, expected return 12%, 20%. Coefficient of a correlation 0.15. You are required to calculate portfolio return of the portfolio of B and D to be considered by A for his investment. So this fellow, he is considering 4. First one, 100% investment in B only, putting entire money in B only. If he is putting entire money in B only, then we need not calculate portfolio return separately. What is the return of a security B? 20%. So return of a portfolio is equal to 20. 12, sorry, 12. Next 50% investment in B only. 50% investment in B only. Sorry, in B and the rest 50% in D. So investment 50 in B and 50 in D. Then what? 50% in B, 50% in D. Then we do weighted average to find out the portfolio return. 0.5 into 12 plus 0.5 into 20. So nothing but 16. Next 75% in B and 25% in D. 75% in B means what? 0.75 into 12 plus 0.25 into 20. So 9 plus 5, I think 14. Clear? Next 100% investment in D only. If you are investing 100% in D only, then you will get 20%. Okay. Also indicate that which portfolio is best from risk as well as return point of view. They are asking return as well as risk. First and fourth, risk of a portfolio we can directly say first case 10%, fourth case 18%. So second and third case we have to apply lengthy formula, that is sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. So entire information is given in the question, just to substitute the values in the formula. Clear? Done? So second and third. Are you getting my point? So 100% investment in B only, return 12%, risk 10%. 50% investment in B, 50% in D. What is the return? 16%. What about the risk? 10.93. 10.93. Clear? What about 75% investment in B and 25% in D? What is the risk? 9.31. The risk is getting diversified because 9.31 is less than 10 and 18. 10 is the risk of B and 18 is risk of a D. So 9.31 means it is less than what? Both B and D. The risk is getting diversified. If you are investing 100%, then return 20% and risk 18%. So from return point of view, which is the best one? From return point of view, fourth case. From risk point of view, third is the best option. Third is the best option. Okay. So when you compare the first and third, if you are investing 100% in A, B, 100% in B, you are getting a return just 12% and risk 10%. But in third case, if you see the third case, you are making a portfolio investment. You are investing 75% in B and 25% in D. Just you are adding 25%. Instead of investing 100 in B, you are just diversifying your 25% investment in D also. What is happening? The return increased to 14% and risk reduced to 9.31. So that's the beauty of portfolio. What do you say, Amar? What is the purpose of making portfolio investment? Diversification of our risk. Am I clear? Are you able to understand? Clear? Now let us move on to the next question. Smart 4. Smart 4 again, it is what? Not for practice. Consider the following information on two stocks A and B, year 2016, so 6 and 7, return on A, return on a B. Return on A is given, return on a B is given. Nothing but X, Y are given. Only 2 years data. In second question, 10 years data is given. Here only 2 years data. You are required to determine the expected return on a portfolio containing A and B in the proportion 40-60. Expected return on a portfolio. So to find out expected return on a portfolio, first we should find out A bar and B bar. Yes or no? So what is A bar? First case, 10 plus 16 divided by 2, 13. 12 plus 18 divided by 2, 15. 13, 15. So now do the weighted average. 0.4 into 13 plus 0.6 into 15. Answer 14.2. Clear? Done? समझ गया ना? पुरिंजिदा? अर्थమైందా? Okay. The standard deviation of a return from each of the two stocks. Standard deviation. Standard deviation हम कर सकते हैं ना? It is past data, right? What are the columns we should take? पहले x, उसके बाद x बार, उसके बाद x minus x बार, उसके बाद x minus x बार whole square. x कॉलम में क्या लेना होगा? 10, 16, x बार 13, 13, x minus x bar minus 13 plus 13, sorry, minus 3 plus 3, x minus x bar whole square 9, 9, total 18, 18 divided by 2, you will get variance 9, standard deviation square root of 9, 3, हमको standard deviation 3% आएगा. Clear है? So security B same, security B also same, 15 आएगा, right? x bar, sorry, y bar 15, फिर y minus y bar minus 3 plus 3. Clear है? 9, 9, 18 divided by 2, 9 square root 3%. आप यहाँ पे एक ऑब्जर्व किया क्या पॉइंट? 2 years data is given, that's okay, fine. Both the securities are moving in same direction. Same direction. Okay. So, and also what? Same proportion. 10, 16, 12, 18. What is the difference? 6. Okay. So next हम covariance calculate कर सकते हैं. Covariance x minus x bar into y minus y bar. समझ गए ना? Covariance of x minus x bar minus 3 minus 3 3 3 9 9 total 18 divided by 2, 9% is the covariance. Next correlation coefficient, 9 divided by 3 into 3, 1. Sigma x by 1 means what? Securities are moving in same direction and in same proportion. Clear? Done? Okay. Next, portfolio risk. Portfolio risk, we need not use this lengthy formula. We can directly what? Do a weighted average. So Wx sigma x plus Wy sigma y. So 3%. Done. Return of a portfolio, again weighted average, Wx x bar plus Wy y bar. समझ गया? So is there a special point in this question? No, there is no special point in this question. So that's why I want you to just refer this question. Next question, super one. Super one means what? You have to practice this question. You have to practice this question. Clear? You have to practice this question. Done. This question is with probability. This question is with probability. So after my explanation, so you can do, you have two options. First option, even without listening to my explanation, you already know the concept. Pause the video and start solving this question. Try to solve this question within 10 to 12 minutes. Okay. For suppose, second option, listen to my explanation, pause the video and solve this question, practice this question. So there is no other option. Okay. So do not go through the solution given in the question bank. To listen to my explanation, pause the video and solve. Okay. Super one. An investor has decided to invest 1 lakh in the shares of 2 companies. Very good. Okay. This fellow wanted to invest 1 lakh in shares of 2 companies, namely ABC, XYZ. The projections of returns from the shares of the 2 companies along with their probabilities are as follows. Along with the probability, possible returns are given 0.2, 0.25, 0.25, 0.3. ABC 12, 14, minus 7, 28. XYZ 16, 10, 28, minus 2. So what did you observe in this? Securities moving in same direction or opposite direction? Security returns, security possible returns with probability are given. My point is securities moving in same or opposite? Opposite. First increasing, second decreasing, and later on second decreasing. So that 12 to 14, 16 to 10, 14 to minus 7, 10 to 18, minus 7 to 28, 28 to minus 2. So that means securities are moving in opposite direction. You are required to comment on return and risk of investment in individual shares. So we have to comment on return and risk of investment in individual shares. Compare the return and risk of these 2 shares with portfolio of these shares in equal proportions. Compare the risk and return of these 2 shares with a portfolio of these shares in equal proportions. In equal proportions, 50, 50. So nothing but first we should find out the return and risk of shares, and next what? Return and risk of a portfolio. Okay, they are asking you to compare return and risk of securities with portfolio. Second question, compare the risk and return of these 2 shares with a portfolio of these shares in equal proportions. Understand the question. Last part, find out the proportion of each of the above shares to formulate a minimum risk portfolio. To formulate a minimum risk portfolio, so we have to find out the proportions of each shares. So there are 2 formulas to find out the optimum weights. Weight of x. If you can find out the weight of x, then obviously you can find out what weight of y. 1 minus weight of x is equal to weight of a y, right? So for construction of minimum risk portfolio, we can use 2 formulas. Which formula we have to use depends upon what? Sigma xy. For suppose if sigma xy is equal to plus 1, then risk cannot be diversified. Whether you change weights or not, the risk will not get diversified. But if sigma xy is equal to minus 1, the risk can be reduced to 0. In that case, weight of x is equal to sigma y divided by sigma x plus sigma y. That we can use. Am I correct? What about next one? In other 3 cases, for finding out weight of x, what is the formula we have to apply? High chances of forgetting the formula. For construction of minimum risk portfolio, weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Clear? Okay. First, to find out the return and risk of investment in individual shares. Return and risk. So first I have to find out the risk of ABC. Probability is given in the question, right? So tell me, guess the columns. Before starting, guess the columns. Write down the columns on the notes, rough notes. Okay? To find out the risk of a portfolio. So tell me, what is the first step? What are the columns we should take? Probability P. X 12, 14, minus 7, 28. Next P into X. That P into X total will be what? X bar. Weighted average of a security return. X bar. Next column X bar. Next X minus X bar. Last column P into X minus X bar whole square. So change your preparation method. Okay, so some majority of the students will note down the columns from the question bank and will solve the question. So that is a calculator practice. You are not testing your concepts. Okay, so first clear. And again, what for sigma y also same columns. Instead of x you take y, right? Clear. First part completed. So we answered return of a security and risk of a security. Next, what we have to find out the return and risk of a portfolio. Return of a portfolio is simple. Wx x bar plus Wy y bar. What about the risk of a portfolio? To find out the risk of a portfolio, we already have a sigma x and sigma y calculated in first part. What else we need? We need covariance of a x comma y. We cannot directly find out sigma p. We have to find out what covariance of a x comma y. What are the columns for covariance of x comma y? X minus x bar, y minus y bar, x minus x bar into y minus y bar into probability. High chances of forgetting the probability. Even I forget. That's why I told last. X minus x bar, y minus y bar, p into x minus x bar into y minus y bar. So find out covariance of x comma y. And next what? Sigma xy. How do we get sigma xy? Covariance of x comma y divided by sigma x sigma y. Clear? Done. What about next? I can find out sigma p. I can find out what? Sigma p. Simple. Done. So first step is what? Sigma x. Second step sigma y. First part completed. For second question, what should I calculate? Covariance of x comma y. Again table. Covariance of x comma y. And then what? Sigma xy. Sigma xy. And then what? Sigma p. I can find out sigma p and p bar. I compare what? X bar, y bar and p bar. And also what? Sigma x, sigma y and sigma p. Because they asked you to compare in second part. What is the last part? Find out the proportion of each share to formulate a minimum risk portfolio. For suppose if sigma xy is equal to minus 1. If I get sigma xy minus 1, then what? Risk can be reduced to 0. Then I will apply weight of x is equal to sigma y divided by sigma x plus sigma y formula. Yes or no? But if it is other than minus 1, in this question you will get sigma xy other than minus 1. In that case, risk cannot be reduced to 0. Risk can be minimized. Further, weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Samajh gaya na? Okay. So if you understood this question, pause the video and solve this question within 10 to 12 minutes. Here in CA exams, CA final examinations, understanding the question itself is not enough. You have to solve the question within the time frame. That is important. So most of the time students will be going through the question and they will understand the answer and they will be feeling like, yes, I got the answer. And they will move on to the next. They keep on adding the questions. They keep on adding the question. You have to do a quality questions instead of quantity. Focus on quality. So that's what I'm doing. I'm segregating the questions into smart and super. Super questions are quality questions. If you solve, if you focus, if you give time to this super question, that is enough. Clear? So all repetitive questions are eliminated and questions are arranged in a sequential order, concept wise, and you can easily solve these questions. Clear? So many of the students might be expecting me, sir, tell me what is A category, B category and C category. In my perspective, in AFM, there is no A category topic, B or a C category. All chapters are A category, but one point I wanted to say is, you have to eliminate the repetitive questions in all the chapters. For example, in mergers and acquisition, if you eliminate all the repetitive questions, hardly you will get 15 super questions. 15. That means if you practice 15 questions, that is enough. In mutual funds, you will get 10 to 12 questions. 10 to 12. If you practice those 10 questions, that is enough. In portfolio also, you will get 15 to 16 questions for practice. Okay, clearer? So nothing but I'm also saying that focus on what? Okay, I'm not saying that take choice. I'm not saying you to take choice one chapter. Do not take choice. You take choice in repetitive questions. You eliminate all. I mean, I have already eliminated the repetitive questions and I have prepared this question bank. So now my point is you blindly rely on this question bank, and if it is smart, prefer. If it is super, practice. That's it. Clear? Done. And do not add any other questions. Do not add. Do not add. Do not add extra luggage. Okay. Please rely only on these questions. Okay. Even if AFM paper, so is tough. In worst case scenario also, you can score easily 50 plus marks with this material. And what is the source of preparing this material? What is the source? Nothing but ICAI study material, CA study material and CA past questions. That's it. Clear? So pause the video and solve this question. Meet you in next session. Thank you. So let us move on to the next concept. What is the next concept? Rule of a dominance. Rule of a dominance. So what is the first step for calculating a risk of a portfolio? Risk of a portfolio. What is the first step? X bar, Y bar, sigma X, sigma Y. Covariance of a X comma Y, sigma XY. Next is sigma P. Yes or no? Is it clear? So there are how many scenarios with respect to correlation coefficient? There can be 5 scenarios. Sigma XY can be -1, +1, 0, -1 to 0, 0 to 1. Clear? So question number 5, I asked you to try the question. Question number 5. Nothing but a super 1. Super 1 you tried or not? Super 1. So this is the answer. Please check with the answer. Okay. Done. Next, let us move on to the next question. Super 2. Super 2 means this is the second question to be practiced in portfolio management. X company limited invested on 1/4/2009 in certain equity shares as below. Name of a company, number of a shares and cost. In September 2009, 10% dividend was paid out by M Limited, and in October 2009, 30% dividend was paid out by N Limited. On 31st March 2010, market quotations showed a value of rupees 220 and 290 per share for M Limited and N Limited respectively. On 1/4/2010, investment advisors indicate that the dividend from M Limited and N Limited for the year ending 31st March 2011 are likely to be 20% and 35% respectively, and that the probabilities of market quotations as 31st March 2011 are as below. The probability factor 0.2, 0.5, 0.3. Price per share 220, 250, 280. 290 price per share of N Limited 290, 310 and 330. You are required to calculate the average return from the portfolio for the year ended 31st March 2010. So they are asking you to find out the average return from the portfolio for the year ended 31st March 2010. Calculate the expected average return from the portfolio for the year 2010-11. And advise X company limited of the comparative risk. Advise X company limited of the comparative risk in the two investments by calculating standard deviation in each case. So third part, they are asking you to find out the standard deviation in each case. So this question is a special question. It is a past examination question. Past examination question. Okay. So high chances you will get stuck with this question. Even if you are able to do first part and second part, you will get stuck in third part. Okay. So for suppose if I give the same question in next weekend exam or the first grant test of AFM, okay, even if this question appears in main examination, so high chances of doing a mistake, and also what you will get stuck with the third part. So be careful. So first one, calculate the average return from the portfolio for the year ended 31st March 2010. So 31st March 2010 means we should consider information up to this one, first paragraph. Okay, first paragraph, that is respectively, because on 1/4/2010, that means information is starting from 1/4/2010. So that is not relevant for first part. So the information which is relevant for first part is, what is the information relevant for first part? Okay, up to respectively. See the information. They are asking you to find out the average return of a portfolio. X company limited invested on 1/4/2009 in certain equity shares as below. M Limited, N Limited. Number of shares 1500. Cost 2 lakhs and 1 lakh 50. In September 2009, 10% dividend was paid out by M Limited. What is the dividend paid? 10% dividend was paid out by M Limited, and in October 2009, 30% dividend was paid out by N Limited. On 31st March 2010, the market quotations showed a value of 220 and 290 per share for M Limited and N Limited respectively. So how do we get average return of a portfolio? By doing a weighted average of a security return. Here security return percentage is not directly given. So we have to find out the security return for the year ended 31st March 2010. Am I clear? So how do we calculate security return if it is not given in the question? Simple. P1 minus P0 plus D1 divided by P0. So for M Limited, what is P1? Price at the end? 220. 220 is the price at the end. What is the price at the beginning? The cost of investment is 2 lakhs. How many shares are there? 1000. So 2 lakhs divided by 1000. So what is the P0? Price at the beginning? 200 rupees is the price at the beginning. Am I clear? Price at the beginning 200. Are you getting my point? So what is the price at the end? 220. So dividend. 10% dividends was paid out by M Limited in September 2009. 10% dividend. So this 10% is applied on what? Face value. What is the face value? 100. So that means 10 rupees. So D1 is equal to 10 rupees, and expected return of a security M is equal to 220 minus 200 plus 10 divided by 200. So the answer is 15%. Okay, clear? So this is return of a M Limited. Return of a M Limited. Am I clear? Done? Okay, fine. Now let us move on to the N Limited. So first chances of doing a mistake is while calculating a return of a N Limited. Why, sir? Because what is the N Limited price at the end? 290. What is the price at the beginning? 1,50,000 divided by 500. 300. So what is the percentage dividend declared? 30% dividend paid out by N Limited. 30% dividend means, okay, students might take 30 rupees here, because subconscious mind will say you take face value to 100. Why? Because M Limited face value is 100. So we by default take 100 for N Limited also. But here N Limited face value is what? 10 rupees. So that means what is the price? 3 rupees. Are you getting my point? So what is the return? 290 minus 300 plus 3 divided by what? 300. So the answer is minus 2.33%. Minus 2.33%. Clear? Now, so let us find out what portfolio return. How do we get portfolio return? By doing a weighted average. So weights are not directly given, but investment amount is given. Okay, so 2 lakhs divided by 3,50,000 into 15 plus 1,50,000 divided by 3,50,000 into minus 2.33. So the answer is 7.57. Raju, is the screen clear? Done? Next, let us come to the second part. What is the second part of the question? Calculate the expected average return from the portfolio for the year 2010-11. For the year 2010-11, so they are asking you to find out the expected average return. Okay. So for 2010-11, that means information is relevant from 1/4/2010. 1/4/2010. Okay. So in 2010-11, in the year 2010-11, the dividends from M Limited and N Limited for the year ending 31st March 2011 are likely to be 20% and 35% respectively. Now the dividend percentages are changing, right? And next, the probabilities of market quotations on 31st March 2011, the prices at the end are not directly given. Prices at the end of 31st March 2011 are given with probabilities. In first part of the question, directly given, prices are directly given, but in second part, what? Okay, the probabilities are given. Okay, there are three possibilities. So probability factor 0.2, 0.5, 0.3, price per share of M Limited, price per share of N Limited. So now the calculation style will change, yes or no? So how can I find out P0, expected price at the end? By doing a weighted average. So what is the expected price at the end? 0.2 into 220 plus 0.5 into 250 plus 0.3 into 280. Clear? You will get 253. 253 expected price at the end. So what is expected price at the beginning? We should take price at the beginning means price at the beginning of 1/4/2010. That means nothing but last year. Last year P1. What is the last year P1? 220. Okay. What is the dividend rate? 100 into 20%, 20 rupees. And return is equal to 253 minus 220 plus 20 divided by 220. So 24.09 percentage. 24.09 percentage. Am I clear? Done. Clear? Next, return of a unlimited for the year ended 31st March 2011. Return of unlimited. Price at the beginning 290. Price at the end. How do we get price at the end? By doing weighted average. 290 into 0.2, 310 into 0.5 plus 330 into 0.3. Okay, so 312. 312. So dividend for the year D1 10 rupees into face value 35%, 3.5. Be careful, okay? So 312 minus 290 plus 3.5 divided by 290, 8.79% is the return of a unlimited. Return of what? Unlimited. Okay? But they are asking you to find out what expected return on a portfolio. How do we get expected return on a portfolio? By doing a weighted average of a security returns. Here there is a high chance of doing a clerical mistake. Be careful. Why? The investments at the beginning are 2 lakhs and 1 lakh 50. The total investment is equal to 3 lakh 50. That is for the first year. But for the next year, the investment value at the beginning is changing, right? So if investment value changes, automatically proportions will also change. So this is the red alert part. High chances of doing a clerical mistake. For suppose if I give the same question in test series, here you will commit a mistake. You will take a weights, previous weight, original weights, that is 2 lakhs divided by 3 lakh 50, 1 lakh 50 divided by 3 lakh 50. So be careful. But for the 2010-11, the weights are changing, right? 1000 into 220 plus 500 into 290. So the overall 3 lakh 65,000 is the investment. Okay. So what is the weighted average return? 2 lakh 20 divided by 3 lakh 65 into 24.09 plus 1 lakh 45 divided by 3 lakh 65 into 8.79. So the answer is 18.02. After listening to my explanation, pause the video and solve this question. So this is a super 2 question. If you want more clarity with respect to portfolio management concepts, whenever I say super question, okay? So 2 options I gave. Either before listening to the explanation, you solve it on your own if you are confident. Some students might feel like, sir, I am already an expert in AFM. I don't need classes for AFM. Okay, so that kind of attitude will be there. So then you pause the video and before listening to my explanation, you solve the super question. If you are able to do, that means you are right. You do not require any class. But if you are facing difficulty and if you are not able to solve, that means what? You need my explanation. Listen to my explanation, then pause the video and practice. Okay, otherwise you may not cope up with the explanation. Clear? So do not listen to the class in 2x speed. Clear? 18.02% is the answer. Second part. See the third part. What is the third part? Advise X company limited of the comparative risk in the 2 investments by calculating the standard deviation in each case. So we have to find out the standard deviation in each case. Here 2 informations are given. One is 2009 to 10 information and second is what? 2010-11 information with probability. So with the probability is given and the past data is also given. Which information we should use for finding out the standard deviation? Simple. So past information is given and the possible future data is given. Then we should use what? Possible future data. Possible future data. So that's why what is the information relevant? The information with probability to find out the standard deviation. We have to find out the standard deviation of 2 securities. Okay, using this probability data. So when there is probability, what are the columns for standard deviation calculation? P, X, P into X, X bar, X minus X bar, P into X minus X bar whole square. Okay. So that is what I am doing. P. What about X? X is not given in the question. So there are 3 possibilities for X. First possibility. What can be the price at the end of the year? 220 minus price at the beginning 220 plus dividend 20 divided by what? 20. Are you getting my point? So this is the first possibility. This is the first possibility. Are you able to understand? What is the second possibility? The price at the end of the year can be 250 minus 220 plus 20 divided by 220. Third, 280 minus 220 plus 20 divided by 220. So 36.36. Are you getting my point? Similar kind of a calculation we have done in question number 1. P1 minus P0 divided by P0. Okay. For 3 possibilities we calculated a return. So next year for 2011 we may get 9.09 return, 22.72 or 36.36. Probability is also given. How do we get M bar? By doing a weighted average. So P into M. What is the total of P into M? 24.1%. So this is what we got in second also. In second part we got 24.09. Here 24.1. Why we are not using the information 24.1 which was calculated in second part? Because we need M also. We need M to find out the risk. Okay, so that's why. What is the next column? M minus M bar. Next P into M minus M bar whole square. So summation sigma P, not P into summation sigma, summation P into M minus M bar whole square, 91.09%. Standard deviation is equal to 9.54%. Clear? Done. So likewise we should find out for what? N limited. So for N limited what is the answer? 4.83%. So again this third part is the special part. You should go through this. I mean you should practice this question. Okay? Clear? With this we have completed what? Return and risk of a security and return and risk of a portfolio. So now we are moving on to the second part of the portfolio management. So from questions point of view, we have completed only what? Around 6 questions. Both smart plus super, we have completed only 6 questions. But concept point of view, we have completed half of the portfolio management. So okay, now the remaining half, it will not take much time. Clear? Done. Go through the solution for next 2 minutes. See the next concept. Rule of a dominance. So this is the Markovitch theory, whatever the concepts we have learned. So this is a modern portfolio theory. Okay, modern portfolio theory of a Markovitch. Okay, sometimes they will ask you to find out the return of a portfolio and risk of a portfolio using modern portfolio theory, Markovitch model. So Markovitch model is nothing but what? Sigma P is equal to square root of Wx square sigma x square plus Wy square sigma y square and so on. Okay. So we have another model to find out the risk of a portfolio, that is Sharpe index model. So that Sharpe index model I am going to discuss at the end of this chapter. Okay. Clear? So now let us move on to the Markovitch rule of a dominance. One security is said to be dominating the other security. One security is said to be dominating the other security if it is giving, first point, high return for same risk. For suppose there are 2 securities. One security is giving high return for the same risk as the second security. Then we say first security is dominating what? Second security, because it is giving higher return for same risk. So one security is said to be dominating the other security if it is giving high return for same risk. Same return for lower risk. Both the securities are giving same return, but whereas first security is having a low risk when compared to the second security. High return for low risk. First security is giving a higher return, but whereas the risk is lower than the second security. Next, high return for higher risk. If the security is giving a high return and also what for high risk, then also we say it is dominating the second security. Actually, we have a concept of efficient frontier. So nothing but we do a plotting on a graph. On x-axis we take risk, y-axis we take return. Okay, and what we plot, we do plotting, and we draw a curve. Okay, in that curve, when the curve takes the right turn, that upper part is called as a efficient frontier, and the securities which are lying on that upper part will be selected. Okay, but that graph plotting efficient frontier, that concept is not required to understand this. This is a simple common sense. So we need not do a plotting and all. Example, see the scenario 1. Scenario 1, Tata Limited and Reliance Limited. Okay, risk is same, right? Okay, what about return? Tata has a higher return for same risk. Which security is said to be dominating? Tata is said to be dominating. So that's why we select what? Tata Limited, because it is giving a higher return for same risk. Let us come to scenario 2. What about scenario 2? What about scenario 2? Risk, Tata Limited is having a lower risk. What about return? Same return. Same return for lower risk means again I am going to select Tata Limited. Clear? Scenario 3. Scenario 3. Which security is having a low risk? Reliance. Which security is having a higher return? Reliance. So that means here Reliance is dominating what? Tata Limited. So that means we select Reliance because it is giving a higher return for lower risk. Clear? Scenario 4. Scenario 4, here we cannot straight away tell the answer, because from risk point of view, which is the best option? From risk point of view, Tata, because it is having a lower risk. From return point of view, Reliance. So which security we should select? So Markovich says that we should select a security which is giving a higher return for higher risk. Nothing but we should select a security which is giving a higher return. That's it. So that means we are going to select what? Reliance Limited. If these are rules of dominance, so keep aside the rule of a dominance. We can use what? Coefficient of a variance and can decide. What is the coefficient of variance? How can we find out the coefficient of variance? Standard deviation divided by expected return. In this case, 5 divided by 10 and 7 divided by 15. So we select the security which is having a lower coefficient of a variance. Okay. In first 3 cases, there is no conflict. Risk point of view, which is the best option? Reliance. Return point of view also, Reliance is the best option. Scenario 2, from risk point of view, which is the best option? Tata. Return anyway it is same. So that's why I go for what? Tata. In scenario 1, risk point of view, both are same, but return point of view, so Tata is the best one, right? I go for Tata. So first 3 scenarios, no conflict. But whereas 4th scenario, risk point of view, Tata. Return point of view, Reliance. In that case, what we select a security which gives a higher return for higher risk. This is as per rule of a dominance. So instead of using rule of dominance, we can go for what? Coefficient of a variance. So answer may differ. So coefficient of variance, how do we calculate? Standard deviation divided by expected return. Okay, clear? Now let us come to the question. Smart 5. Smart 5 means this question is for practice or refer. This question you have to refer. Okay, but general psychology of a student is they feel like practicing the small easy questions and they feel like referring the hard questions. So that's why I have specifically categorized the questions into smart and super. But human tendency, if smart 5, students get excited to calculate the answer. Okay, because it is easy to understand, there is no chance to do a clerical mistake. Okay, so change your preparation, okay, method and style. So following is the data regarding 6 securities, particulars A to F. Return is given, risk is given. Assuming 3 will have to be selected, state which one will be picked. Only 3 securities can be selected, state which one will be picked. Okay, this is easy question, but we cannot ignore. We have to refer. Why? So we have only one question on this concept, rule of a dominance. Only one question. For suppose if you are not referring to this question and going to the examination, if this question appears in examination, suddenly what? Okay, so what is this concept? You may not be able to get it. So that's why you have to refer. Clear? So return, risk. Assuming 3 will have to be selected, state which one will be picked. Which security has to be selected. First, let us start comparing. Let us start comparing what? A and B. A and B. So tell me which security am I going to select out of A and B? I am going to select A. Why I am going to select A? Because A is giving a same return for lower risk. So that means this is out. A is dominating B. A is dominating B. Yes or no? A is dominating B. So that's why we select A. Clear? Let us compare A with C. We cannot say A is dominating C. We cannot say A is dominating C. Okay. So clear? We cannot say A is dominating C because C is giving a higher return for higher risk. That means as C is giving higher return for higher risk, I should select this C also because C is giving higher return for higher risk. Let us compare A and D. A and D. If you compare A and D, so then what? If you compare A and D, then what? A is better. Why A is better? Because A is giving higher return for same amount of a risk. So that's why D out from the race. What about E? E. I cannot eliminate E. Why? Because E is giving higher return for higher risk. Clear? What about F? What about F? F, same return for higher risk. So A is giving same return for lower risk. F is giving same return for higher risk. A is dominating F. So that's why what eliminate F. So that means out of 6, only 3 will have to be picked. So what are the 3 we are going to pick? A, C, E. First, suppose they may ask you to pick only one. In that case, we cannot apply the rule of a dominance. What you have to do is simple. Go for what? Coefficient of a variance. Find out the coefficient of variance for all the 6 securities and select the security which is having a lower coefficient of a variance. Clear? Done? Clear? So out of 3 we have to select what? A, C and E. You should write the reasons also. Why we are selecting A, C and E. Clear? Next, assume perfect correlation. Perfect correlation means, so when they say perfect correlation, not negative, it is positive. Perfect correlation means +1. In this question, special point you may not understand. Perfect correlation means what? +1. That means correlation between X and Y is equal to +1. Assume perfect correlation 1. Okay. So that means what? Securities are moving in same direction and in same proper. Show whether it is preferable to invest. 70% in A and 20% in C. First option. 75% in A and 25% in C. Or to invest 100% in E. 100% in E. If 100% is invested in E, return is equal to 9%, risk is equal to 5%. Yes or no? So what is the first option? 75% in A and 25% in C. Assume perfect correlation. Perfect correlation means what? Correlation between A and C is equal to +1. Okay. So when correlation coefficient is +1, so how do we find out the risk of a portfolio? Simple. We do a weighted average of a security risk. Yes or no? So that means 0.75 into what? 4 plus 0.25 into 12. 0.75 into 4. That means 3 plus 0.25 into 12. That is also 3. Overall, 6% is the risk. 6% is the risk. Clear? I need not use the lengthy formula. Why I need not use the lengthy formula because correlation is perfect. That means sigma xy is equal to +1. When sigma xy is equal to +1, sigma p is equal to A plus B. What about the return? Return is equal to 75% into 8, 6, plus 25% into 12, 3, 6 plus 3, 9. So nothing but 9% return, 6% risk. In first option, 9% return, 6% risk. If you are investing 100% in E, return 9, risk 5%. So that means in second option, we are getting same return for lower risk. So it is better to invest in what? E. It is better to invest in what? E. Am I clear? Done. E will be preferable. Clear? Everybody are able to understand? Now let us move on to the next concept, beta concept. Without calculation of portfolio beta, you will not find even one single question paper. Beta. So what is this beta? So till now we learned how to find out the return and risk of a security, and also what return and risk of a portfolio. Okay, risk of a portfolio or a security can be measured using variance, standard deviation, coefficient of variance. Are you able to maintain the link? We are discussing portfolio management. Why we are discussing portfolio management? Because 4 decisions falls within the scope of a financial strategy: investment, financing, dividend, portfolio. What is the object of AFM? Wealth maximization. Wealth depends on 2 factors: profit and risk. Okay, we should keep risk as low as possible. So while taking a portfolio decision, we consider mainly 2 factors. What are the mainly 2 factors? Before investing in a portfolio, we consider mainly 2 factors, that is return and risk. So that's why we have learned how to find out the return and the risk. See how these numbers are calculated. First we started with X. How the X is calculated? Apply common sense. P1 minus P0 plus D1 divided by P0. So that is simple. Investor will get a return in the form of 2: capital appreciation and dividend or interest. If it is a bond, he will get interest. Yes or no? So first we calculate X. And next what? X bar. Generally we expect what? An average. If it is past data, we do simple average, and then if it is future data, we go for weighted average. X bar. So we are expecting something like X bar, but we should consider the another factor, not just the return. We have to consider another factor. What is that factor? Risk. How do we calculate risk? What is the meaning of risk? First you should understand the meaning of a risk. Risk means uncertainty, possibility of occurrence of a loss, possibility of a deviation from the mean average. If you are investing in Government of India bond, that means no risk. If you are investing in Government of India bonds, no risk. If you are investing in Treasury bill, no risk. But if you are investing in Reliance, Tata or Tata Motors, then there is a risk involved. Uncertainty is involved. So that's why we learned how to find out the risk. How can we measure the risk? By calculating variance, standard deviation, coefficient of a variance. There also we have discussed the logic. X bar, X minus X bar. Why X minus X bar? Possibility of a deviation from the mean. So that's why we took deviation from the mean. But why we took X minus X bar square? Because if you take the total of X minus X bar, you will get 0. Okay. But if it is a probability question, then what? P X, P into X, X bar, X minus X bar, P into X minus X bar square. If you are taking only P into X minus X bar, and if you take the total, you will get 0. So that's why you are taking square. And later on we started return and risk of a portfolio. You have to maintain the link to understand the concepts. Understanding concepts is important. Okay, you should focus on the quality rather than the quantity. Okay. So after that we moved on to what? Return and risk of a portfolio. Return of a portfolio is simple. We do a weighted average. We take weights and we do a weighted average of a security return, and we get a portfolio return. So what about portfolio risk? Can we do the same for portfolio risk? Answer is no. Why? Because the main purpose of investing in portfolio is diversification of a risk. Whether the risk will get diversified or not, that depends upon the closeness of a securities. So to determine the closeness of securities, that is sigma xy, first we should determine the co-movement of a securities. Co-movement of a securities means nothing but covariance of a x comma y. Are you getting my point? So directly I cannot find out sigma p. Okay. So whether I can diversify the risk or not, to understand that, first I should find out the closeness of a securities, that is sigma x y. Sigma xy ranges from -1 to +1. But to determine the closeness of a securities, I should first determine what? Co-movement of securities, that is covariance of x comma y. So that also columns you can easily remember. Co-movement, how the securities are moving together, that we have to find out. So that's why we are taking x minus x bar, y minus y bar, x minus x bar into y minus y bar. Total divided by n. That is covariance of x comma y. Okay. Now, covariance of x comma y ranges from -infinity to +infinity. Minus means securities moving in opposite direction. Plus means the securities are moving in same direction. Likewise, sigma xy ranges from -1 to +1, or it can be 0. There are 5 scenarios. We discussed that 5 scenarios, right? So we have to consider that correlation coefficient sigma xy. If sigma xy is equal to +1, then we cannot diversify the risks. Then okay, we can write sigma p is equal to wx sigma x plus wy sigma y. Simple weighted average of what? Security risk. Clear? Now we are moving on to systematic risk. Sir, what is this systematic risk? Total risk is equal to systematic risk plus unsystematic risk. Total risk is equal to what? Systematic risk plus unsystematic risk. So in this chapter, mainly we are talking about the risk diversification. If somebody asks you a simple question, why do you make a portfolio investment? What is the purpose of making a portfolio investment? Simple, my answer is, if I make a portfolio investment, I can diversify the risk. Even if I lose money in one security, okay, I will get money in other security. So my risk will get diversified. That is my simple answer. Yes or no? Okay. Risk diversification. But see the next extension to this concept. Total risk is equal to systematic risk plus unsystematic risk. So risk is a component of two types of risk: systematic risk, unsystematic risk. Okay. Here unsystematic risk can be diversified, but systematic risk cannot be diversified. Are you getting my point? Systematic risk cannot be diversified. Unsystematic risk can be diversified. Sir, what is this? Example, your friend, okay, so recently, okay, so in the end of February, he might have started investing in stock market. Okay, unlucky fellow. So due to Israel and Iran war, what is happening? Throughout the world, the stock prices are reducing. Even he invested in 10 securities, even if he has invested in 10 securities, still he is going to get loss. Why? First of all, this Iran and Israel war is a systematic. The risk arising due to Israel and Iran war is a systematic risk. That is not going to affect one single company. That is going to affect, okay, all the companies throughout the world. Okay. So generally what systematic risk means, it is a country specific or a world specific. Country specific or a world specific. Are you getting my point? For suppose if the government changes, okay, if the coalition government comes, coalition government means what in central, especially in central government, coalition government means overall, okay, 10 party, India alliance has came into the power. Okay, so 5 to 10 parties, they formed as a coalition and they came into power. Example, 5 to 10 parties. What happens? Generally, so the investors will lose a confidence. Why? Because multiple parties together came and they came into the power, right? So now, so initially they may agree Rahul Gandhi as a prime minister, but after 6 months, Arvind Kejriwal, he will be saying like, I will become a PM. Later on, Mamata Banerjee, she may start what? I will become a PM. Okay. So later on what? Akhilesh Yadav, he might ask for PM, prime minister post. So CBN is not in India alliance, okay? He is in NDA. Okay. So now the point is, what happens is, so investors generally lose confidence because if there is a coalition government, if any policy decision is taken, that government may collapse at any point of a time. If a government collapses at any point of a time, then what happens? Again the new government will form and again they will change the policy. Okay. So that's why generally investors will lose confidence. Okay, are you getting my point? So this political instability, inflation or a change in interest rate are the examples for what? Systematic risk. It cannot be diversified and it is country specific, non-diversifiable risk. Unsystematic risk can be avoided. Okay, unsystematic risk. Example, if a Donald Trump died, it is going to affect throughout the world in a positive way. Okay, so is it a systematic risk or unsystematic risk? Systematic risk. Okay, if Donald Trump dies today, what happens? Automatically investors will confidence in the market and they start investing. Okay. Unsystematic risk means what? Example, a CEO of a particular company has died. So that is going to affect only that particular company, not the entire country or a world. Okay. So unsystematic risk can be avoided. Unsystematic risk can be avoided. For example, you invested in X Limited and Y Limited. If X Limited CEO died, okay, fine. You may get loss in X Limited shares, but you will get benefit in Y Limited shares. So nothing but risk has got diversified. So unsystematic risk can be diversified. If there is an electricity problem in one particular company, if there is a labor strike in one particular company, so that is going to affect only that particular company, and that can be diversified by investing in other companies. Clear? Okay. So beta denotes systematic risk. Beta denotes what? Systematic risk. So what is the systematic risk? Beta, okay, denotes systematic risk. It is also called as sensitivity. Sensitivity. So we are all sensitive or not? Yes, we are all sensitive. We are all sensitive to some factors. We are not sensitive to all the factors. Okay, for example, North Korea leader has died. Okay, so here Amar is laughing. He is feeling happy. So that means he is sensitive. He is sensitive. You might be feeling like sensitive means only the positive reaction. You might be expecting Amar to cry on the death of what? Okay, Kim? Okay. So here Amar is laughing. Amar is sensitive. Amar is what? Sensitive. But he is moving in opposite direction. If someone dies, we expect people to cry. But here he is laughing. That is also a sensitivity. That is also what? Sensitivity. Are you getting my point? Okay. Now Salman Khan getting married. Amar crying. Is he sensitive or not? He is sensitive. He is sensitive. Okay. Salman Khan got divorced. He started laughing. He is sensitive or not? He is sensitive. समझ गया ना? तो यहाँ पे now the point is, okay, sensitive does not mean the same reaction. Same reaction. Okay. For suppose Amar has got a new love. He started crying. So what do you expect generally? Okay, you expect a person to be happy if he enters into a relation, but he is feeling sad. That means he is sensitive. Okay, so I mean, he broke up with his girlfriend. He started enjoying the life. He is sensitive. So be careful. Sensitive does not mean what? Just crying, feeling sad. Sensitive means what? Being happy or sad. Any kind of a reaction, any kind of a responsiveness. So likewise here also, beta can be positive or negative. Okay. So it denotes the responsiveness of a security return with respect to change in market return. With respect to change in what? Market return. So for example, if markets are performing too good, what do you expect from your company? Generally you expect what? The company should perform well. But the company is going in opposite direction. If markets are performing well, the company in which you made investment, it is performing worse. Getting my point? So that means the company is responding to the market or not? Yes, the company is responding to the market. Company is sensitive to the market. Company is sensitive to the market, but not in a positive direction. It is moving in an opposite direction. So that means if you find out the beta between this company and market, you will get negative. So beta negative means what? Market and security moving in opposite direction. High beta indicates whether it is positive or negative. High sensitivity. High sensitivity. Example, are you getting my point? High sensitivity. For suppose, if a girl enters the class and say hi to Amar, Amar is saying hi. That means what? It is high sensitivity or low sensitivity? High sensitivity. Okay. If second case, if the other girl is saying hi and Amar is saying low sensitivity, it is what? Low sensitivity. Okay. Responsiveness of a security return with respect to what? Market return. High beta. High beta, whether it is positive or negative, indicates what? High risk. Okay. If a girl says hi, Amar says this is also what? Sensitivity. This is also what? Sensitivity. High sensitivity or low sensitivity? High sensitivity. So sensitivity need not be positive. Clear? So beta can be positive or negative. So beta positive means security and market both are moving in same direction. Beta negative means opposite direction. Market and security moving in opposite direction. But 99% of the cases, beta move in beta will be positive. That means market and security move in same direction. Simple. We are living in a society and company is a part of a market. Company is a part of a market, right? So if markets are good, then obviously company will also be performing good, right? Okay. Likewise, if a society is good, then obviously what? We as a person, individual, can also what? Grow. Be happy. Yes or no? Clear? Okay. Beta 0 means what? No relation. Beta 0 means what? No relation. Are you getting my point? Beta 0 means no relation. 99% cases, sensitivity will be positive. Okay, if someone dies, 99%, we feel sad. Okay, 1% chance we may give an opposite reaction. Likewise, markets and the company also. If a market perform well, company will also perform well. If market is not doing good, then company will not also do good. Okay, clear? So beta, security beta, portfolio beta. How the beta of a security can be calculated? Beta of a security. Sir, you're telling market. Whenever I say market means index, Nifty or a Sensex. Okay, this is not a regular class. I'm not going to tell how the Nifty points are calculated, but orally I will tell you the example. The Nifty, the composition of companies, the companies which are forming part of a Nifty are selected based on a market capitalization. One of the main criteria. There are several other factors, but one of the main factor which taken into consideration for selecting the company for Nifty points calculation is market capitalization. How do we get market capitalization? Number of shares into market price per share. Number of shares into market price per share. Clear? If market capitalization is high, then the company will be selected for Nifty. Clear? So Nifty is a composition of 50 companies. How the Nifty points are calculated? Simple. So on daily basis, not on daily basis, for every minute, okay, the market capitalization of those companies will keep on changing for every minute. Okay. So let us take at the beginning, the Nifty points are 100. The market capitalization of entire Nifty companies, example 1 crore. I'm taking simple numbers. Nifty points 100 and the entire market capitalization of 50 companies is 1 crore. Next day, what can happen? Or next minute, market capitalization may increase or decrease. Let us say market capitalization increased to 1 crore 10 lakhs. The Nifty points will increase to 110. Because market capitalization is increasing by 10%, so the Nifty points will also increase by 10%. If the market capitalization decreased, the Nifty points will also decrease. Simple. Okay. We say that market is not performing well today. Based on what? Nifty points. If Nifty points are decreasing, then we say what? Market is not performing well. Why the Nifty points are decreasing? Because the market capitalization is decreasing. Why the market capitalization of Nifty companies is decreasing? Because investors lost confidence and they started selling the shares in the companies. Okay, clear? So if the Nifty is a combination of only 50 companies, is a composition of what? Only 50 companies. But that indicates what? The entire market in India. Okay, if Nifty points are decreasing means what? Even BCCA is not performing well. Index. For every book you will find the index, right? For every book you will find index. Okay. So what is that index? If you see the index, you will get to know what are the chapters, how many pages it is there, where it is practical or theory, how many marks you will get from that each chapter. So you will get some idea, right? Likewise, if you see the Nifty index or Sensex, you will get an idea about the Indian markets. Clear? Okay. So whenever I say market means what? Index. For suppose in question they gave Nifty. Nifty means what? Market. Sensex means what? Market. Okay. So how do I calculate beta? So first, percentage change formula. When 2 period data is given, if only 2 periods data is given, for example, market return 2010. So first period 20, second period 10. That period can be year, month or 6 months. So market return 20 and 10. Security return 30-10. Security return 30-10. So market return decreased, security return also decreased. Now I should find out beta. So beta means what? Beta denotes responsiveness of security with respect to market. With respect to change in market. So change in security return with respect to change in market return. So that's why what should be the formula? Change in security return divided by change in market return, because beta denotes responsiveness of a security return with respect to market return. So that means 30 minus 10 divided by 20 minus 10. So 20 divided by 10, you will get 2. What is the meaning of that? For every 1% change in market, security return changes by 2%. Beta is a ratio. Beta is not a percentage. Remember again, beta is not a percentage. Beta is a ratio. Beta is equal to 2 times. What is the meaning of that 2 times? For every 1% change in market, security return changes by 2%. For every 1% change in market, security return changes by 2%. That is okay. Beta is equal to 2 times. Beta is equal to what? 2 times. Are you getting my point? Clear? Done. Now, so that we can observe from the example also. 20, 10, 30, 20. If you see the difference, this is 10, that is what? 20. That means for every 10, 20 is the change. Nothing but for every 1, the change is 2. That is what I am talking about beta. That is what beta. Okay. But this formula we can apply only when 2 periods data is given. For suppose if the data is 30, 20 and 10. 30, 20, 10. 20, 10 and 5. Then I cannot apply this formula. I cannot directly take the change between first and third or first and 2 or 2 and 3. I cannot take. Then I have to apply what? The second or third formula. What is that second formula? Covariance of security and market, S comma M, divided by sigma M square. Beta is equal to covariance of security and market divided by sigma M square. Standard. So sigma M square means what? Variance of a market. Variance of a market. Clear? Okay. So now, sir, what is the logic? Again, simple. Beta denotes what? Responsiveness of a security with respect to market. Numerator we should get security, denominator market. Yes or no? If you see the formula, I am not completely deriving the formula, but covariance of S comma M means what? S means what? Security. M means market. S minus S bar into M minus M bar. Forget about summation sigma and divided by N. Okay, forget about it. Likewise, sigma M square, M minus M bar square. Here also I am ignoring what? Summation sigma and N. Square and this M minus M bar will get cancelled. What is left? Deviation of security divided by deviation of a market. Responsiveness of a security with respect to change in market. Yes or no? So that's why what is the formula? Second formula, beta is equal to covariance of S comma M divided by sigma M square. Am I clear? Now, correlation formula. Sir, what is this correlation formula? Simple. Covariance of S comma M, this can be written as what? Covariance of S comma M, this can be written as sigma SM covariance of S comma M. You know the sigma SM formula. Sigma SM is equal to covariance of S comma M divided by sigma S sigma M. Correlation coefficient formula. Do you remember the correlation coefficient formula? Sigma SM is equal to covariance of S comma M divided by sigma S sigma M. Do not come to class without preparation. Okay, if you are coming to class without preparation, you cannot cope up. Okay, so what happens now? Covariance of S comma M is equal to what? Sigma SM into sigma S sigma M. Am I correct? Now the square and the sigma M will get cancelled. What is left? Sigma SM into sigma S divided by sigma M. Again same, in the numerator we are getting standard deviation of market, numerator standard deviation of a security into what? Correlation coefficient. That's it. So beta is equal to sigma SM into sigma S divided by sigma M. So we have a regression formula, but this regression formula we are not going to use it. Regression formula, summation sigma S into M, nothing but we multiply security return and market return and take the total of security return into market return, minus N into S bar into M bar divided by summation sigma M square minus N into M bar square. Here also in the denominator we are taking market, in the numerator we are taking what? Security and market. Clear? But we use the second formula. What is that second formula? Covariance of S comma M divided by what? Sigma M square. Okay, done. Now covariance of S comma M and sigma M square. So what are the columns we need for covariance of S comma M? S minus S bar, M minus M bar. So to find out beta, I cannot directly take S minus S bar because I need to find out S bar. So that's why what are the columns I should add? S, S bar, and next S minus S bar, M minus M bar. What about M minus M bar? Again, I need M and M bar. But here I have to find out two. One is covariance of S comma M, and the other one is sigma M square. So first I should start with sigma M square. Why I should start with sigma M square? If I start with sigma M square, then for finding out sigma M square, the columns I will take is M, M bar, M minus M bar, M minus M bar whole square. So that M minus M bar we can use in what? Covariance of S comma M. We can reduce the columns. Okay. So covariance of S comma M. What are the columns for covariance of S comma M? S, S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. Clear? Okay. Are you getting my point? So this is when past data is given. But when future data is given, for sigma M square, what are the columns? P, M, P into M, M bar, M minus M bar, P into M minus M bar whole square. Clear? And for covariance of S comma M, what are the columns? P, S, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. Clear? Done? Okay. So capital asset pricing model. Capital asset pricing model means it is used for finding out required rate of a return of a security. So this we already know. CAPM return is equal to RF plus RM minus RF into beta. What is RF? Risk-free return. Beta, risk factor. RM, market return. RM minus RF, market risk premium. Beta into RM minus RF, security risk premium. This is simple to understand. Beta of a risk-free security is equal to 0. Beta of a risk-free security is equal to 0. Beta of a cash is also equal to 0. Remember this. Beta of a cash is also equal to 0. Beta 0 means what? No relation between security and market. Sir, why beta of a risk-free security is equal to 0? Simple. Whether markets move up or down, it is not going to affect my risk-free rate of a return. That is, it is not going to affect my investment in Government of India bonds. My investment in Treasury bill is not going to get affected because of the markets. So that's why beta of a risk-free security is equal to 0. No risk. No risk means what is my return? What is my CAPM return? What do I require? I require only RF. I require only what? RF. If I invest in risk-free security, I would expect only RF. Simple. Yes or no? Because beta is equal to 0. The obviously second component, 0 into RM minus RF will be 0. That's it. So what do I expect? RF. Only RF. Simple. Zero risk. Zero risk means I will expect risk-free rate of a return. But if I invest in market, if I am investing in market means in Nifty or Sensex. If I am investing in market, that means I am adding risk. I am adding risk. Now the beta is not equal to 0. So beta of a market is equal to 1. Beta of a market is equal to 1. Why is beta of a market is equal to 1? Simple. Beta denotes responsiveness of a security with respect to market. If you are investing in market, here security means market. Market itself is a security. Yes or no? So if a market changes by 1%, market will change by 1%. Yes or no? Are you getting my point? If a market changes by 1%, that means market will change by 1. The relationship with market, relationship of market with market is what? Same, right? Are you getting my point? If I go 2 steps forward, then I will be going 2 steps forward, right? Okay. So is my shadow going 3 steps forward or what? No. So likewise here beta of a market is what? Simple. 1. Beta of a Nifty is equal to 1. Responsiveness of a market with respect to market is 1. Okay. So substitute 1 in that formula. Then RF plus RM minus RF. RF will get cancelled and you will be expecting what? RM. You will be expecting what? RM. Getting my point? For suppose RF 8, RM is equal to 20. If you are investing in risk-free security, you will expect 8%. If you are investing in market, you will expect 20. But now, I am going to invest in a company, okay, that is Amar Industries Limited, which is having a beta 3. Which is having beta 3. What is the meaning of beta 3? For every 1% change in market, 1% change in market, Amar Industries Limited changes by 3%. For every 1% change in market, Amar changes by 3% in, okay, yes or no? So that means 3 times. 3 times. So that's why as a investor, my requirement will increase. I will not just expect 8. I will be expecting 8 plus premium for investing in market. Market risk premium. What is the market risk premium? 20 minus 8. If I invest in market itself, I will expect extra 12. But here I am not investing in market. I am expecting in a company which is having beta 3 times of the market. So that's why I will expect 3 times market risk premium. So 8 plus 12 into 3. So overall my expectation will be what? 44%. If a beta risk increases, my required return will also increase. My requirement will also increase. So that is what happening here. Are you getting my point? So beta into RM minus RF is security risk premium. RM minus RF is market risk premium. So return. So now, sir, why are we finding out the CAPM return? CAPM return we use in security valuation. So the name itself indicates capital asset pricing model. We use this required return, CAPM return, to find out the price of a equity share, find out the value of a equity share. Value of a equity share or a value of a firm. In business valuation, we are going to discuss this concept. Sai Charan, clear? Okay. Now, so I'm going to end up the discussion related to CAPM return with this table. Later on, we shall move on to the practical questions. CAPM return means what? CAPM, not CAMP, CAPM. CAPM return is CAPM. What is the CAPM return? Requirement. So for the risk I take, what is the requirement in above example? For the risk I take, okay, I want 44. I compare the CAPM return, that is required return, with expected return. Required return means what do I require? Expected return means what the security is expected to give or what the company is expected to give. So here what is my requirement? 44. So be careful, sometimes CAPM return is also called as a expected return. You should go by the context, not by the words. Clear? Sometimes they may ask you, calculate expected return as per CAPM. So nothing but they are asking you to find out required return. Otherwise, in general sense, expected return means nothing but X bar, Y bar. The return expected to be given by the security. So now I am comparing CAPM return and expected return. So for suppose what is the CAPM return? 44. This is my requirement. But security is giving only 20. Security is giving only 20. So nothing but it is second scenario. Expected return 20 is less than CAPM. Okay. So am I going to invest in the security? Answer is no, because I want 44, but the security is expected to give just 20. Why do I invest? I have a brain, right? So that's why. So if I have already made an investment that is overvalued, just sell it. Okay. So get relieved from the security, because for the risk I take, I should get 44. It is just giving what? 20. So sell it. For suppose my requirement is 44, but the security is giving 80. Wow. My requirement is just 44, but security is giving 80. Getting my point? Okay. Example. I'm just giving an example. Amar, he is expecting Anupama Parveshwaran, but God gave Rukmini Vasant. Is he going to accept the decision? Is he going to accept or not? Okay. Why? Because the God is expected to give more than his requirement. Yes or no? Blushing. So likewise here also, we are expecting for the risk we take, we want only what? 44%. We want only what? 44%. But the security is expected to give 80. That means undervalued. Security is undervalued by it. Okay. But your requirement is 44 and your security is expected to give 44. Then correct pricing, just hold it. Clear? So CAPM return is also called as fair return, or it is also called as equilibrium return. Done. Clear? Okay, sorry, I mean, able to understand this beta concept. So now after solving these questions, you will get more clarity. Come, smart 6. Smart 6. Smart 6 means what? Refer. But psychologically, students feel like practicing this question. I have to get this answer at any cost. Okay. So they put their blood and sweat in this question. But this question is just for the referral. Okay. Given below is the information. Raju, सुन रहा है ना? अमर भाई, सुन रहा है ना? चरण भाई, ममता दीदी, सुन रहा है ना? Okay. Rahul Gandhi. Okay, hi. Thank you, sir, for coming to my class. Given below is information. Given below is information of market rates of returns and data from two companies A and B. Given below is information of a market rate of a returns and data from two companies A and B. Particulars 2007, 2008, 2009. Market returns are given 12, 11, 9. Company A 13, 11.5, 9.8. Company B 11, 10.5, 9.5. You are required to determine the beta coefficient of shares of company A and company B. हम कैसे कैलकुलेट कर सकते हैं बेटा? बोलो अमर बेटा बोलो. How do we calculate beta of a company A? How do we calculate beta coefficient? What is the formula? Can we apply the first formula, change in security return divided by change in market return? No, because 3 years data is given. So that means we have to apply the second formula. What is that second formula? What is the second formula? Covariance of S comma M divided by sigma M square. Variance of a market. So variance of market will be same for what both A and B. Market information is given. So using this market information, we can find out what variance of a market. What is the next step? Finding out covariance of A comma M, covariance of B comma M. समझ गया? Nothing but the first step. I'm just writing the steps. You have to calculate. So after the break, pause the video. After my explanation, pause the video and calculate. For the first time, you have to calculate. Even though smart question, if it is a smart question, to get conceptual clarity, first time you have to calculate. Second time, just focus on super question, refer smart. Okay. Sigma M square. First step. So what are the columns? M, M bar, M minus M bar, M minus M bar whole square. Okay. Clear? Sigma M square. What about the next one after calculating sigma M square? Covariance of A comma M. So what are the columns for covariance of A comma M? We cannot directly write A minus A bar, M minus M bar, A minus A bar into M minus M bar. Why? To find out A minus A bar, I do not have a A bar. So first I should start with A bar, A minus A bar, M minus M bar, A minus A bar into M minus M bar. These are the columns. Okay. Is there a probability in this question? No. What is the next step? See. Covariance of. So practice means guessing the columns, guessing the steps, visualizing the steps. Okay. But unfortunately, you copy these columns from the question bank and then you start calculating, writing the numbers and start playing with calculator. So that is not a practice. Okay. So what are the columns? B bar, P minus B bar, M minus M bar, dB into dm. dB means deviation of a security, B into deviation of a market, not deviation of biscuit. Okay. Clear? Now beta is equal to what? Covariance of A comma M divided by sigma M square. Beta of A. Beta of a B is equal to covariance of B comma M divided by sigma M square. That's it. Done? Okay. Pause the video and solve this question. Check whether your answers are matching with question bank or not. That's it. Workbook. Let us move on to the next question. Smart 7. ఓకే, మిర్చి మూవీ చూసుంటారు కదా. నన్ను ప్రాక్టీస్ చేయాలని ఎక్స్పెక్ట్ చేస్తారు మీరు. యూ మైట్ బీ ఎక్స్పెక్టింగ్ మీ టు రైట్ ద ఆన్సర్. నేను ప్రాక్టీస్ చేస్తే నాకు వస్తుంది, నీకు రాదు కదా. మిర్చి మూవీలు ఏంటి? మంచోడు నువ్వు అవ్వాలి అంటే డబ్బులు నువ్వు ఇవ్వాలి. లైక్వైజ్ ఎగ్జామ్ నువ్వు పాస్ అవ్వాలి. యూ టు ప్రాక్టీస్, నాట్ మీ. ఓకే, నెక్స్ట్ స్మార్ట్ 7. The distribution of return of a security F. The distribution of a return of a security F and market portfolio P. So return of a security F distribution and also what? Market portfolio P. Market portfolio means market is given below. Probability is given. Probability is given. And next what? Security return. Security return and market return. Probability, security return, market return. You are required to calculate expected return of security F. You are required to calculate expected return of a security F. Expected return of a security F means here F bar. How do we get F bar? By doing weighted average. And the market portfolio, expected return of a market portfolio, nothing but M bar. How do we get M bar again? By doing a weighted average. The covariance between the market portfolio and security. They are asking you to find out the covariance of a security and market. Covariance of security and market. And next what? Beta. Nothing but ultimately they are expecting you to find out the beta. How can we find out beta? Beta is equal to covariance of S comma M divided by sigma M square. While finding out sigma M square, anyway you are going to find out what? Expected return of a market. Yes or no? While finding out covariance between portfolio and security, you are going to find out what? Expected return of a security F. Nothing but you have to find out what? Beta. But they asked you stepwise. Simple. I can directly proceed to calculate beta. Question number. This is smart or super? Smart 7. Even though there is probability, I have categorized this question as a smart 7. Why smart 7? I will let you know. So smart 7. First step, what is the first step? Akhilesh Yadav ji, what is the first step? Sigma M square. Sigma M square. So tell me the column. Sigma M square. Here probability is there. You have to be careful. Probability. When there is probability, there is high probability of doing a clerical mistake. Okay. P M P into M M bar M minus M bar P into M minus M bar whole square. So expected return of a market is being calculated here. Yes or no? Okay. Next, what is the B part? B part, covariance of S comma M. Covariance of S comma M. Can I directly take S minus S bar? No. So what do I want? I want S bar. I have to find out S bar. So that's why what should be the column? P, S, P into S, S bar, S minus S bar, M minus M bar, P into, be careful, P into DS into DM. High chances of ignoring this probability. Be careful. P into DS into DM. Done. So first part of the question is expected return of a security. Expected return of a security calculated. Next what? Expected return of a market calculated. Next what? Covariance between security and market calculated. Next what? Beta. How do we get beta? Covariance of S comma M divided by what? Sigma M square. Answered successfully. Clear? Done? Okay. So first time, if you are listening to this class first time or first time practice, then you have to practice smart question also to get clarity, to retain the concepts. But second time you focus only on what? Super question. Okay, done. Let us move on to the next question, super question. This question is for practice. High chances of forgetting this part. State your observation. आपने क्या ऑब्जर्व किया? ओके, कुछ भी ऑब्जर्व कर सकते हैं, लेकिन कुछ भी नहीं लिख सकते. यू हैव टू राइट व्हाट दे आर एक्सपेक्टिंग, what they are expecting. Okay, so this question we have to practice. I mean, you have to practice. The following information are available with respect to Krishna Limited. Year 2012, 13, 14, 15, Krishna Limited average share price, dividend per share, average market index, dividend yield, return on a government bond. After explaining this question, I will give 1 hour break, and again I will start portfolio session. Okay, again at 9:30 I will be taking the class. So today our target is to complete portfolio management at any cost. Krishna Limited average share price, dividend per share, average market index, dividend yield, return on a government bonds. Return on a government bonds. Calculate beta value of the Krishna Limited at the end of the 2015. Beta find out chemana. They're asking you to find out the beta. Is it a past data or a future data with probability? Past data. So nowhere they have given a probability. So this is past data. How do we find out the beta? Covariance of S comma M divided by sigma M square. Okay, to find out sigma M square we want M bar. So in this question M is not directly given. Okay, so here this is the market related information. This is the market related information. This is what? Security related information. Security related information. So return on a government bond. This is what? Risk free rate. Why this risk free rate is given? We can discuss later. Okay. First step is to find out what for beta. What is the first step to find out beta? Super 3. First step is to find out sigma M square. Yes or no? First step is to find out what? Sigma M square. Okay. See the sigma M square. So see the columns, what I am taking. What are the columns? M bar, M minus M bar, M minus M bar whole square. So you have to find out. See the information, market related information. It is given on the right side. Be careful. How do I find out M? P1 minus P0 plus D1 divided by P0. Okay. For 12-13, for 2012-13, this is the P1 and this is P0. So that means 2130 minus 2013 plus D1. D1. D1 means 4% or 5%? 5% at the end. Okay, but this is not a dividend amount. Be careful, that is dividend yield. In this question, high chances of doing a clerical mistake is because that 5% is not a dividend amount, that is a dividend yield. Dividend yield means this is already T1 by P0. This is not D1 actually. This is, getting my point, this is not D1. This is what? D1 by PO. D1 by P0. D1 by P0. Are you getting my point? Okay, this is not D1. This is D1 by P0. So what is the M formula actually? P1 by P1 minus P0 plus D1 divided by P0. Nothing but I can write it as P1 minus P0 divided by P0 plus D1 by P0. Yes or no? So here the special point is that 5% is not a D1, it is D1 by P0. So that's why that 5% has to be added separately. We cannot again divide with P0. So that's why what is the calculation? 2130 minus 2013 divided by 2013 plus 5%. Clear? What is for next year? 2350 minus 2130 plus 6%. Next 2580 minus 2350 plus 7%. Clear? Are you able to understand this? So here chance of doing a clerical mistake, and we should take D1. Students might take D0. Be careful. So this is m bar, m minus m bar, m minus m bar square. Clear? Okay, so what is the variance? 7.38%. Clear? Now let us come to what covariance of security and market. So what are the columns? S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. So this is the company related information. So now 253 minus 245. This time dividend amount is given. Here this is not a dividend yield, this is dividend amount. This time what is the calculation? 253 minus 245 plus 22 divided by 245. Normal calculation. Next 310 minus 253 plus 25 divided by 253. 330 minus 310 plus 30 divided by 310. Clear? So this is how we can find out what S. And remaining common S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. So this is the covariance of S comma M. 14.12. Beta is equal to 1.913. Clear? Done. Here one part is missing actually. Okay. State your observation. Sir, what is the state your observation? What is the beta we got? 1.913 beta. 1.913. Sir, what is the observation? Observation is simple. So I told you the CAPM return. How do we find out the CAPM return? CAPM return is equal to RF plus RM minus RF into beta. For 1213, what is RF? 6%. Plus RM. For 1213, what is RM? For 1213, what is RM? 10.81. So for 1213, I am calculating CAPM return. What is CAPM return? 6 plus RM 10.81 minus RF 6 into beta 1.913. Are you getting my point? You can find this answer in ICAI book, CA Final Study Material. Okay, I'm explaining the answer. 6 plus 10.81 minus 6 into 1.913. So what is the answer? 15.2. What is this 15.2? 15.2 is the requirement, my requirement. But what is the security giving? Security for 1213, it is giving 12.24. Security is giving 12.24, which is less than my requirement. Which is less than my requirement. Which is less than my requirement means sell. Overpriced. Overpriced. Likewise, I find out for what? 13, 14, 14, 15. So 13, 14. 13, 14, what is risk-free rate? 6. So 13, 14. 6 plus, what is the M? 16.33 minus 6 into beta. 1.913. 20? 25.76. What is the return? 32 point. My requirement is 25.76, but security is expected to give 32.41. Now we are expecting Anupama, but God is giving Rukmini. Okay, so buy or sell? Buy. Undervalued. Security is undervalued. Clear? If you go deep, the question framing itself is wrong. The answer given in CFA and study material is also wrong. How the beta is calculated? Using the past data. How can you go into past and calculate required return? Using the past 3 years data, you calculated beta. Again, you are going back and you are finding out CAPM return for the past. How can you find out, right? Okay. So, but you have to write the answer which is expected by CA study material. So that's why be careful. State your observation. This is a special point in this question. Done. So with this, we have completed what? Beta concept. Beta concept. So again, let us meet at 9:30. Done. So today our target is to complete. Slowly we should complete what? A portfolio. Thank you. Thank you everyone. Raju, thank you so much. See the smart eighth question. A company has a choice of investment between different equity oriented mutual funds. The company has an amount of rupees 1 lakh to 1 crore to invest. The details of mutual funds are as follows. 5 mutual funds and beta is given. Required, if the company invests 20% of its investment in each of the first 2 mutual funds and an equal amount in the mutual fund of C, D and E, what is the beta of the portfolio? How can we find out the beta of portfolio? Beta of a portfolio is nothing but weighted average of a security beta. So systematic risk cannot be diversified. Systematic risk cannot be diversified. So that's why portfolio beta. Beta denotes systematic risk, yes or no? So that's why portfolio beta is simple weighted average of security beta. Okay, am I correct? So this question is simple. First part and second part is simple. Third part you have to refer, because there is a special point in third. Simple but special. First part, you need not find out any weight. How the investment is made? 20% in first 2 mutual funds. That means what is the weight of A? 0.2. Weight of a B? 0.2. Clear? At an equal amount in the mutual funds C, D and E. What is the balance? 20% in A, 20% in B. What is the balance? 60%. So that balance is invested in C, D and E equally. That means 0.2, 0.2, 0.2. If you do the weighted average, you will get portfolio beta. Simple. So what is the answer? Portfolio beta 1.22. Okay. See the second part. If the company invests 15% of investment in C and 15% in A, 10% in E, okay, and the balance, what is the balance? 0.15, 0.15, 0.1. The balance is 0.6. Balance in equal amount in the other 2 mutual funds, 0.3, 0.3. So what is the beta of the portfolio? Simple. We do weighted average. So the special point in this question is third part. If the expected return on a market portfolio is 12% at a beta factor 1. What is the expected return of a market? 12% at a beta factor 1. RM. Nothing but market return RM is given. So beta factor 1. Obviously, what is the beta of a market? 1. So when beta is equal to 1, market return is equal to 12%. Now the question is, what will be the portfolio expected return in both the situations given above? So generally, to find out the portfolio expected return, we apply CAPM return. What is CAPM return? RF plus RM minus RF into beta. But to apply this formula, RF is not given in this question. This is the special point. RF is not given in this question. So RF is not given. So how can I find out CAPM return? So that's why here in this question the special point is, first case, what is the beta? 1.22. Okay, 1.22 means 1.22 times of the market. So what is the market return? 12%. So the portfolio expected return is equal to 12 into 1.22 times, that is 14.64. In situation 2, the beta is 1.335. So 12 into 1.335, 16.02 is the answer. Clear? Simple answer. Okay. But it is a special one. Why? Generally we feel like expected return means CAPM return, that is RF plus RM minus RF into beta. No doubt in that. Conceptually that is correct. We cannot directly multiply RM with beta. We should take what? RF plus RM minus RF into beta. But why it is a special point in this question? RF is not given, so that's why we are just multiplying RM with beta. Clear? Done? Simple question. Smart. See the next question. So this is a super question. This is a super question. Here on the screen I have not mentioned, but this is a super question. Okay. Super question. Super question means what? Question for practice. A Limited has an expected return of 22%. Standard deviation of 40%. B Limited has an expected return of 24. Standard deviation 38. A Limited has a beta of 0.86. B Limited has a beta of 1.24. The correlation coefficient between the return of A Limited and B Limited is 0.72. The standard deviation of the market return is 20%. Suggest is investing in B Limited is better than investing in A Limited. Is investing in B Limited is better than investing in A Limited. Okay. First part is simple. Yes, investing in B Limited is better than investing in A Limited because B Limited is giving 24% return, which is higher than A Limited, and the standard deviation 38%, which is lower than A Limited standard deviation. So that's why investing in B Limited is better than investing in A Limited. Why? Because simple reason, because B Limited gives higher return with lower risk. So first part is simple. Second part is also simple. If you invest 30% in B Limited, 70% in A Limited, what is your expected rate of return and portfolio standard deviation? So be careful here. Weights, first B Limited weight is given, second 70% A Limited weight is given. But whereas in first paragraph, first A Limited information, second B Limited information is given. So they are expecting you to find out expected rate of a return and standard deviation. Simple. How can I find out the expected rate of a return? By doing a weighted average. Yes or no? So 0.7 into 22% plus 0.3 into 24%. Clear? What is P bar? 22.6%. Next, risk of a portfolio. How can I find out the standard deviation of portfolio? Correlation coefficient is 0.72. 0.72. So that means I have to use lengthy formula. Square root of Wx square sigma x square. Okay, so I will get sigma p 37.06%. So this is also a normal point. Here the special point in this question is third part. Why is a third part is special point? What are the market portfolios expected rate of a return? What are the market portfolio expected rate of a return and how much is the risk-free rate? Nothing but they are asking you to find out RM and what? RF. What are the market portfolio expected rate of a return and how much is the risk-free rate? They are asking you to find out RM and RF. Sir, how can we find out RM and RF? Okay. The information available is what? A bar, B bar, sigma A, sigma B, and sigma AB. This is the information available. But what I have to find out? I have to find out what? RM and RF. Okay. So why it is a special point? Because we should assume that CAPM return and expected return are the same. You should assume CAPM return and expected return are the same. So I should form the equation. What is the equation? 22% is equal to, I do not know RF. RF is a constant. Irrespective of company, risk-free rate will remain same. So that's why I take RF, not RF1. RM minus RF into beta 1. Beta 1. Beta changes from company to company, but RF will remain same. RM minus RF will also remain same. What is the beta first case? 0.86. So this is the equation number 1. What is the equation 2? 24 is equal to RF plus RM minus RF into 1.24. So this is equation number 2. Okay, equation 2 minus 1. Okay, RF will get cancelled. You can find out RM minus RF. Then afterwards, substituting RM minus RF, you can find out what RF. So later on, pause the video and solve this. Okay, you can find out RF and also what RM. So this is the special point in this question. Understand the concept. So this is similar to y equal to bx straight line equation. CAPM return formula is nothing but it is similar to what? Straight line equation, that is y equal to a plus bx. In this a and b are constants. Of course, in our equation also RF is constant, RM minus RF is also constant. X is a variable. From company to company beta changes, and whenever the beta changes, this CAPM return will also change. Okay, so X and Y are variables. Clear up? So this is a special point. See the fourth point. What is the beta of portfolio? Weights 70, 30. This is simple again. What is the beta of a portfolio? We do a weighted average. That's it. 0.7 into 0.86 plus 0.3 into 1.24. So beta of a portfolio is equal to 0.97. Clear? Simple one. So let us move on to the next question without wasting time. So this question is a smart question. This question is what? Smart. Mr. Tempest has the following portfolio of 4 shares. Following portfolio. The risk-free rate of a return is 7%. The market rate of a return is 14%. Name of a security beta and investment is given. Next, required. This should come under the table. Required. Determine the portfolio return. Calculate the portfolio beta. Actually, second part should be the first part, and first part should be the second part. Determine the portfolio return. So nowhere they have mentioned whether it is expected return or a CAPM return. Nothing but they are expecting you to find out what CAPM return. Because RF is given, RM is given. I have to find out portfolio beta. How can I find out the portfolio beta? By doing a weighted average. Investment is there. By using this investment, I can find out what proportion. Investment, security, investment, proportion, beta, proportion into beta. So this is the portfolio beta. So what is the portfolio return? RF plus RM minus RF into beta. 7 plus 14 minus 7 into beta. So the answer is 16.13%. Clear? Done? Okay? Simple. This question is a smart question. You need not practice, you have to refer this question. Clear? Are you getting my point? So some students will have a negative mindset. So this question is very easy. So these kind of questions will be asked in examinations or not. Yes, they will ask these kind of questions. This is a past question. I think question number 16, it was asked as case scenario. Okay. So let me explain next question. Question number 14. The following information is available in respect of a security X. In security X. Equilibrium return. I told you already, equilibrium return means CAPM return. What is the CAPM return? 15. CAPM return of a security X is equal to 15. What is the market return? 15. Market return 15 and required return of a security X is also 15. That means beta of a security X might be 1. That's why CAPM return is equal to RM. Beta might be 1. So this is conceptual understanding. 7% treasury bond trading at $140. 7% treasury bond trading at $140. This information is given to find out risk-free rate. 7% treasury bond. Here we have two alternatives. You can take risk-free rate 7%. You can take risk-free rate directly 7%. But whereas in ICAI book, they have taken 7 divided by 140. Nothing but 5%. Why sir 7 divided by 140? So the assumption is face value $100. Market price is $140. So the interest payable is 100 into 7%. 7 divided by 140, 5%. Clear? Covariance of market return and security return. 225%. Correlation coefficient 0.75. You are required to determine the standard deviation of market return, that is sigma m, and the standard deviation of security. Standard deviation of security. So here we have to find out sigma m and sigma s. Sigma m and sigma s. How can we find out? So this actually you have to try on your own. Pause the video and try. I hope you tried. Now how to solve this? Simple conceptual understanding. Equilibrium return is equal to market return. That means beta might be 1. We know beta is equal to 1. What is the beta formula? Covariance of S comma m divided by sigma m square. So covariance of S comma m is already available. We know that beta is equal to 1. So we can find out what sigma m square. Yes or no? Sigma m is equal to nothing but square root of a sigma m square. What is the third formula, beta formula? Sigma sm into sigma s divided by sigma m. So we already know the beta. We know sigma sm given in question. Correlation coefficient. Sigma m already calculated. So by using this information we can find out what sigma s. Okay. So beta. How the beta is calculated? So conceptual understanding is simple. What is the concept? CAPM return is equal to market return. That means beta is equal to what? 1. That is simple one. Okay. So here what? Instead of applying the concept, you can find out RF first. RF is equal to 5%. Now substitute equilibrium return. CAPM return 15% is equal to RF plus beta into RM minus RF. We already know RF. We can find out what? Beta. So beta is equal to 1. Next, beta is equal to formula covariance of S comma m divided by sigma m square. That is equal to 1. I already know covariance of S comma m. I can find out what sigma m square. So sigma m is equal to what? 15%. Clear? Now, Another formula, beta is equal to sigma s divided by sigma m into sigma sm. That means 1 is equal to sigma s divided by sigma m calculated in first part. Sigma s divided by 15 into correlation coefficient 0.75. You will get sigma s 20%. Clear? Am I clear? Done? Any special point in this question? No. So this is a smart question. This is a smart question. Smart one. Is it for practice or refer? Just refer. Yes or no? Even I think your opinion also same. Your opinion also same. Yes or no? This question is for practice or refer? Yeah. Next, see the question number 15. Mr. Fed up wants to invest an amount of rupees 520 lakhs and had approached his portfolio manager. The portfolio manager had advised Mr. Fed-up to invest in the following manner. Security, moderate, better, good, very good, best. Amount, beta. You are required to advise Mr. Fed-up in regard to the following. Using CAPM methodology. Expected return of the portfolio. If the government securities are at 8%, the Nifty is yielding 10%. Okay, risk-free rate 8%, RM 10%. Because government securities are 8%, Nifty 10%. Clear? What they are asking you to, you are required to advise Mr. Fed-up in regard to the following using CAPM. Using CAPM, we have to find out expected return on the portfolio. Expected return on the portfolio. Using CAPM, we should advise on expected return on the portfolio. This is the first part of the question. Second part of the question is advisability of replacing security better with Nifty. So first let us see the second part. Advisability of replacing security better with Nifty. Security better. Okay, they want to replace security better with Nifty. Nifty means market, yes or no? What is the beta of a Nifty? What is the beta of a Nifty? Market. Beta of a market or a Nifty is equal to 1. What is the beta of a better? 1. That means even if you replace security better with Nifty, it will not make any difference. Why it will not make any difference? Because beta of a better and beta of a Nifty is same. So that is second part. Let us come to the first part. First part, expected return on the portfolio using CAPM. So CAPM is equal to RF plus RM minus RF into beta. Yes or no? So first we should find out portfolio beta. How can we find out portfolio beta? What are the columns? Security, amount, proportion, beta, proportion into beta. After finding out portfolio beta, how do we get CAPM return? RF 8% plus RM 10% minus RF 8% into portfolio beta. Clear? See the solution. Security, amount, proportion, beta, proportion into beta. So 1.104. So expected return on a portfolio is equal to RF plus RM minus RF into beta. So the answer is 10.208. Second part, beta of a better is equal to 1. Beta of a Nifty is equal to 1. So there is no difference even if better is replaced with Nifty. Simple point. Clear? This question is super or smart? Smart. For other subjects also, you do this kind of a analysis, whether it is financial reporting, even for theory chapters also, theory subjects like audit also, you can apply the same concept. If it is a basic question, okay, you just refer or you can ignore. Okay, so there in theory we do not have a concept of practicing, right? But the point is, if it is a basic question, just ignore and go for what advanced question. Do this kind of analysis. Clear? Nothing but you should pick a question which covers all the points. We should pick the theory question which covers all the points. That kind of a question you have to pick. Okay. Next, let us move on to the next question. Question number 16. This is also a smart question. Smart question. It is for referral, and this is a special one. So both 16, 17, 18th, obviously it is a super question. I will share updated sheet again in the group. Let us see this question. Smart. Sir, if it is the basic question, why you are not ignoring? Why you are mentioning again? There is a special point in this question. What is that special point? See, your client is holding the following security. 4 securities, cost is given, dividend or interest is given, market price is given, and beta is also given. Okay, clear? Now, average return of a portfolio is 15.7%. Average return of a portfolio is given 15.7%. Calculate expected rate of a return in each using CAPM. Average return of the portfolio is 15.7%. Calculate expected rate of a return in each using CAPM. Okay, so I have to find out expected return in each case. That means 4 cases. How can I find out? RF plus RM minus RF into beta. So beta is already readily available for all the 4 securities. Beta is available. Yes or no? Am I correct? Beta is already available, right? Okay, so beta is available. What else we require? RF. RF is given in the question or not? No. Risk-free rate is not given in the question. What about RM? RM is not given in the question. So they are asking you to find out RF also. Risk-free rate of a return. Here also, the second part should be the first part, and first part should be the second question. Because unless we find out the risk-free rate, we cannot find out the CAPM return in each case. Sir, why this question is a special question? Why I should refer? Because this is a CAPM concept I already know. I already know the formula. Because here RM, there is no scope to find out RM. Because market related information is not given. The information given is related to the portfolio. Okay. Now, I am calculating the return RM. How I am finding out RM? See, what is the cost? What is the total of this? What is the total of this? Tell me the total of the cost. What is the total of the cost? 75,000. What is the total of dividend or interest? 7025. What is the total of market price? 80,500. How do I find out the return? Return is equal to P1 minus P0 plus D1 divided by P0. Yes or no? Okay. What is P1 here? 80,500 minus 75,000 plus 7025 divided by 75,000. 16 point what? 16.7%. Actually, this 16.7% is nothing but portfolio return. Yes or no? Am I correct? That is portfolio return. Portfolio is containing 4 securities, and on that 4 security I calculated a return. So that 16 point, what is the answer? 16.7 is a portfolio return actually. But already average return of a portfolio 15.7 is given. Why this question is special? You have to refer it mandatorily on day before examination, because the 16.7% which is calculated is portfolio return, but it is assumed as market return. But it is assumed as what? Market return. So that's why this question is special. You have to refer. Actually, the 16.7 is portfolio return, but we are assuming it as what? Market return. Done? Next, let us find out the portfolio beta. How do you get portfolio beta? Security, investment, proportion, beta, proportion into beta. This is the portfolio beta. Okay. Now, we are assuming the average return of a portfolio given in the question as a CAPM. We are assuming the average return of a portfolio given in the question as a CAPM. We already know the CAPM return 15.7. What is the formula? RF plus RM minus RF into beta. We know the beta. We know RM. We know beta. We know RM. So we can find out what RF. So what is RF? 15.15%. Second part is answered. Now come to first part. What is the first part? CAPM return in each case. How can I get CAPM return in each case? RF plus RM minus RF into beta. So in each case I have to find out CAPM return. Clear? Are you able to understand? So this question is special because portfolio return is assumed as what? RM. And the average return of a portfolio given is assumed as 15.7 is assumed as CAPM return. Clear? So in this question, here the portfolio beta is calculated using the proportions which are calculated using what? Cost. Okay. But whereas in the new edition of a CA material, they have taken a market value as a basis for calculating proportions. Okay. So actually this answer is copied from CA final study material old edition, but in new edition what? They have a calculated proportions using market value. Okay. So conceptually either you can use cost or a market value, both are correct. But I don't want to take risk and you also do not take risk. Better you take what? Proportions on the basis of market value. Okay. So this is how our ICAI plays with student. Let us move on to the next question, 17th question. Your client is holding the following securities. Again 4 securities. Cost is given, dividend, market price, beta. Assuming a risk-free rate 15%. In this question risk-free rate is given 15%. What they are asking you to find out? Calculate expected rate of a return in each using CAPM. RF is already given. So we have to find out RM. How can I find out RM? Same procedure as I calculated in previous question. So I will take cost, total dividend, total market price. Clear? So what is RM? 15.88%. And CAPM return in each case. This question is simple than the previous question. Why? Because RF is already given. Clear? So RF plus RM minus RF into beta. I apply that formula. And in second part, they are asking you to find out the simple average return of the portfolio. See this carefully. Simple average return of the portfolio. In case scenario, this question was asked. Simple average return of portfolio means what? I will do the simple average of all these 4 security returns. So 15.49 is the simple average return of a portfolio. Clear? Are you able to understand this? Done? Okay. So this question is also what? Smart. Now this question is a super question. This question is a super question. Okay. So I would recommend you to apply the same analysis. You do the same analysis for remaining subjects also. I'm telling you the logic why I categorize this question as a super or a smart. Okay. So question number 18. An investor holds 2 stocks, A and B. An investor holds how many stocks? 2 stocks, A and B. An analyst prepared ex ante probability distribution for the possible economic scenarios. Ex ante means future, ex post means past. And the conditional returns for 2 stocks and the market index as shown below. Okay. Conditional returns percentage. An investor holds 2 stocks. For 2 stocks, conditional returns, nothing but possible returns are given, and the market, conditional returns of a market also given. Probability is given. So there are how many possibilities? There can be 3 possible economic scenarios. Economy may grow, economy may remain stagnant or recession. If there is a growth in economy, returns 25, 20, 18. If the economy is stagnant, 10, 15, 13. If economy is in recession, negative. One thing you can observe here, securities and market moving in same direction, obviously. Yes or no? Okay. The risk-free rate during the next year is expected to be around 11%. Risk-free rate 11. RF 11. This question is super question. You have to practice this question. Conceptual question. Unless you understand the concept, you cannot solve this question. Determine whether the investor should liquidate his holding in stock A and B. Liquidate his holdings in stock A and B. Liquidate means what? Sell. Sell his holdings in stock A and B, or on the contrary, make a fresh investment. Contrary means what? On the other side, make a fresh investment in them. CAPM assumptions are holding true. So this is the question. Simple question. So they are not asking you to find out the beta. If they ask you to calculate beta, then okay, you will be about applying the formula covariance of S comma M divided by sigma M square. Yes or no? If they ask you to find out the CAPM return, then also what? You search for the information, RF, beta, RM, etc. and you apply the formula. But here the question is, Okay. Determine whether the investor should liquidate, sell the stock or make fresh investment, buy, sell or buy. How do we decide sell or buy? Already we discussed one super 3 question. State your observation. How do I decide whether to buy or sell? By comparing CAPM return and expected return. CAPM return and expected return. Expected return means what? A bar, B bar. What the security is expected to give. So that I can calculate easily. Expected return. How can I calculate the expected return? By doing a weighted average. Clear? Okay. So the point is, I should compare what CAPM return and expected return. How can I get CAPM return then? RF already given 11% plus RM market return. By doing a weighted average of market returns, I will get M bar. So that M bar is nothing but RM. Okay. And RF plus RM minus RF into beta. Beta is not readily available. Okay. So nothing but I have to find out what covariance of security and market and sigma M square. So that means while finding out sigma M square, I will find out M bar. While finding out covariance of S comma M, I will find out S bar. S bar. Yes or no? So while finding out beta, I will calculate each and every factor I require. So thereafter, I will compare what CAPM return and expected return and decide whether to make a fresh investment or liquidate the holding. Completely a conceptual. Wonderful question. Okay. So here I am not going to write the answer as I already told. Okay. Here the number is 18, but it is a super question. What is the first step? What is the first step? After analyzing all CFNL past papers, study material, I have put a lot of efforts to put all the questions in a sequential order, concept wise. Okay, and based on the past experience, after seeing many students and seeing the certified copies, I have categorized these questions into smart and super. You can blindly rely on these questions. Okay, sigma M square. What is sigma M square? Probability is there, yes or no? So tell me the columns. P, M, P into M, M bar, M minus M bar. This is nothing but what? M bar is nothing but what? RM. This we can use for finding out what CAPM return. Next, B part. B part, what I can find out? Covariance of A comma M. Covariance of A comma M. Tell me what are the columns? Covariance of A comma M. I can take A, P, P into A bar. Next what? A minus A bar, M minus M bar, P into DA into D. Here high chance of forgetting what? Probability. Be careful. High probability of forgetting probability. Next what? Covariance of B comma M. So tell me the columns. B, P, P into B, B bar, B minus B bar, M minus M bar, P into TB into DM. Forget about the presentation given in the workbook. Okay, so you have to follow this process. Okay, so this sigma M square, covariance of A comma M, B comma M, all these will be what? Working notes. Clear? Okay, now I can find out what? Beta. Now I can find out beta. Yes or no? So beta is equal to what? Covariance of A comma M divided by sigma M square. Okay. Now I can compare actual return and expected return and CAPM return, and I can write whether I have to sell or buy. Or we can find out the Jensen's alpha. So what is this Jensen's alpha? Jensen's alpha is nothing but expected return, actual return minus CAPM return. Jensen's alpha is equal to actual return minus what? CAPM return. If Jensen's alpha is positive, buy the security. Listen to me. If Jensen's alpha is positive, positive means what? Actual return is greater than CAPM return. Security is expected to give more than my requirement, so buy. If Jensen's alpha is positive. If Jensen's alpha is negative, sell. If Jensen's alpha is equal to 0, hold. Okay? So now, how can I find out the actual return? Actual return is nothing but A bar. A bar. Say, how do I get CAPM return? RF plus RM. RM means what? M bar minus RF into what? Beta. If Jensen's alpha is positive, invest. If it is negative, sell, liquidate. Okay? Clear? Done. Here the Jensen's alpha is positive for both the securities. So that's why what? Both the securities are underpriced. So an investor should make fresh investment in them. So wonderful question, conceptual question. So these kind of questions will make your concept stronger. So now pause the video and try to solve this question within 15 minutes. Within 15 minutes. So this question is for practice. If you observe, see the categorization, how I made efforts. Please understand. In this question, are we going to calculate beta or not? Yes or no? In this question, I am calculating beta. That too with probability or without probability? With probability. So in this question, are we going to calculate CAPM return or not? We are going to calculate CAPM return. And in this question, we are calculating Jensen's alpha also. So 3 concepts are covered. Okay, covariance of SM, everything. Okay. So if you see this question I categorized as a SMART. Why? Probability, single security and market. But whereas the question which we discussed earlier, it has a 2 securities, probability, and we are not just restricting ourselves to computation of a beta. We are calculating what? CAPM return and also what? Jensen's alpha. Nothing but the earlier question which we discussed includes this question. So on day before examination, you can ignore these kind of a smart questions also. So I request every student who is watching this class, please do this kind of analysis for all the subjects. Save your time. Okay, I will not recommend you to study for 16 hours daily. So do smart work, short list. Okay, you make the list of questions short and focus on those questions. Do the quality of questions. Practice only quality questions. Okay, clear? So meet you in next session. Thank you. And in next session, I'm going to discuss arbitrage pricing theory. In 2 sessions, we are going to complete portfolio management. Thank you. See the next concept, arbitrage pricing theory. Before moving on to the next concept, arbitrage pricing theory, so already we have discussed Jensen's alpha, right? So how do we get Jensen's alpha? Jensen's alpha is equal to actual return minus CAPM return. If Jensen's alpha is positive, Jensen's alpha. So Jensen's alpha is the difference between the portfolio's actual return and the return it should have earned. So nothing but actual return minus what? CAPM return. Are you getting my point? So Jensen's alpha, if it is positive, what does it indicate? We should buy the security. Jensen's alpha negative means we should sell the security. Jensen's alpha 0 means we should hold the security. Yes or no? And next. So I have told you when the security is undervalued or overvalued. If the expected return or actual return, if expected return is greater than CAPM return, nothing but what I want versus what I will get. If what I will get is greater than what I want, simple, I will buy the security. Yes or no? Next, expected return less than CAPM return. That means what I get is less than what I want. That means security is overvalued. Sell the security. For suppose if both are same, FR is equal to AR means fair return is equal to actual return. Nothing but CAPM return is equal to actual return. That means correct pricing, hold the security. hold the security. Clear? So do not get confused between these two concepts. One concept is what? Comparing the actual return and CAPM return. Second one is comparing the actual market price and the market price calculated using the CAPM. So how do we calculate market price using CAPM? CAPM return is equal to RF plus RM minus RF into beta. So that is the required return of a security. That's what KE. So we use this KE to find out the price per equity share. How can I find out the price per equity share? P0 is equal to D1 divided by KE minus G. D1 divided by KE minus G. So that market price is called as a theoretical market price or a CAPM market price. See the second comparison. If actual market price is greater than CAPM market price, actual market price is greater than CAPM market price. So that means the security is overvalued. For suppose CAPM market price 100, but the actual market price is 150. What does it mean? As per my theory, the price in the market should be equal to 100, but whereas in the market the price is 150. Okay, so that means overvalued, sell the security. So do not get confused a bit, with before concept, earlier concept. In earlier concept, we are comparing the returns. We are comparing returns. Here we are comparing what? Market prices. For suppose if actual market price is less than CAPM market price, less than CAPM market price. That means what? Undervalued by the security. If both are equal, then it is correctly priced. So example, CAPM market price 100, but actual market price is 50. As per our theory, market price must be equal to 100, but in the market it is available for 50. So buy the security. Simple. If it is overpriced, sell. If it is undervalued, buy. So while comparing the actual return and CAPM return, if you have a confusion, then find out Jensen's alpha. If a Jensen's alpha is a positive, buy. If Jensen's alpha is negative, sell. If it is 0, hold. Okay. Now let us move on to the next concept, arbitrage pricing theory. Sir, what is this arbitrage pricing theory? So arbitrage pricing theory is used an alternative to the CAPM with few modification. It is similar to CAPM with few modification. It is used an alternative to the CAPM. Okay. So CAPM formula helps to calculate the market's expected return. But arbitrage pricing theory uses the risky assets expected return and the risk premium of a number of macroeconomic factors. The second one, that point is important. Nothing but simple, you need not by heart the theory. Simple, this theory is simple, arbitrage pricing theory. What is CAPM return? CAPM return is equal to RF plus RM minus RF into beta. RF plus RM minus RF into beta, yes or no? So what is beta? Beta is a risk factor. RM minus RF is what? Market risk premium. Nothing but we are considering only the market risk premium. Market risk premium. So in CAPM, what is the theory? So the security return is affected by the only market. Security return is affected by the market. But what is arbitrage pricing theory? Arbitrage pricing theory is we are going to consider premium for various macroeconomic factors, not just the market. Not just the market, we are going to what? Consider premium for various macroeconomic factors. What are the various macroeconomic factors? Example, inflation. Inflation is going to affect company return or not as security return. CAPM is simple. Inflation will affect market and market will affect company. So that's why we are considering only market risk premium. But here in this arbitrage pricing theory, we consider a premium for various factors, macroeconomic factors. Example, inflation will affect the security return. GNP will affect the inflation, will affect the security return, yes or no? So the industrial production will affect what? Okay, will affect what? Okay, will affect the security return. Okay, change in interest rates will affect what? Security return. So that's why here we are going to consider premium for each factor, each macroeconomic factor. So that means, see the arbitrage pricing theory formula. CAPM is equal to RF plus RM minus RF into beta. Arbitrage pricing theory is equal to alpha plus beta into risk premium of each factor. So you may not understand the second one. See the third one. Required return is equal to, under arbitrage pricing theory, required return is equal to RF plus factor 1 premium into beta 1. Are you getting my point? we calculate the sensitivity of each factor and we consider premium for each factor. So RF plus F1 beta 1 plus F2 beta 2 and so on. So instead of this factor 1, we may take lambda. Navina. Okay. So required return is equal to RF plus factor 1 beta 1 plus factor 2 beta 2 and so on. So the risk premium is not directly given in the question, then it can be taken as a actual minus expected, taken as difference between actual and expected. So please make a correction. Then it can be taken as a actual minus expected return. So in some questions, risk premium will not be given. If a risk premium is not given in the question, then we should take what? The difference between the actual return and expected return. Are you able to understand this arbitrage pricing theory? Simple method arbitrage pricing theory. We are considering premium for what? Each factor. Okay, you know the meaning of sensitivity. So security is sensitive to various factors, various macroeconomic factors. Like example, in this question, if you see the question number 14, smart 14. So 5 factors are given: GNP, inflation, interest rate, stock market index, industrial production. Beta, sensitivity of all the 5 factors is given. Sensitivity of all the 5 factors. In CAPM, we used to consider only sensitivity of a security with respect to market. But here we are going to consider sensitivity of a security with respect to various factors. So find out the return of the share under arbitrage pricing theory. Simple, RF plus. Without any risk, investor will expect RF. What is RF here? 9.25. 9.25 plus beta 1 into risk premium 1. Here in this question, risk premium is not given. When risk premium is not given in the question, we should take the difference between the actual value and expected value. So 7.7 minus 7.7, that is 0. That is what? 0. Okay. So what is the calculation? Simple. First case, the risk premium 0. Second case, 1.5. Third case, 1.25. Next 2 and a 0.5. So okay, beta into risk premium. So for GNP, the risk premium 0. For inflation, the risk premium is 2.625. What is the meaning of this 1.75? Inflation beta 1.75. For every 1% change in inflation, security return changes by 1.75%. Okay, beta positive means security and inflation moving in same direction. Okay, I'm talking about the information given in the question. Clear? Plus risk free rate. So required return is equal to 17.4%. Is it clear, everybody? Done? Navina, am I clear? Shall we move on to the next question? So next is Super 6. Super 6 means you have to practice this question. You have to practice this question, Super 6. Mr. Nirmal Kumar has categorized all the available stock in the market into following types: small cap growth stock, small cap value stock, large cap growth stock, large cap value stock. Mr. Nirmal Kumar also estimated the weights of the above categories of stocks in the market index. Furthermore, the sensitivity of returns on these categories of a stock to the 3 important factors are estimated to be. So in this question, only 3 important factors are given. Sensitivity of returns on these categories of a stock to the 3 important factors are estimated to be. So categories of a stocks given. So there are 4 categories of a stock: small cap growth, small cap value, large cap growth, large cap value. Small cap means companies with small market capitalization. Okay, how do we get market capitalization? Number of shares into market price per share. Okay, weights of each stock is given: 25%, 10%, 50%, 15%. Factor 1 beta is given. Factor 1 beta. Factor 2 book price sensitivity is also given. This is also a beta. Okay, so what is this 1.39? 1.39 is sensitivity of a small cap growth with respect to book price. So next, inflation. Factor 3 is what? Inflation. Risk premium for each factor is given. Risk premium for each factor is given. 6.85 minus 3.5, 0.65. Done. The rate of a return on a treasury bond is 4.5%. So the rate of a return on a treasury bond is 4.5. That means what? Risk-free rate required. Using arbitrage pricing theory, determine the expected return on the market index. Determine the expected return on a market index. Using CAPM, determine the expected return on a market index. Here the market categorize all the available stock in the market into 4 types. In the market, all the available stocks are categorized into 4 categories. Okay, they are asking you to find out what? Expected return on a market index as per APT, arbitrage pricing theory. What is the second one? CAPM. And next is C part. Mr. Nirmal Kumar wants to construct a portfolio constituting only the small cap and large cap growth stock. If the target beta for the desired portfolio is 1, determine the composition of his portfolio. Determine the composition of his portfolio. Okay, let us start this question. Using arbitrage pricing theory, what? Determine the expected return on the market index. So what is arbitrage pricing theory? We take RF plus what? Beta into factor 1 premium. What is the factor 1 premium? This is the risk premium of a factor 1. This is the risk premium of factor 2. This is the risk premium of factor 3. Nothing but F1, F2, F3. We need beta 1, beta 2, beta 3 of the market. But market is a composition of what? 4 categories of a stocks. Weights are given. So how do I get portfolio beta? I should do weighted average. Yes or no? I should do what? Weighted average. So if I do weighted average, so 25% into 0.8 plus 10% into 0.9 plus 50% into 1.165 plus 15% into 0.85. Then I will get what? Okay, then I will get portfolio beta 1. Clear? Clear? Okay, done. So next, likewise, I will find out the portfolio beta 2 and portfolio beta 3. Clear? Done. So there are 2 ways to calculate. So here, first find out portfolio beta 1, portfolio beta 2, portfolio beta 3. The risk premium is given, yes or no? So RF plus, what is the arbitrage pricing theory return? RF plus F1 beta 1 plus F2 beta 2 plus F3 beta 3. We consider premium for various economic factors, macroeconomic factors. Here in this question there are 3 factors, right? So that means what is the risk-free rate? 4.5. Clear? 4.5 plus what is the factor 1 premium? 6.85 into what is beta 1? Beta 1 is equal to 1. What is the factor 2 premium? Factor 2 premium is negative, minus 3.5 into 2.105 plus 0.65 into 5.8. So the answer is 7.752. So this is the first alternative. Clear? So there is other way to find out. The APT return. What is the other way? What is the alternative? Find out the return as per APT for each category. Find out the return as per APT. Example, small cap growth. What is the risk-free rate for small cap growth rate? 4.5. 4.5 plus, what is the risk premium for factor 1? 6.85 into, what is beta 1 of a small cap growth? Beta 1 of a small cap growth. Beta 1 of a small cap growth already given, 0.8 plus risk premium for factor 2 minus 3.5 into beta 2 of a small cap growth. What is the beta 2 of a small cap growth? Beta 2 of a small cap growth is equal to 1.39 plus, what is the risk premium of factor 3? 0.65 into, what is the beta 3 of small cap growth? 1.35. Very good, Amma. So 4.5 plus 6.85 into 0.8 plus minus 3.5 into 1.39 plus 0.65 into 1.35. So 5.99% is the return as per APT for what? Small cap growth. Likewise, find out for how many? So find out for other 3 and then do weighted average. If you do the weighted average of these 4 returns, you will get 7.752. Here answer is missing. I'm just writing the answer. So what are the weights? 0.25 into 5.99 plus 0.1 into 8.85 plus 0.5 into 8.48 plus 0.15 into 7.53. So the answer is, you will get 7.752. Clear? Okay, if you are starting your preparation after a long gap, you will find difficulty because we are in the middle of the chapter. Okay, so be positive. Clear? If it is CAPM return, simple, RF plus RM minus RF into beta. What is the overall portfolio beta? Overall portfolio beta, we got 1. If it is CAPM return, we consider only one factor, that is normal beta. Yes or no? So what is the normal portfolio beta? 1. So that's why, what is CAPM return? 4.5 plus 6.85 into 1, 11.35. Clear? This is the first alternative. What is the second alternative? Find out the CAPM return in each category. Find out the CAPM return in each category. Each category means we should ignore factor 2 and factor 3. This is a CAPM return. Find out CAPM return in each category and then do weighted average. Clear? See the next one. Third part. Mr. Nirmal Kumar wants to construct a portfolio consisting only the small cap. Consisting only what? Small cap. Consisting only small cap value and large cap growth stock. Okay? If his target beta is 1, if his target portfolio beta is 1, determine the composition of his portfolio. Composition means proportion. They are asking you to find out the proportion of a small cap value and a large cap growth. So what is the beta of a small cap value? 0.9. Beta of a large cap growth? 1.165. Okay, if I invest in these 2 portfolios, these 2 securities, okay, I should, what is my target beta? 1. My target beta is 1. Clear? So simple. My target beta is 1. Let the proportion of small cap value stock is equal to P. So there are 2 stocks in portfolio. We want to construct a portfolio which consists of only 2 stocks. Let us assume the small cap value stock is equal to P. Then the proportion of large cap growth is equal to 1 minus P. How do I get portfolio beta? By doing a weighted average of a security beta. By doing a weighted average of a security beta. Yes or no? So target beta, we know the portfolio beta. What is the portfolio beta? 1 is equal to P into 0.9 plus 1 minus P into 1.165. Clear? So after solving this equation, you will get P 62.26. That means 1 minus P 37.74. So if you want to restrict your beta to 1, you should invest 62.26% of your funds in small cap value, 37.74% in large cap. Clear? Done? So pause the video and practice the question. See the next question, Super 7. This question is also for practice. Either you try this question without listening to my explanation, or if you are not confident, at least listen to my explanation, then pause the video and practice the question every time. Every time you watch the video on YouTube, you pause the video and solve this question, because this is Super 7 question. Super 7 means this is 7th practicing question in portfolio. Mr. X owns a portfolio with the following characteristics. Particulars: security A, security B, risk-free security. Factor 1 sensitivity. Factor 1 sensitivity is given 0.8, 1.5, 0. So sensitivity of a risk-free security with respect to factor 1 is equal to 0. Why? We already know. Okay, we already know. So risk-free security is insensitive. That's why we are calling it as risk-free. Factor 2 sensitivity 0.6, 1.2, 0. Expected return. Security A expected return 15%, security B expected return 20%, security risk-free security return is 10%. Factor 1 sensitivity, factor 2 sensitivity, 2 factors are given. That means this is arbitrage pricing theory. It is assumed that security returns are generated by two-factor model. It is assumed that security returns are generated by a two-factor model, means using arbitrage pricing theory. Okay, these expected returns are generated by using arbitrage pricing theory. Done? Okay. So this question is a practice question. See the first part of the question. What is the first part? This is the first part. For Mr. X has rupees 1 lakh to invest. Mr. X has rupees 1 lakh to invest and sells a short rupees 50,000 of a security B and purchases rupees 1,50,000 of a security A. What is the sensitivity of a Mr. X portfolio to the two factors? This is the first part. First part is a critical, it is tough part. B part is even more tough. If Mr. X borrows rupees 1 lakh at the risk-free rate and invests the amount he borrows along with the original amount of rupees 1 lakh in security A and B in the same proportion as described in part 1, what is the sensitivity of the two factors? What is the sensitivity of the portfolio to the two factors? And next, this is the C. What is the expected return premium of a factor 2? What is the expected return premium of factor 2? First of all, first part question is, what is the sensitivity of a Mr. X portfolio to the two factors? Nothing but they are asking you to find out the sensitivity of a portfolio, nothing but portfolio beta for two factors. Nothing but we should find out factor 1 portfolio beta, factor 2 portfolio beta. How do we get portfolio beta? By doing a weighted average. Yes or no? By doing weighted average. Clear? So we should find out the weights of each security in the portfolio. So read the theory again. Question. If Mr. X has rupees 1 lakh to invest, X is having 1 lakh to invest and sells short. Sells. So here we are going to learn a new term. What is the new term? Sells short. In stock market we have a short selling concept. Sir, what is this short selling? We know the concept of buying the stock. What is this short selling? Short selling means simple. I borrow the security from the broker. For suppose I have an expectation that the price will increase in next 6 months. The price of a security will increase in next 6 months. Okay. So price will decrease. Price will decrease in the next 6 months. So this is my expectation. So price will drastically decrease in next 6 months. Okay. So price of security X. So we have a concept of short selling. What is the short selling? So for suppose the present stock price is 200. My expectation is in next 6 months, the price is going to decrease to 50 rupees. Okay, this is my expectation. So what is the short selling? I approach the broker, stock broker, and I borrow the security X. I borrow security X. I will buy, I'm not going to buy. I'm going to borrow one share from the broker and I will sell in the market. I will sell in the market. How much I am going to receive? 200. Okay. After 6 months, I will buy the stock for rupees 50 and I will give back the stock to the broker. I am just borrowing a share. Nothing but short selling means selling a share without owning it. Selling a share without owning it. Okay, so after 6 months I will buy it for rupees 50 and I can earn a profit of 150. Ignore interest and transaction cost. Okay, so this is my imagination. This is my imagination, but after 6 months price may increase to 300. Then I will lose money. So that is a different scenario. So what is the concept of short selling? Short selling means selling a security without owning it. Okay, so Mr. X has rupees 1 lakh to invest and sells a short rupees 50,000 of a security B. He is not investing in security B. He is selling security B. That means he will be receiving 50,000. Already he has 1 lakh plus 50, 1 lakh 50, and purchases 1 lakh 50,000 rupees worth of a security A. Yes or no? How he is able to buy worth of 1 lakh 50? Simple. Original amount 1 lakh, own money. So 50,000 received on short selling security B is invested in security A. Okay. See the solution. See the solution, first part. What is the original amount? Original amount 1 lakh. So we have a security A, B and risk-free security. In first part of the question, we are not going to invest in risk-free security. So what is actually done? 50,000 sold. So what is the investment made in security A? 1,50,000. So that means what is the weight? First case, what is the weight? 1.5 is the weight. Original amount is 1 lakh, but we made an investment of 1,50,000. That means the proportion of investment in security A is 1.5. But the total of weight shall be equal to 1. The weight of a security B is minus 0.5. The weight of a security B is minus 0.5. Yes or no? Navina, are you able to understand this? Pavani? Clear? Done? So now let us come to the portfolio beta. So they are asking you to find out the sensitivity of a portfolio. Sensitivity of a portfolio for 2 factors. For 2 factors. So let us come to factor 1 beta is equal to 1.5 into what is the weight of security A? 1.5. What is the sensitivity? 0.8. What is the security B sensitivity? 1.5. So 1.5 into 0.8. Yes or no? 1.5 into 0.8 plus minus 0.5 into 1.5. Clear? So what is the sensitivity of a portfolio with respect to factor 1? 0.45. Clear? Now come to factor 2. Factor 2. So 1.5 into 0.6 minus 0.5 into 1.2. Okay. So what is the answer? 0.3. Clear? Are you able to understand? Done? Okay. Now let us come to the second part. First part, are you able to understand? So this question is for practice. If I give this question in next weekend exam, you will not be able to solve it. Be careful. You have to practice this question. Okay, especially in last month. On day before examination, you have to refer. Okay. Next, if Mr. X borrows rupees 1 lakh at the risk-free rate, 1 lakh borrows at risk-free rate, Nothing but we are not investing money in risk-free security. We are borrowing. Nothing but we are selling. We are selling. So that means we receive 1 lakh. And invest the amount he borrows along with the original amount of rupees 1 lakh. Risk-free borrowing 1 lakh. What is the original amount? 1 lakh. Total 2 lakhs. Okay. Invest the amount he borrows along with the original amount of rupees 1 lakh in security A and B in the same proportion as described in part 1. In the same proportion as described in part 1. Nothing but when I have a amount 1 lakh, I have a original amount 1 lakh. So in first part, when I have only 1 lakh, so what I have done is simple. I sold 50,000 rupees worth of a security B and invested 1,50,000 in security A. But now I am having 1 lakh original amount plus risk-free borrowing 1 lakh, overall amount 2 lakhs. Now what I am going to do is, so when I have a 1 lakh, short selling is 50,000. Now I am having 2 lakhs. That means what is the amount of short selling of a security B I am going to do? Simple. Now I am going to short sell security B worth rupees 1 lakh. Are you getting my point? Previously, when I have only 1 lakh, okay, security B short selling amount to 50,000. But now I am having 2 lakhs. So that means double, yes or no? So that means what is the calculation B part? B part. So what is the original amount? 1 lakh. A, B and risk-free. So risk-free investment or risk-free borrowing? Borrowing. That means I receive amount 1 lakh. Okay. So what is the overall amount? Original amount 1 lakh plus this risk-free borrowing 1 lakh. So that's why I will make a short selling of 1 lakh. So total amount. What is the total amount I have? 3 lakhs. Earlier 1,50,000 is invested in security A. But now I will make an investment of 3 lakhs. Clear? So now see the factor 1 beta. So what is the calculation? Now the weights are 3 minus 1 minus 1. Original amount is 1 lakh. But the investment made in security A is 3 lakhs. That means weight 3. So what is the calculation? 3 into 0.8 minus 1 into 1.5 minus 1 into 0. Beta 2 is equal to 3 into 0.6 minus 1 into 1.2 minus 1 into 0. What is the answer first case? First case 1.2. Second case 1.2 first case. I think it is not 1.2. First case it is 3 into 0.8 minus 1.5. 0.9. Second case 0.6. Clear? Are you able to understand second part? Now the third part is even more critical. What is the third part? What is the expected return premium of a factor 2? Expected return premium of a factor 2. So expected return premium of a factor 2. Premium, they are asking premium of a factor 2. So we know beta 1, beta 2. They are asking you to find out what? F2. Premium for factor 2. Okay. So this part is even more critical because let the factor 1 premium is equal to F1. We don't know the premium of factor 1 and premium for factor 2, not given in the question. Let the premium of a factor 1 premium is equal to F1. Let the premium of factor 2 is equal to F2. Okay. In the question they have mentioned, it is assumed that expected returns are generated using two-factor model, that is arbitrage pricing theory. What is arbitrage pricing theory formula? RF plus beta 1 F1 plus beta 2 F2 and so on. Let us form the equations. So we know the expected return of a security A. What is the expected return of a security A? 15%. So that means I can write 15% is equal to 10% risk-free rate, because expected return on a risk-free security is 10%, plus what is the factor 1 beta? 0.8 into factor 1 premium plus factor 2 beta 0.6 into factor 2 F2. Likewise, 20% is equal to 10% plus 1.5 into F1 plus 1.2 into F2. Clear? Okay. I cannot directly, so this is equation number 1, equation number 2. I cannot directly take equation 2 minus 1. Okay. So I should multiply equation 1 with 2. Okay, I should multiply equation 1 with 2. So here the calculation is little clumsy. Okay, I should multiply equation 1 with 2. Nothing but equation 1 into 2 minus equation number 2. Are you getting my point? Okay. So then what happens? This F2 will get cancelled. This F2 will get cancelled. Yes or no? Okay. Are you getting my point? So I'm just writing 15% into 2, nothing but 30 is equal to 20 plus 1.6 F1 plus 1.2 F2. Yes or no? If I multiply equation 1 with 2, next 20 is equal to what? 10 plus 1.5 F1 plus 1.2 F2. So what happens? 10 is equal to 10 plus 0.1 F1. Nothing but F1 I will get 0. F1 I will get 0. Substitute this F1 in either of the equation. Okay? Clear? Substitute this F1 value in either of the equation. For suppose if I substitute F1 value 0 in equation number 1, then I will get 15 is equal to 10 plus 0 plus 0.6 F2. So F2 is equal to 15 minus 10, 5 divided by 0.6, 8.33. So this is, if you substitute in what? Equation number 1. What is the other alternative? Go for equation 2. What is equation 2? 20 is equal to 10 plus 0 plus 1.2 F2. So F2 is equal to 10 divided by 1.2, 8.33. Are you getting my point? Am I clear? So this is the answer. Okay. So this question is for practice. Pause the video and practice this question. So super question means it's like a warning. Unless you practice, you may not be able to solve the question in examination. Practicing all the questions is not a correct approach. Just referring the questions and answers instead of practicing all the questions is also not a correct approach in CA course. Okay, so that's why I categorize the questions into 2, smart and super. Smart question is for refer. You just refer, read the question, guess the answer and see the answer. Okay, super question means read the question and try on your own. If you are not able to understand if you are not able to solve on your own, go through the answer, understand it, and then what again? Either in the evening or immediately solve the question. So try to complete the question within 15 minutes. Okay. Next. So next we have a concept of Sharpe ratio. Okay. In portfolio we have several stages. One of the stages is what? Portfolio evaluation, assessing the performance. So Sharpe ratio, simple. Sharpe ratio means excess return per unit of a total risk, not per unit, per. Excess return per unit of a total risk. Sharpe ratio, excess return per unit of a total risk. Higher the Sharpe ratio, the better it is. Simple. Sharpe ratio is equal to RP minus RF divided by sigma P. Okay. So RP minus RF divided by sigma P, nothing but it is reward to volatility ratio. Reward to volatility. So this is also termed as reward to volatility. Okay. So RP minus RF is reward to volatility. Volatility means what? Risk. Okay. Simple. This is easy to understand. Sharpe ratio. For suppose I'm getting 12% return of a portfolio. My risk-free rate is 8%. Risk-free rate is 8%. Standard deviation of a portfolio is equal to 8%. Standard deviation of portfolio is equal to 8%. Okay. Now, simple to calculate Sharpe ratio, 12 minus 8 divided by what? 8. Understand the numbers. Without any risk, I can earn 8%. Without any risk, I can earn what? 8%. But I am investing in a portfolio which is having a standard deviation of 8. And what is the return I am getting? 12. So what is excess return? 4%. I am getting excess 4% for 8% risk. Nothing but I am getting 0.5% excess return for every 1% of a total risk. So Sharpe ratio here it is 0.5. What is the meaning of this 0.5? 0.5 means excess return for every extra 1% of a total risk. Okay, are you getting my point? Excess return for every, okay, excess return for every 1% of extra risk. So in my example, it is 0.5. For suppose if there is another security, the return is 14, risk-free rate 8, and the standard deviation of that particular security is 4. Then what is the answer? 6 divided by 4, 1.5. So which security am I going to select? First or second? Second one. Because for every extra 1% risk, I am getting excess return of 1.5. So higher the Sharpe ratio, better it is. So trainer's ratio. Trainer's ratio is simple. It indicates excess return per unit of systematic risk. Instead of total risk, we take what? Systematic risk, trainer's ratio. Nothing but RP minus RF divided by beta P. So instead of standard deviation in the denominator, we take what? Systematic risk, that is beta. Simple. Higher the trainer's ratio, better it is. Higher the trainer's ratio, better it is. So let us see the question. Smart 15. Smart 15 means not for practice. The following are the data on a 5 mutual funds. Fund A, B, C, D, E. Return. Standard deviation, beta. You are required to compute reward to volatility ratio. RP minus RF is reward to volatility. Volatility means risk. So Sharpe ratio or trainer's ratio, we also can term it as what? Reward to volatility. Okay. Rank these portfolios using Sharpe method, trainer's method, assuming what? Risk-free rate? 6%. Simple. So how do I get Sharpe ratio? 15 minus 15 is the return on a mutual fund A. Yes or no? 15 minus what is risk-free rate? 6 divided by what? 7. 1.286. This is the Sharpe ratio for mutual fund A. Mutual fund A. What is the trainer's ratio? 15 minus 6 divided by 1.25. 15 minus 6 divided by 1.25. So answer 7.2. Likewise, we should find out for other 4 mutual funds. Rank these portfolios. How do we rank? Higher the Sharpe ratio, higher the trainer's ratio, better it is. That means we give rank 1 to the security which is having a highest Sharpe ratio or a trainer's ratio. Simple. Done? Clear? Next, Smart 16. This question is also for referral. This question is not for what? Practice. Okay. Smart 16. Suppose that economy A is growing rapidly. Economy A is growing rapidly. You are managing a global equity fund so far. So far you are managing a global equity fund. You have so far you have invested only in developed country stocks only. Okay. Economy A is growing rapidly. Nothing but developing economy. But so far you have invested only in developed country stock. Now you have decided to add stocks of economy A to your portfolio. The table below shows the expected rate of a return, standard deviation and correlation coefficient. All estimates, in brackets, all estimates are for aggregate stock market of a developed countries and stock market of a economy A. So the information is not relating to one individual company. It is related to what? Aggregate stock market of a developed countries and stock market of a economy A. particulars, developed country stock, stock of a economy A. Expected rate of a return, annualized percentage 10 and 15. Risk 16 and 30. So you forget about the country. If it is, here the words are what? Like, we are calculating what standard deviation for overall country. So forget about the country, whether it is developing economy or a developed country. So simple, security A, security B. So return and risk are given. Correlation coefficient between developed country stock and economy A, 0.3. Nothing but developed country and developing country, both are moving in same direction but not in same proportion. Clear? Assuming the risk-free rate 3%, you are required to determine first part, what percentage of your portfolio should you allocate to stock of a economy A? If you want to increase the expected rate of a return of your portfolio by 0.5, if you want to increase your expected rate of a return by 0.5, what percentage of a money you should allocate to the stock of a economy A? So I want to increase, if you want to increase your return by 0.5, what is the present? Presently, you are investing only in developed country stock. And what is the return you are generating? You are generating 10%. If you want to increase your return by 0.5, that means what is your target rate of a return? The target rate of a return is 10.5%. Are you getting my point? If you want to increase your return of your portfolio by 0.5, by 0.5 means right now I am getting 10. I want to increase it by 0.5. So that means target rate of return is, what is the target rate of return? 10.5. Very good. 0.5%. Already 10%. 10% plus 0.5%. Okay, so 10.5. It's a simple question. Now, I have to find out the weight. I have to find out what? Weight. So let us assume the proportion of a economy A is equal to P. What is my target portfolio return? 10.5. So let the proportion of economy A is equal to P. Then the proportion of stock of developed country is equal to 1.1 minus P. How do I get portfolio return? How do I get portfolio return? By doing a weighted average of security return. Yes or no? By doing weighted average of a security return. That's why 1 minus P into 10 plus P into 15 is equal to 10.5. Developed country stock return is equal to 10. Developing country 15. Developing economy 15. Clearer? So I can find out P. So P is equal to 10%. 1 minus P is equal to 90%. Nothing but the percentage of portfolio to be allocated to stock of economy A is equal to 10%. The percentage of portfolio to be allocated to stock of economy A, 10%. Clear? Done? Okay. Am I clear? Are you able to understand this? Now, let us move on to the B part. What is the B part? What will be the standard deviation of your portfolio, assuming that stock of economy A are included in the portfolio as calculated above? As calculated above. Okay. So, what will be the standard deviation of your portfolio, assuming that stock of economy A are included in the portfolio as calculated above? Simple. So standard deviation. How do I get standard deviation of portfolio? Here the correlation coefficient is 0.3. That means I should apply the lengthy formula, right? Yes or no? So sigma P is equal to square root of Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy sigma x sigma y sigma xy. So sigma P is equal to square root of, what is the weight of developed country stock? 0.9 square into 0.16. What is the standard deviation of a developed country? What is the risk of a developed country? 16.16 square plus 0.1 weight of a economy A, 0.1 square into standard deviation of economy A 30%, so 0.3 square plus 2 into 0.9 into 0.1 into 0.6 into 0.3 into correlation coefficient 0.3. You will get the answer 15.6%. Clear? Done. So next, this is C part. Okay. So what is the C part? C part is the special point to be referred. C. Also show how well the fund will be compensated for the risk undertaken due to inclusion of stocks of economy A in the portfolio. Also show how. Okay, Navina, this class will be uploaded, no problem. Also show how well the fund will be compensated for the risk undertaken due to inclusion of a stocks of a economy A in the portfolio. Okay, this is special kind of a question. You should write the answer which is expected by ICAI. Okay, you cannot write your own answer. For suppose if I have to write the own answer, what is the question? How well the fund will be compensated for the risk undertaken due to inclusion of a stock of a economy A. See the standard deviation of a stock of a economy A. What is the standard deviation of stock of economy A? 30%. Okay, that means if I am adding stock of economy A means, so nothing but the risk has to increase. The risk has to increase. Yes or no? Right now, what is the standard deviation? Right now, only the amount is invested in stock, developed country stock. What is the risk? 16%. What is the return? 10%. 10% return, 16% risk. But in the revised scenario, the return increased to 10.5 and the risk reduced to 15.6. That is the beauty of a portfolio. Why do we invest in portfolio? We can diversify the risk. Here the risk has got diversified or not. Okay, so the risk of a stock of a economy A is 30%. So generally a layman will be thinking like, if I add the stock of a economy A, as the risk is 30%, okay, the overall risk of a portfolio will increase. But so for a surprise, what happened? The risk of a portfolio decreased to 15.6. So the question is, how well the fund will be compensated for the risk undertaken due to the inclusion of a stock of a economy A. The fund has compensated for the risk undertaken. That's why what happened? The return increased by 0.5 and the risk decreased to 15.6. 15.6. This is my explanation. But in the examination, you have to calculate the Sharpe ratio because they are expecting you to calculate the Sharpe ratio. Okay, whatever the explanation I gave, it is logical and it is correct. But you should write, you should calculate the Sharpe ratio. What is the Sharpe ratio in existing case? If you are investing only in developed country stock, the Sharpe ratio is equal to 10 minus risk-free rate 3 divided by standard deviation 16, 0.437. What is the meaning of this 0.437? Excess return for every 1% of extra risk. If you are including the stock of economy A, then 10.5 return minus risk-free rate 3 divided by standard deviation 15.6, 0.481. So the Sharpe ratio improved by 0.04. So that means the fund is getting compensated for the risk undertaken due to inclusion of a stock of a economy A. So this is the answer you have to write in examination. Even if you give the meaningful justification in the other way, they will not give marks. They will give marks as per the suggested answer. Clear? Done. So this question is for practice or referral. You have to refer this question, especially the third part. Especially third part. Why? They are not asking you to find out the Sharpe ratio. If they ask you to find out Sharpe ratio, you know the Sharpe formula, you calculate Sharpe ratio and you can conclude. That is direct. But the question is different. Question is asked different. How well the fund will be compensated for the risk undertaken due to the inclusion of a stock of a economy A. So find out the Sharpe ratio and write the answer. Okay? Done. Clear? Let us move on to the next concept. What is the next concept? So we are almost reached to the end of the portfolio chapter. So the concepts left are security market line, capital market line, security market line, capital market line, and characteristic line, sharp index model. Sharp index model. The last concept recently asked in examination, January 2026, cutoff and determining the optimum portfolio. Okay. So let us see the security market line. Sir, what is the security market line? You know the straight line equation, right? Straight line equation, y equal to a plus bx. Y equal to a plus bx. So in straight line equation, a and b are constants, x and y are variables. Am I correct? Done. If you see the CAPM return formula, CAPM return is equal to RF plus RM minus RF into beta. RF is constant, RM minus RF is constant, beta is a variable. So from company to company, beta changes. Whenever the beta changes, CAPM return will also change. Okay. So security market line is not the new concept. Security market line is nothing but a graphical representation of a CAPM return. It is a graphical representation of a CAPM. What does it denote? It denotes relationship between security return and beta and security return, beta and security return. Okay, it denotes what? Relationship between beta and security return. So that's why whenever the beta changes, what happens? SML return will also change. SML return is nothing but CAPM return, that's it. Okay, you will get a straight line. If you do the plotting on graph, okay, if you do the plotting, so this is return and this is beta. Okay, if a beta is 0, you will get risk-free return. If a beta is increasing, the return will increase. If a beta increases, what happens? Required return will also increase. Okay. So SML is security market line is nothing but what? The graphical representation of a CAPM return. So SML return is equal to RF plus RM minus RF into beta. Better you write beta on the right side. So y equal to a plus bx. A and b are constants. Here a is RF, b is RM minus RF. It denotes the relationship between what? Systematic risk and security return. Beta and security return. Clear? Okay. So actually in the denominator you can take beta m. Beta of a market is nothing but what? 1. Okay, so that's why we every time not taking what? Beta and okay. So SML return is equal to RF plus RM minus RF into beta. Clear? Now let us come to the capital market line. Sir, what is this capital market line? Simple. Capital market line, it denotes the relationship, it represents the relationship between security return and total risk. Instead of systematic risk, here we take what? Total risk. That's it. Nothing but CML return is equal to, what is the formula? RF plus RM minus RF into, instead of a beta S, you will take a standard deviation of a security divided by standard deviation of a market. Clear? CML return is equal to RF plus RM minus RF into sigma S divided by sigma M. So total risk, security return. SML, beta, security return. Nothing but systematic risk and what? Security return. Are you getting my point? Okay. The only difference is what? Here it is relationship between total risk and security return. In SML, it is relationship between systematic risk and security return. Nothing but in the previous security market line, what is X? Systematic risk. What is Y? Security return. In this case, what is Y? Security return. Remains same. What is X? Total risk. Clear? Sigma S divided by sigma M. Now let us come to the capital market line. Capital market line, it represents relationship between security return and market return. Y remains same, security return. What about X? Market return. X is market return. So characteristic line. Okay. So characteristic line alpha. We have a concept of what? Alpha. So first see this formula. What is return of a security? RS is equal to alpha plus beta into RM. Actually RM should be written in on a right side because RM is X. RM is X. So that's why you better write RM on a right side. So RS is equal to alpha plus beta into RM. Because characteristic line represents the relationship between security return and market return. Am I clear? Done? Clear? So return of a security is equal to alpha plus beta into RM. So in this case what alpha is a constant, beta is a constant and RM is variable. So whenever the RM changes, return of a security will also change. Okay, clear? So what is alpha here? Alpha is a portion of a return of a security which does not depend on a market. That's why it is a constant. It is a portion of a return from the security that does not depend on a market. RS is return of a security, RM means risk of a market. So how can I find out alpha? So in questions generally we find out alpha. So they will ask you to determine the characteristic line, derive the characteristic line. So how do I find out alpha? Simple, alpha is equal to RS minus RM into beta, beta into RM. Yes or no? Clear? Okay. So characteristic line alpha, it is also called as sharp index alpha. Jensen's alpha is different. How do I get Jensen's alpha? Jensen's alpha is equal to actual return minus CAPM return. So see the difference between the Jensen's alpha and this characteristic line alpha. The Jensen's alpha is what? Actual return minus CAPM return. Yes or no? How do I get CAPM return? RF plus RM minus RF into beta. Yes or no? But here characteristic line alpha is what? Actual return minus RM into beta. In one question we calculated expected return. Do you remember? Risk free rate is not given. Then how we calculated expected return? Simply we multiplied the market return with beta. Yes or no? So instead of CAPM return, what we are taking is RM into beta. So this is characteristic line alpha. Are you able to understand the difference between Jensen's alpha and characteristic line alpha? Okay, clear? Done. So nothing but alpha is equal to RS minus RM into beta. So if it is Jensen's alpha, then what? RS minus return of a security minus CAPM return, RF plus RF minus into beta. Okay, done. Clear? Now let us move on to the questions. Question number 17. Question number 17. So this is a smart question, not for practice. You need not practice this question. Okay, let us see the question. The rates of return on the security of a company X and market portfolio for 10 periods are given below. For 10 years, return of a security X is given. Return on a market portfolio is given. Very good. So they are asking what is the beta of a security X. Can I find out the security beta? How do I get security beta? Covariance of S comma M divided by sigma M square. Am I correct? Yes or no? So smart 17. First I should have find out what? Beta. Return of a security is given, return of a market is also given. So how can I find out beta? What is the formula of beta? A part. Beta is equal to covariance of S comma M divided by sigma M square. So first part I can find out what? Sigma M square. How can I find out sigma M square? What are the columns? M bar, M minus M bar. Probability is not given, yes or no? So clear? Okay, so we already know the concept. How can I find out covariance of S comma M? S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. If you want, you can add what here. Clear? Done? So we already know we can find out beta. So instead of calculating beta, let us see the answer here. What is the beta? 0.505. Clear? Okay. What is S bar? 15. Nothing but return of a security. What is M bar? 12. Remember these numbers. We know beta, return of security. Beta 0.505, return of a security 15, return of a market 12%. See the second part of the question. What is the characteristic line for security X? What is the characteristic line? So what is the characteristic line formula? I mean equation. Characteristic line is equal to alpha plus, yeah. In this question also you have to refer B part only. Okay. So they're asking you to determine the characteristic line. Nothing but you have to derive the characteristic line. I know beta, I know RM, I know return of a security, but I do not have an idea about alpha. Okay. So characteristic line, nothing but left hand side is return of a security. RS is equal to, what is RS? 15 is equal to alpha plus into 12. So beta positive, yes or no? Positive or negative beta? Beta is positive. Clear? Now let us find out the alpha. What is alpha? 8.94% is alpha. This is the portion of a security return which is not dependent on a market. Clear? Done? Okay. So characteristic line, we have to derive the characteristic line. So characteristic line is equal to, okay, characteristic line is equal to alpha is a constant, yes or no? So 8.94 plus beta is also constant, 0.505 into RM. Nothing but characteristic line RS, return of a security, is equal to alpha 8.94 plus 0.505 into RM. We should write RM. Why we should write RM? So in next scenario RM changes. Whenever RM changes, return of a security will also change. But alpha and beta are constants. Clear? Done? Okay. Let us move on to the next question. Smart 18. Assuming that shares of ABC Limited and XYZ Limited are correctly priced according to capital asset pricing model, the expected return from the beta of these shares are as follows. Expected return and beta is given. Share ABC XYZ beta expected return. You are required to derive security market line. We are required to derive security market line. So to derive security market line, we have to find out what RF and also what RM minus RF. Okay. Clear? In security market line, RF is constant, RM minus RF is also constant. Yes or no? What is the expected return first case? SML is nothing but CAPM return. So 19.8 is equal to RF plus RM minus RF into 1.2. So this is equation number 1. RF and RM minus RF are constant. So that's why I write RF. I will not write RF1, RF2. Next. 17.1% is equal to RF plus RM minus RF into 0.9. Equation number 2. So equation 1 minus 2. I can find out what? RF will get cancelled. I can find out what? RM minus RF. Am I correct? So RM minus RF is 9%. RF 9%. RM is equal to what? 18%. They are asking you to derive the security market line. So derive. So what should I write? Security market line SML is equal to RF risk free rate 9 plus 18 minus 9 into beta. Because RF is constant, RM minus RF is constant. So that's why we write numbers. SML return is equal to 9 plus 18 minus 9 into beta. Done? Clear? Okay. Next. Let us move on to the next question. 19th question. Expected return on two stocks for particular market returns are given in the following table. Two stocks information is given. Market return is given 7 and 25. Aggressive stock return 440. Defensive stock 9 and 18. returns are given. Expected returns on 2 stocks and also what? Market. You are required to find out the beta for the 2 stocks. Beta for the 2 stocks. Simple. Here 2 possible returns are given. 2 possible returns. When only 2 possible returns are given in the question, how do I find out the beta? First one, change in security return divided by change in market return. That means 40 minus 4 divided by 25 minus 7. 36 divided by 18. So first case I will get beta 2. First case I will get beta 2. Second case beta 0.5. Why 0.5? 18 minus 9. 9 divided by 18. 0.5. Is it clear first part? Done. Let us come to the next one. Expected return of each stock. They are asking you to find out the expected return of each stock. If the market return is equally likely to be 7 or 25. Market return is equally likely to be means what? Weights are same. Equally likely to be 7% or 25%. That means 50% chance that we may get 7, 50% chance that we may get 25. Yes or no? So nothing but we should go for simple average. So the question is they are asking expected return on each stock. How do I get expected return of aggressive stock? 4 plus 40 divided by 2. Yes or no? 4 plus 40 divided by 2. I will get 22. Second case, 9 plus 18 divided by 2. 13.5. Clear? Next. Security market line. Calculate security market line. If they ask you to calculate security market line, calculate, not derive, then what? You should calculate SML return. You should calculate SML return, CAPM return. Risk-free rate 7.5. Market return is equally likely to be 7 or 25. So that means RM is equal to 7 plus 25 divided by 2. 7 plus 25 divided by 2. Okay, 16. Okay, clear? So how do I get SML return? SML return is equal to RF plus RM minus RF into beta. So for aggressive stock, SML is equal to 7.5 plus 7.5 plus 16 minus 7.5 into 2. So 24.5. Defensive 7.5 plus 16 minus 7.5 into 0.5. So the answer is 11.75. Clear? Done? Okay. So next, alpha of the 2 stocks. Alpha of the 2 stocks. So here question is not clear whether it is Jensen's alpha or a characteristic line. So that's why you have to remember this point. They are expecting you to find out the characteristic line alpha. Okay, for 2 stocks. For 2 stocks. For aggressive, return of a security is equal to alpha plus beta into RM. We know the return of a security. What is the return of a security? 22 plus alpha. So return of security 22 is equal to alpha plus, we know beta, 2 into RM, 16. So alpha minus 10. This is for aggressive. For defensive, 13.5 is equal to alpha plus 0.5 into 16. So what is alpha? 5.5. So generally alpha should be constant. But here the question framing is not that correct. Okay, so that's why we got 2 different alphas, minus 10 and 5.5. Clear? You're done? Okay. So we are moving on to the last but one concept, that is sharp index model. Sharp index model. Okay. So this is one of the most important topic in portfolio management. Clear? So next concept, sharp index model. So you know the Markovitch theory, modern portfolio theory. What is the Markovitch modern portfolio theory? Sigma p, standard deviation of portfolio, is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma xy. When there are 2 securities. But when there are 3 securities, then what? The formula will be similar to a plus b plus c whole square. So this is the modern portfolio theory, Markovitch. If they ask you to apply the modern portfolio theory, then you have to apply this formula. Okay, Markovitch theory. So we have not derived this formula in revision class. In regular class, generally we derive the formula. Okay. So now, sharp index model. So we know that total risk is equal to systematic risk plus unsystematic risk. Unsystematic risk is also called as a residual variance. Here we follow the variance approach. Residual variance. Why it is called as residual variance? Because total risk minus systematic risk is equal to unsystematic risk. So whatever the left out, residual means what? Left out. So total risk minus systematic risk. The left out part is unsystematic risk, nothing but residual variance. So be careful, in questions they will ask you to calculate residual variance. Residual variance means nothing but what? Unsystematic risk. Very good. Now the risk of a security. So first we are talking about risk of a security. Systematic risk. Sir, how do we calculate systematic risk? Till now I told you beta denotes systematic risk. Yes or no? Beta denotes systematic risk. So for suppose I take beta. Beta denotes what? Systematic risk. Okay. Total risk is what? Standard deviation. Okay. Based on the past discussion, so beta of a security is nothing but beta S, systematic risk. So then unsystematic risk is equal to what? Total risk, standard deviation minus what? Systematic risk. But so at least 2 to 3 times I told you, stress the point that beta is a ratio. Beta is not a percentage, beta is a ratio. But what about standard deviation? Standard deviation is a percentage. Yes or no? So how can I reduce a ratio from a percentage? I cannot reduce ratio from a percentage. So that's why what should I do? I should convert this ratio into a percentage. I should convert this ratio into a percentage. For suppose beta 2. Change in market, change in security. Let us assume beta is equal to 2. Beta is equal to 2. What is the meaning of that? For suppose if a market changes by 10, security changes by what? 20. How I am getting this 20? Beta into change in market. Yes or no? Nothing but I should convert this beta ratio into a percentage. To convert this ratio into a percentage, I should multiply with what? Standard deviation of a market. 2 times means what? 2 times of the market, right? 2 times means what? 2 times of the market. So that's why to convert this ratio into a percentage, I should take what? I should multiply with what? Standard deviation of a market. Yes or no? So here we are following what? Variance approach. Variance approach. Variance approach means what? Square. Instead of standard deviation we should take square. So that means what is my systematic risk? I cannot make my systematic risk is equal to beta S. I should convert it into a percentage. So that's a beta S into sigma M. It is a variance approach. So that's why beta S square into sigma M square. Clear? So systematic risk beta S square into sigma M square. Unsystematic risk sigma S square minus beta S square into sigma M square. Risk of a portfolio. Let us come to the risk of a portfolio. Simple. Risk of a portfolio means instead of security I will take beta of a portfolio. So beta S square, beta P square into sigma M square. Beta P square into sigma M square. And next unsystematic risk is equal to sigma P square total risk minus beta P square sigma M square. So unsystematic risk is also called as what? Residual variance. Residual variance. So and we have a other formula. High chances of forgetting this other formula. What is that other formula? Wx square unsystematic risk of x plus Wy square unsystematic risk of a y and so on. So this unsystematic risk can also be termed as random error in a question. If they mention random error in the question, that means what? That is unsystematic risk. High chances of forgetting the second formula. What is that second one? Wx square unsystematic risk x plus Wy square unsystematic risk y and so on. Nothing but if you break the Markovitch modern portfolio theory, then you will get this sharp index model formula. Okay, but no time, so you need not think about the derivation. So right now at this stage, clear? So some students might get a doubt if you have a deep thinking, if you want to deep learn. Sir, you told that unsystematic risk can be diversified. We have to consider a correlation coefficient. To find out sigma p, we cannot directly do a weighted average of a security risk. Then why you are taking a weighted average of a unsystematic risk here? Okay. So if you observe closely, I am not doing a weighted average. So weighted average means what? Wx into unsystematic risk of x. But here I am taking what? Wx square. Okay, so this is not a weighted average of a unsystematic risk of a various securities. Okay, so clear. So Wx square unsystematic risk of x plus Wy square unsystematic risk of y, and so on. And so on. Am I clear? So high chances of forgetting this formula, be careful. Now, let us come to the Super 8 question. Following are the details of a portfolio consisting of 3 shares. This is a past examination question. Share ABC, portfolio weight 0.22, 0.5, 0.3, beta, expected return in percentage, total variance. Total variance is given 0.015, 0.025, 0.1. Standard deviation of a market portfolio return is equal to 10%. You are given in the following additional data: covariance of A comma B, covariance of A comma C, covariance of a B comma C. Calculate the following. Portfolio beta. So that is simple. How do I get portfolio beta? 0.2 into 0.4 plus 0.5 into 0.5 plus 0.3 into 1.1. Clear? So what is the answer I am getting? 0.66. This is the beta of a portfolio. Clear? What is the second part? Residual variance of each of the 3 shares. Residual variance means nothing but what? Unsystematic risk. How do I get unsystematic risk? Total variance minus systematic risk. How do I get systematic risk? Beta s square into sigma m square. Clear? Okay. Here, do not convert this 0.015 into a percentage. If you convert this 0.015 into a percentage, high chances of doing a clerical mistake. Why, sir? Simple. So generally, you multiply with 100 to convert this number into a percentage, yes or no? So 0.015 into 100, you will get 1.5. Okay, which is not correct. To convert the variance into a percentage, we should multiply with 10,000. Because variance is a standard square of a standard deviation. So that's why you should multiply with what? 10,000, 100 square. So that means if you are converting this 0.015 into a percentage, you should multiply with into 100 into 100. You will get 150. But if it is a standard deviation, then you have to multiply with 100. Because standard deviation is root of a variance. Variance is the square of a standard deviation. So that's why multiply with 10,000. So that's why what I would recommend is ignore percentages, just take 0.015. So let us find out what residual variance. So I'm writing the calculation. How do I get residual variance? Total variance 0.015 minus systematic risk. How do I get systematic risk? Beta square 0.4 square into sigma m square. What is sigma m? 0.1. So 0.1 square. Yes or no? Standard deviation of market portfolio is 10%. So I should write 10% as 0.1. Clear? Are you getting my point? So this 0.0016 is systematic risk. So total variance minus systematic risk is equal to unsystematic risk 0.0134. Am I clear? Done? Are you able to understand? Now, likewise, I should find out for other 2 securities. I should find out for what? Other 2 securities. Am I clear? Done? Next, portfolio variance using Sharpe index model. Portfolio variance using Sharpe index model. Sharpe index model. So how can I find out the portfolio variance using Sharpe index model? Portfolio variance. Systematic variance plus unsystematic variance. How can I find out the portfolio variance? Systematic risk plus unsystematic variance. Simple. Systematic risk of a portfolio. We know the beta of a portfolio. What is the beta of portfolio? 0.66. So systematic risk of a portfolio is equal to 0.66 square into sigma m square, 0.1 square. This is the systematic risk. Clear? How can I find out the unsystematic risk of a portfolio? I told you high chances of forgetting the second formula. First one is sigma p square minus beta p square into sigma m square, but I do not know sigma p square. Okay, but I know unsystematic risk of A, B and C. So I can find out what unsystematic risk of a portfolio. So unsystematic risk of portfolio is equal to WA square unsystematic risk of A plus WB square unsystematic risk of B plus WC square unsystematic risk of a C. Clear? So this is the unsystematic risk, and total variance is equal to systematic risk plus unsystematic risk. This is the answer, 0.018428. Done. What is the last part? Portfolio variance using Markovitch. So there are three securities. There are three securities means covariance of, here correlation coefficient is not given, covariance is given. Covariance of A comma B, A comma C and B comma C. So what is the formula I should apply? Portfolio variance using Markovitch theory. Sigma P square is equal to A square plus B square plus C square. WA square sigma A square plus WB square sigma B square plus WC square sigma C square plus 2WA WB covariance of a comma B plus 2WB WC covariance of a B comma C plus 2WC WA covariance of a comma C. So the answer is 0.03625. Clear? Done. Are you getting my point? Are you able to understand? Okay. Let us move on to the next question. Super 9. Pause the video and practice the previous question. Next, Super 9. The returns on a stock A and market portfolio for a period of 6 years are as follows. 6 years data is given. You are required to determine the characteristic line for stock A. And the second part, the systematic and unsystematic risk of a stock A. So systematic risk of a stock A. How can I find out systematic risk of a stock A? Beta S square into sigma M square. So to determine the characteristic line, I want beta. I want S bar, M bar and beta. Then I can find out alpha. Yes or no? We have seen in one question. Okay. So characteristic line for stock A. Characteristic line for stock A. So to find out the characteristic line, to determine the characteristic line of a stock A, first I should find out what beta. While I finding out beta, anyway I will find out what S bar and also what M bar. Okay, clear? Okay. So how can I find out systematic risk? Systematic risk is equal to beta S square into sigma M square. And what about unsystematic risk? How can I get unsystematic risk? Total variance minus systematic risk. So that means I want sigma S square also. I have to find out what? Sigma S square. So written on a is given. I can find out what sigma S square. So I'm writing the steps. You note down the steps and pause the video and solve this question. Be careful. Generally to find out beta, we start with sigma M square. Yes or no? And later on we find out what covariance of S comma M. But here start with sigma S square. Why? Because to find out unsystematic risk, we want total variance of a security. So what are the columns we should take? S, S bar, S minus S bar. This will be the working note 1. Clear? Next, come to working note 2. Sigma M square. M, M bar. So please note down the columns, follow this approach only. M minus M bar whole square. Now come to working note 3. Covariance of S comma M. Generally covariance of S comma M, we used to start from S, S bar, S minus S bar. But now S and S bar are not required. Why? Already S minus S bar is available in working note 1. So start with clear? Done. So working note 1 and working note 3. And next what? Working note 4. Find out beta. So I'm not calculating. Let us write down the answers. What is the variance? 497. Sorry, 82.889. This is the variance. What is the answer? 82.889. Next, see the variance of market. What is the variance of market? 40.146. Next, covariance of S, comma M. 48.25. Clear? 48.25. Now we can find out beta. 48.25 divided by 40.146. Yes or no? So beta we got 1.2019. Now let us come to the main answer. Okay. So what is the characteristic line? Characteristic line, return of security is equal to alpha plus beta into RM. Return of a security is nothing but what? S bar. S bar, A bar. So what is A bar here? 6.33. 6.33. What is M bar? 5.75. So 6.33 is equal to alpha plus beta 1.2019 into M bar 5.75. You can find out what? Alpha. Clear? Done. So alpha we are getting minus 0.58 minus 0.58. So now what is the equation? Characteristic line, return of security is equal to minus 58 plus 1.202 into Rn. So this is the characteristic line, first part. Now come to the B part. B part, what is the B part? Systematic risk. So systematic risk is equal to beta square. What is beta? 1.202 square into sigma m. What is the sigma m square? 40.146. So this is the systematic risk. Clear? What? 58. Unsystematic risk is equal to total risk. What is the total risk? 82.889 total variance. 82.889 minus 58. 24.88. So in last minute, this is how you have to prepare. Am I calculating sigma s square? No. Am I calculating sigma m square? No. Am I calculating covariance of S comma m? No. So I am calculating what is important. Okay. Clear? Done. So let us move on to the next question. Super 10. A study by mutual fund has revealed the following data in respect of three securities. In respect of three securities, this is the following data available. Security A, B and C, standard deviation 20, 18 and 12, correlation with index. Correlation with index. Nothing but what is given? Correlation with index means this is sigma A comma M. Correlation coefficient of a security A and market. So this is what? Sigma BM. This is sigma CM. The standard deviation of a market portfolio is observed to be, standard deviation of market is what? 15%. Clear? Now, what is the sensitivity of a return of each stock with respect to the market? Sensitivity of a return of each stock with respect to market. How can I find out the sensitivity? Sensitivity means beta. Sensitivity of each stock with respect to the market means nothing but beta. So they are asking you to find out beta of A, beta of a B and beta of a C. Simple. How can I find out? I can apply the third formula, that is sigma A comma M into sigma A divided by sigma M. What is sigma A comma M? 0.6 into sigma A 20 divided by what? 15. So this we already know, yes or no? So beta 0.8, 1.14, 0.6. So this is not a special point in this question. In this question, special point is second part. What are the covariance among the various stocks? They are asking you to find out the covariance among various stocks. Okay. How can I find out the covariance among various stocks? So, to find out the covariance among various stocks, nothing but I want covariance of A comma B. Likewise, covariance of A comma C and covariance of B comma C. How can I find out covariance of A comma B? So, one first approach we have learned is take A minus A bar, B minus B bar, A minus A bar into B minus B bar. But that information is not given. A is not given in the question. So, we cannot find out A bar and all. What is the second formula we can use? Sigma A, sigma B, sigma AB. Sigma A, sigma B, sigma AB. So, sigma A is given in the question. Sigma B is also given in the question. What about sigma AB? Correlation of security A and B is not given. Correlation of security A and market is given. So, that's why I cannot apply this formula. So, there is another formula which you might forget, high chances of forgetting the formula. Covariance of A comma B. In this question, this is a special point. High chances of forgetting this formula. Beta A, beta B, sigma m square. So, okay. So, let me tell you the logic. What is the beta A formula? Covariance of A comma m divided by sigma m square. Sigma m square. Sigma m square. Yes or no? Okay. Sigma m square and sigma m square will get cancelled. What is left in the denominator? M minus m bar whole square. In the numerator, A minus A bar into M minus M bar into B minus B bar into M minus M bar. Yes or no? I can cancel this or not? Sigma m square means nothing but M minus M bar square. Okay. So, what is left? Covariance of A comma B. Clear? So, covariance of A comma B is equal to beta A, beta B, sigma m square. So, this is a covariance matrix. Covariance matrix. See the covariance matrix. Covariance of A with A. Covariance of A with A is nothing but variance of a A. Yes or no? Covariance of A with A means what? A minus A bar into A minus A bar. Nothing but A minus A bar whole square. Nothing but what? Variance of a security A. What is the standard deviation of A? See the question 20. So 20 square, 400. 400 is the covariance of a with A. Are you getting my point? Covariance of B with B. Again, covariance of B with B means what? Variance of B. Covariance of C with C means what? Covariance of C with C means nothing but sigma C square, nothing but 12 square, 144. Now come to covariance of A comma B. How do I get covariance of A comma B? Covariance of A comma B is equal to beta A, beta B, sigma m square. Beta A 0.8, beta B 1.14 into sigma m square. So the answer is 205.2. That is what I am writing here. Clear? Covariance of A with B. Clear? Next, covariance of A with C. Covariance of A with C means beta A, beta C, sigma m square. So the answer is 108. Clear? Next, covariance of B with C. Covariance of B with C means beta B, beta C, sigma m square. Clear? Done. So covariance matrix. This is a special point in this question. Done. Next, move on to the next one. What would be the risk of a portfolio consisting of all the three stocks equally? Consisting of all the three stocks equally. Simple. We should find out the risk of a portfolio consisting of all the three stocks equally. Weights are equal. Three stocks. What is the formula we apply? Sigma P is equal to square root of A square plus B square plus 2AB 2BC. That formula. But here covariance is available. So that's why we take what? 2 WA, WB, covariance of A comma B. Covariance of A comma B calculated in second part. Okay? Clear? So apply this formula, you will get 14.15 standard deviation. But what is the variance? 200. Variance is equal to 200. Done. Next, what is the beta of the portfolio consisting of equal investment in each stock? Beta of a portfolio means what? Simple, we do weighted average of security beta. Here the weights are equal. Weights are equal means we do a simple average. So 0.8 plus 1.14 plus 0.6 divided by 3. 0.8467. Clear? Next, E part. Next what? E. What is E part? What is the total systematic and unsystematic risk of a portfolio? They are asking you to find out the systematic risk and unsystematic risk. Simple. How do I get systematic risk? Beta S square into sigma M square. I know the overall beta 0.8467. Beta of a portfolio is equal to 0.8467 square into what? Sigma M square. 161.302 is the systematic risk. Okay. How do I calculate unsystematic risk? Unsystematic risk is equal to total risk, total variance. Total variance already calculated in third part. In third part, what was the total variance? 200.244 minus what? Clear? Unsystematic risk is equal to total variance minus systematic risk. So 200 minus 161. So the answer is 38.942. Clear? So total risk is 200.244. Clear? Are you able to understand? So this is also a past examination question. So be careful. So practice. Pause the video and practice. Next, let us move on to the next question. An investor is, after discussing two questions, let us have a break, and then later on I will discuss cutoff and optimum portfolio question. Super 11. An investor is proposing to invest 10,000 in two portfolios A and B in the ratio of 3:2. The portfolio have three securities, each with following weights. How many securities? 3. Okay. So two portfolios. In suggested answer also there was a wrong framing. So an investor is proposing to invest rupees 10,000 into portfolio X and Y in the ratio of 3:2. The portfolio have three securities, each with the following weights. Portfolio X, how the investment is made? So better we take this as A and B. Let me change the question. X, Y, Z. So this is how the questions are given in ICAI. Okay. So mistake is given in the question. So students will get automatically confused, right? So 10,000 invested in portfolio A and B in the ratio of 3:2. That means 6,000 in A and 4,000 in what? B. The portfolio have a three securities, each with following weights. Portfolio A contains X, Y and Z. How the investment is made? 0.3, 0.25, 0.45. Portfolio B 0.2, 0.45, 0.35. You are required to calculate the weight of each stock. So we are required to calculate the weight of each stock. First part is simple. What is the investment made in A? 6,000. And what? 4,000. And again this 6,000 is invested in X, Y and Z in the ratio of 0.3, 0.25, 0.45. Nothing but 1,800, 1,500 and 2,700. Next 4,000 is invested in X in the ratio of 0.2. 800, 1,800, 1,400. That means overall investment made in X, security X. What is the overall investment made in X? 2,600. And next 3,300. And next 4,100. The question is, find out the weight of each stock. Simple. Out of 10,000, we invested 2,600 in A, sorry, X. X. So what is the weight? 0.26. What about Y? 0.33 and Z 0.41. Clear? Are you able to understand? 0.26, 0.33, 0.41. See the second part. Calculate the amount allocated to Y and Z. If half of the funds are allocated to security X, why the investment is made like this? That means why the investment is made in the ratio of 0.26, 33 and 41. So this might be the minimum risk portfolio. Yes or no? So that's why investor will be investing in the same ratio. So what is the amount allocated to security X? Amount allocated to security X is equal to half out of 10,000. 5,000 allocated to security X. What is the remaining balance? 5,000. Okay. How this 5,000 is invested? Simple. Right now the investment is made in the ratio of 26, 33 and 41. Why the investment is made only in this ratio? This might be the minimum risk portfolio. This might be the minimum risk. So that's why obviously what? So I will be making the remaining balance investment in Y and Z in the same ratio. That is what? 33 is to 41. Balance amount allocated between Y and Z in the ratio of 33, 41. So that means what is the investment? 5,000 into 0.33 divided by 0.74, 2230. So Z 5,000 into 0.41 divided by 0.74, 2770. So this is a past examination question. Two alternatives are given, but I have given the simple alternative in the question bank. If you see the CA final, this is the past exam question. You will find a similar question in study material, okay, where the weights, here weights are same. In portfolio A and B, the weight of a Z is not same, 0.45 and 0.35. But in CA final study material question, you will find the weight 0.3 in both the cases. Okay, go through the CA final study material question also. So follow the second alternative. That is simple. Clear? Done? Okay. Now let us move on to the next question. Super 12. A portfolio having following features: security B, security beta, random error, weight. Weights are given. So ICAI study material question number 37. Question number 37. See the question, Super 12. Security L, M and K, beta, random error. I already told you random error means unsystematic risk. So be careful, you have to observe this one. Sigma. Sigma. Deviation is given, not the variance. So if I want the unsystematic variance, I should take the square of 7. Why? Because in next question, if you see here, sigma square is given. So in next question, unsystematic variance is given, but in this question, unsystematic deviation is given. So what is the question? Beta is given, unsystematic deviation is given, weights are given, 4 securities. You are required to find out the risk of a portfolio if the standard deviation of the market is 18%. A simple question. First, let us find out the portfolio beta. So what is the portfolio beta? 0.25 into 1.6 plus 0.3 into 1.15 plus 0.25 into 1.4 plus 2.2 into 1. So the answer is 1.295. So this is the portfolio beta. The question is, they are asking you to find out the risk of a portfolio, overall risk of a portfolio. Okay. First, let us find out the systematic risk. How do I get systematic risk? Systematic risk is equal to beta p square into sigma m square. What is beta p? 1.295 square into sigma m 18 square. So okay. So this is the systematic risk. 1.295 square into sigma m square. So what is the answer? 1.295 square into 18 square. Systematic risk. 1.295 square into 18 square. Clear? Answer. 543.35. But the question is total risk. Understand, total risk is equal to, I'm writing the formula, beta p square into sigma m square. What is this beta p square into sigma m square? Systematic risk of a portfolio. So the question is, they are asking you to find out the total risk. We are using the Sharpe index model. Beta p square into sigma m square, systematic risk plus. How do I get unsystematic risk of a portfolio? Unsystematic risk of portfolio, second formula. What is unsystematic risk of portfolio? Second formula, WA square. Unsystematic risk of A plus WB square. Unsystematic risk of B. WC square. Unsystematic risk of C. WD square. Unsystematic risk of a D. Here my answer is 543.35 plus, what is the weight of A? 0.25 square into 7 square. Why 7 square? Unsystematic deviation is given, but I should take unsystematic variance plus, what is the next weight? What is the next weight? 0.3 square into what? Random error 11 square. 0.25 square into 3 square plus 0.2 square into 9 square. So what is the answer? Okay, so you will get the answer. Okay, so if you take the square root, then you will get what? Standard deviation. Standard deviation 23 point, sigma p is equal to 23.69. What is sigma p square? 561.115. Clear? Done. Okay, so in the next session I will discuss the last question, and in PDF you will find the additional questions, smart and super, and again in additional you will find smart and super. So that is the same kind of a questions with the special points. Okay, after completing the class you go through those additional questions also. Clear? Thank you. See the last question which I am going to explain in this class, in this session. Sharpe optimization model. So this is one of the toughest concept in AFM, entire AFM. Okay, so I will try my level best to make it simple. Sharpe optimization model. This question was tested in January 2026. Okay, so this is a super question. You have to practice this question. So after listening to my explanation, please do practice this question. Okay, and thereafter I will give you an additional questions list, that is 5 questions or 6 questions, and I will mention which is a super question and smart question. So without fail, practice those questions also. Okay, practice or refer, so whichever. Okay, so let us start this question without wasting time. Ramesh wants to invest in stock market. He has got the following information about individual securities. Security A to F, expected return is given, beta is given, sigma square CI. Sigma square CI means it is an unsystematic variance. In previous question, random error sigma EI, so that is unsystematic deviation. So this is unsystematic variance. So be careful. So random error means unsystematic deviation. Okay, and specifically mentioned sigma, so that's why it is deviation. Otherwise what we can, if it is sigma square, we should consider it as a variance, unsystematic variance. Market index variance is 10%. Market index variance is 10%. That means sigma m square. Sigma m square. The risk-free rate of a return is 7%. What should be the optimum portfolio assuming no short sales? What should be the optimum portfolio assuming no short sales? In January 2026, first they asked you to find out the trainer's ratio. Second, they asked you to find out the cutoff point. And then what? They asked you to determine the weights for optimum portfolio. But here directly they are asking you to, okay, to find out the optimum portfolio. What are the proportions of a securities to make it an optimum portfolio? Optimum means best. Okay, but to find out the optimum portfolio, first we should find out the trainer's ratio, then cutoff point, and then we can find out the proportions for optimum portfolio. Okay, so we already know the trainer's ratio. How to find out the trainer's ratio? So what is the formula for trainer's ratio? RP minus RF divided by beta. RP minus RF divided by beta. Yes or no? So question number super 13, right? Super 13. So what is the first step? Trainer's ratio and ranking. Trainers ratio and ranking. Okay. So columns: security, trainers ratio, and next what? Ranking. Security A, B, C, D, E and F. So what is the trainers ratio formula? RP minus RF divided by beta. It denotes excess return per each unit of a systematic risk. Okay. So trainers ratio, first case, 15 minus 7 risk free rate divided by beta 1.5, 5.33. Second case, 12 minus 7 divided by 2, 2.5. Third case, 10 minus 7 divided by 2.5, 1.2. Next, 9 minus 1, so 9 minus 7 divided by 1, so it is 2. Next, 8 minus 7 divided by 1.2, 0.833. Next, 14 minus 7 divided by 1.5, 4.667. So tell me, first rank, higher the trainers ratio, better it is, yes or no? So first rank goes to A, rank 2 goes to F, and rank 3 goes to B, and rank 4 goes to D, rank 5 goes to C, and rank 6 goes to E. So this is simple. This is the known part, calculation of trainers ratio and ranking, yes or no? Now come to the critical part, B part. B part, I will try my maximum. I will put my maximum efforts to make it simple. B, calculation of cutoff point. Calculation of a cutoff point. So what is this cutoff point and how to find out the proportions for optimum portfolio? So this is a sharp optimization model. Sharp. If you see the trainers ratio, we are considering only systematic risk. We are considering only systematic risk. We are taking into consideration only systematic risk. So this is the order of making investment. First you should make investment in security A, and then if you have a money, go for what? F, and then B. Yes or no? Okay. But here we are not considering what? Unsystematic risk. Unsystematic risk which can be diversified. If you see this, F unsystematic risk is what? 30, whereas A unsystematic risk is 40. If you are taking into consideration only systematic risk, then obviously what? A is the best security, and what? Then B, sorry, then F, then F. But if you take into consideration unsystematic risk, then what? F is better than A. F is better than what? A. So even though A return is greater than F, so A return is just greater than by what? 1%. But whereas unsystematic risk is higher than the F security by 10. By 10, yes or no? So that's why we have a concept of cut-off point. Cut-off point means, so how do we find out the cut-off point? Cut-off point means up to where the investment can be made. Out of 5 securities, we cannot invest in all the 6 securities. So we determine the cut-off point, and we select the securities in which the investment has to be made. So here the point, this calculation is based on the point that we have to take into account the unsystematic risk also. Okay. Let us take the columns. So I will take columns one by one. First, security. First, security. Next, trainers ratio. And next, systematic risk divided by unsystematic risk. Systematic risk divided by unsystematic risk. Nothing but beta S square sigma m square divided by sigma square EA. Yes or no? So this is what? Nothing but systematic risk divided by unsystematic risk. Clear? Okay. Next column, cumulative summation sigma 1 plus beta S square sigma m square 1 plus beta s square sigma m square divided by sigma square Ci. Nothing but 1 plus what? Systematic risk divided by unsystematic risk. Okay? Clear? Okay, next. Trainer's ratio into, let us give numbering 1, 2, 3, 4, 5. Trainer's ratio into 3. Trainer's ratio into 3 means what? Nothing but trainer's ratio into systematic risk divided by unsystematic risk. Clear? Next, summation sigma trainer's ratio into 3. Trainer's ratio into 3. So I am making it simple. So by the end of this session, you can easily solve the cutoff point. Clear? So the last column. The last column, 6 divided by 4. Last column, 6 divided by 4. First, write down the security as per ranking. As per ranking. So rank 1 goes to security A. And then what? Rank 2 goes to F. Rank 2 goes to F. Next what? B. D. And next what? C. And then what? E. Okay. So write down the trainers ratio. What is the trainers ratio? 5.33. 4.667 and B 2.5, D 2 and C 1.5 and this one 0.833. Clear? Now what is the third column? Third column is nothing but systematic risk divided by unsystematic risk. We already know as per Sharpe index model, systematic risk is equal to beta s square sigma m square. In the question, sigma m square is already given. Variance of market is given. What is the variance of market? 10. What is the variance of market? 10. So what is the beta in first case? 1.5 square. What is the beta of A? 1.5. 1.5 square into sigma m 10 divided by unsystematic risk. What is unsystematic risk? 40. Clear? So beta s square into sigma m square divided by unsystematic risk. So 1.5 square into 10 divided by 40. So tell me what is the number? What is the number? 0.5625. Second, what is the f beta? 1.5. So 1.5 square into 10 divided by, this time unsystematic risk is 30. So unsystematic risk is in the denominator. Yes or no? So what is the number? See, this 0.75 is greater than A. So we are taking into consideration what? Unsystematic risk also. Okay. Next, third one. So third one, so there is no space to write, you calculate. So what is the third security? B. So what is the B beta? 2. 2 square into 10 divided by 20. So answer is 2. Okay, clear? Next. So next, D. 1 square into 10 divided by 10. You will get 1. Next, C. 2.5 square into 10 divided by 30. 2.0833. Clear? So next one. C completed, right? E. 1.2 square into 10 divided by 20. 0.72. So this third column is nothing but what? Systematic risk divided by unsystematic risk. So now let us take the cumulative. Okay, let us take the cumulative. But before taking the cumulative, add 1. So first one 1.5625. So add 0.75 to this 1.5625. 2.3125. So you take 2.31, 2 decimal. Next 4.31. 5.31. Next 2.0833. 7.39. Next. 8.11. Clear? So we took a cumulative of a systematic risk divided by what? Unsystematic risk. Done? Clear? Now, fifth column. What is this fifth column? So trainer's ratio into systematic risk divided by unsystematic risk. If you are taking only trainer's ratio, means you are considering only systematic risk. So, but we are going to consider about unsystematic risk also. What is the trainer's ratio? 5.33 into 0.5625. 2.3. The answer is what? 3. Next, 4.667 into 0.75. 4.667 into 0.75. 3.5. Next, 2.5 into 2. 5. 2 into 1. 2. 1.5 into 2.083. 1.5. C. What is the C? C trainers ratio 1.2. Sorry, I'm sorry. C trainers ratio 1.2. 1.2 into 2.0833. What is the number? 2.5. 0.833 into 0.72. 0.6. You will find complicated answer in ICAI book. Okay. Next, let us take the cumulative factors. So what is the cumulative trainers ratio into systematic risk divided by unsystematic risk? 3, 6.5, 11.5, 13.5, 16, 16.6. Clear? Okay. Now, so last column, cutoff point. So how do we get cutoff point? So sixth column divided by fourth column. Sixth column divided by what? Fourth column. Nothing but trainers ratio into systematic risk divided by unsystematic risk, all divided by 1 plus systematic risk divided by unsystematic risk. But we should take a cumulative factors. So first case, 3 divided by 1.5625. 1.923. Next, 6.5 divided by 2.31. 6.5 divided by 2.31. 2.813. Third case, 11.5 divided by 4.31. 2.668. Next, 13.5 divided by 5.31. 2.542. Next case, 16 divided by 7.31. 7.39. Sorry, 2.165. Next case, 16.6 divided by 8.11. 2.046. I am writing in next page. 2.046. See the last column. Security A. You have to invest in the securities in the following order, right? A, then F, B, D, C, E. If you consider only the trainers ratio. But here in second part we calculated a cutoff point. So cutoff point. If you observe the last column, the number is increasing up to F and thereafter the number is decreasing. Yes or no? So that means this is the cutoff point. 2.813 is the cut-off point. Nothing but you have to make investment in security A and F. Okay, if you start investing in B, your portfolio will lose the optimality. Okay, so that's why you have to invest only on what you have to invest only in security A and F. So 2.813 is the cutoff point. Okay, now last part, C part. They're asking you to determine the optimum portfolio. So determine the optimum portfolio, we should find out the proportion. Last part, optimum portfolio. Okay, so to find out the optimum portfolio, first let us find out ZA. Okay, so one thing is clear, based on the second part, one thing is clear, we should make investment only in security A and F, that's it. Okay, so what is the ZA? ZA is equal to beta A divided by sigma square Ci or EI. Okay, nothing but beta divided by unsystematic risk into trainer's ratio minus what? Cutoff point. So this is a complicated one, okay? So what is the beta? 1.5 divided by what? 40 into trainer's ratio 5.33 minus cutoff point. What is the cutoff point? 2.813. So what is the number you're getting? Likewise, let us find out ZF also. ZF 1.5 divided by 30 into 4.667 trainer's ratio minus 2.813. First case, what is the number? 0.094. Second case, 0.0927. What is the next number? 0.0927. So ZA is greater than ZF. That means proportion of A will obviously greater than what? Proportion of a F. So weight of A is equal to, see the calculation, weight of A is equal to 0.094 divided by 0.094 plus 0.927 or 0.0927? 0.0927. And weight of B is equal to, sir, weight of F. Weight of F is equal to 0.0927 divided by 0.094 plus 0.0927. So tell me what is the weight of A and weight of F. Weight of A. Weight of A. So tell me the number, final answer. So these are the weights for optimum portfolio. Is these numbers correct or not? Weight of A is equal to 0.5041, nothing but 50.41. Yes or no? 50.41. What about this one? 49.59. 49.59. Clear? So these are the weights. So nothing but the conclusion is how the investment should be made. Funds to be invested in security A and F are 50.41% and 49.59% respectively. So this is one of the most complicated concept in entire AFM. Clear? Are you able to understand this? Done? Okay. So simple. Here the cutoff point is complicated. What are the columns we are taking? Security, trainer's ratio, systematic risk divided by unsystematic risk, summation of 1 plus systematic risk divided by unsystematic risk, and next trainer's ratio into summation of 1 plus systematic risk divided by unsystematic risk. Clear? Sorry, trainer's ratio into systematic risk divided by unsystematic risk. Fifth column, trainer's ratio into systematic risk divided by unsystematic risk. And sixth column, summation of fifth column, cumulative. Okay. And next, last cutoff point, to find out the cutoff point, what? Sixth column divided by fourth column. Done? Clear? Now, so we completed portfolio management. We have discussed each and every concept of the portfolio management. Question number 1. So this is a smart question. These are the additional questions, left out questions, smart. So question number 2. This is also a smart question. Additional questions, okay? So this is May 2023 question. This is super question. So please do practice this question now. So you know the concept, right? You solve this question. Question number 5. This is also a super question. Super question. Arbitrage pricing theory. Similar kind of a question we have already done. Please solve this question also. Question number 5. Not the question number 5. Actually, the serial number is wrong. 1, 2, 3. The next what? 4. This question refer. That means smart. If you have a time, refer this question. 11 already covered. This refer, smart. All points are covered in this question, but generally this question may not be asked in examination. So this is also smart. Okay. So on priority, I would request you to solve this question number 4. I think this is November 23 CA final past question. And this question number 3, May 2023 past question. So this is the priority. Okay. I hope you enjoyed the session. So please let me know the feedback in comment section, because that is the only motivation I get from online students. Okay, so what is our next session? Derivative analysis and valuation. So thank you all. Thank you so much.